CPA with manifested online classes. We're here to make your CPA journey a success, no matter your learning style. Choose your path to CPA victory. Live Zoom classes. Experience the energy of live learning with expert instructors. It's just like being in the classroom, but from the comfort of your home. Plus, if you miss a class, no worries. You'll have access to class recordings. Live classes are just 4,500 shillings per subject, and our September to December timetable is out now. Classes kick off on September 2nd. To enroll, use paybill 4216688873 and enter the subject code as your account name. It's that simple. Manifested online classes. Your CPA success story starts here.
Welcome to Manifested Publishers.
So once we have that, we can then just move ahead to the base, to the optimistic case. We just, first of all, before we group, we just copy this part, again, copy, and we can skip this part towards the right there, Control V. Even if you were to just delete this part over here now, delete it, that, or we can just undo and undo. And we select this part and just say cut instead of copy. Cut there. And then we paste it right here. Control V, so that now we don't get disturbed by the space. And we copy this part up to 2022, like that again. Copy. Sorry, I said cut. This should be copy. And we put it right above, right here. Control V. And this case is what? Optimistic case. Optimistic case. In a similar font, just put that right there. And here we can just be able to group it right over here. So we group. Where do we group? We come to data. We come to group. You can see group here. We press the above one. Group, that thing comes. This kind of grouping comes. In terms of the outline, let's group it there. So we have even this one for the base case. Let's group it. We want our forecast to be from 2023 to 2027. So you can see I click this one, copy 2023 to 2027 like that, copy, and then we reduce the grouping right over there and compress Control V. It comes. Now let's look at systematically, step by step, what changes we have to make. So we again go through this, clear the font, no fill, we make adjustments. Revenue growth rates are the forecast under the three scenarios, namely base case, optimistic case, and pessimistic case. The base case growth rate for the first year and forecast is 2022 CAGR. This is expected to reduce by 2% annually until the last year of the forecast, subject to a minimum of 15%. Optimistic case is 20% above the base case. So we can come right over here to 21A down here. And we're saying it is 20% above. Here is a pessimistic case. We said it was 10% below. So you can come over here, optimistic, here, and say that it is plus this one, plus this one times, open the brackets, 1 plus, not minus, 1 plus 20%. It's above. So 20%. So for purposes of consistency, like that, 25%. So we increase 21% by 20%, it comes to 25%. So what are we told? We come back to tab B. 20% above the base case. So the base case was 21%, yes. So we are saying that it is expected to reduce like that. And we can say that now, come back over here, plus 22 like that, times, open the brackets, 1 plus, we come to this value here, that value, close the brackets, enter, 119. So for font, keep the font the same. Once you have 119, it's expected to reduce by what percentage? By 2%. So plus this one minus 2%, 23%. Then plus this one minus 2%, that 21%, and so on and so forth. As you move along, move along up to there. So what are we saying? This is 2023, and we can be able to increase like that until 2027. So field series. So this will be the rates for the years over here. This is the years, bold that. These are going to be the rates right here. So we've picked 25% for 2023. Now we need to pick 23% for 2024. So we pick plus that value times, open the brackets, 1 plus what? The one for 2024. We come back to tab A. 2024 you can see is that one there. Close the brackets, enter like that, and you do the same plus that value times shift, open the brackets, 1 plus what? We are picking 2025. We come to tab, this next tab over here. 2025 you can see is 21%, and close the brackets, enter like that, and then plus that value over there times, open the brackets, 1 plus what? We are picking 2026. So we come back over here, 2026, and right over here is 19%. Like that. You close the brackets, and then you press enter. And then we are saying we press plus that value times, open the brackets, 1 plus what? We are picking 2027. Come back over here, 2027 is 17%. It's not reached the threshold of 15%. Like that, we close the brackets and we press enter like that, and that gives us the revenue under the optimistic case. How about cost of sales? We already have the gross profit margin. So you can be able to compute the gross profits very easily like that. So we just come over here, highlight like that, the same format, painter there. We're saying it's just going to be given as the sales times gross profit margin. So plus that times the gross profit margin for 2023, that over there, gross profit margin is that. Once we have that, we just drag the formula moving to the right there. And then for us, it's going to be is equals to minus, so we open the brackets right over here, that one minus that value, and we close the bracket like that, so you can be able to get it consistently as a negative value there. So for format painter, you move across like that, and then you can now drag the formula moving towards the right. So to just check, so plus that gives us, so you can see this answer is the same as that one there, and even if you were to drag it moving towards the right, of course you can see that one is the same as that. Of course the decimal places over here come into play, but don't worry about that, it's actually the same. These are actually the same values there. So delete that for now. How about the operating expenses? We have the operating ratio, they are given to us there. We've been told, so revenue is done, put pitch there, gross profit margin is done, we've done that. Operating expenses are modeled 3-year averages for the period 2020 to 2022. These are assumed to remain constant of the forecast period. So we just pick the expense ratio. To get the operating expenses is just the sales times expense ratio from 2023. Sales times expense ratio. So plus, so is equals to minus, because it's a formula like that, times the expense ratio, because it's operating expenses, expense ratio 2023, ndio hiyo iko hapo, like that, close the bracket, enter. Move up, so negative value, formatting, come to format painter, like that. Of course, in the exam, you don't need to just really bother yourself with the format, but I'm just doing it because of to ensure that we have consistent results there and consistency in terms of presentation. That's it. We just drag the formula like that. How about operating profit? Plus that should give us, that's all. I said plus that value plus that value should give us 44 there. Just drag it like that. It gives us the same, gives us consistent answers. Format painter. Depreciation. We've been told that depreciation, we finished operating expenses, we've been told depreciation down over here to revenue ratio is assumed to remain constant over the 3-year average for the period 2020 to 2022. So we should remain here 0.9%. So it's just going to be the sales times depreciation ratio. So it's just going to be plus sales times depreciation ratio 2023. There, enter. Once we have that, we drag the formula towards the right, and we can be able to ensure consistency. So minus, then we open the brackets, close the bracket like that, enter. But now here it should be negative. Oops, like that. How about the profit before tax, before interest and tax? Plus that, get the answer straightforward, move towards the right. Format painter, there. Finance costs, ladies and gentlemen. We are saying finance costs, we've already done depreciation right over there. Come to finance costs. They are expected to reduce steadily as the loans are repaid. Use the reduction rate in 2022 over the forecast period there. So in a similar fashion, plus that one minus, this is the depreciation rate, reduction rate. So 2023 there. Oops, it should be plus, this is 2023, that one minus that. I'm pressing minus or plus, sorry. Plus that one plus 1,000, yes, 2023, that. Yes, that's the correct value. Sorry, using this wrong formula. We drag it like that. Format painter. Profit before tax plus that, get that. We drag the formula like that towards the right, and we use format painter. Finally, or rather semi-finally, second to final, income tax expense. We've been told the income tax expense and the finance cost we've done. Income tax expense, calculate the historical average effective tax rate. Highlight that to show that you've done it, and it's just going to be plus that times this value here, like that. But because it's a negative, so you put negative minus. Open the brackets, close the bracket, enter. So we drag there. Finally, we have the profit before tax plus that, should be able to have those values like given to you there. So format painter, you can see the values right there. So 2023, I need to ensure that there's consistency in terms of the presentation of the outlook over there. You can be able to see that we have concluded the optimistic case. So we have answered part B of the question. Prepare 5-year forecast statements for profit and loss for Sepetuka Limited from 2023 to year 2027. So just to recap what we've discussed, we were told to prepare a base case income statement, a pessimistic case income statement. You can compare, and the 42 represents the base case, and the 40,000 represents the worst case or the pessimistic case, and towards the right over here you can see the optimistic case is 50, slightly higher as compared to the previous two there. So this answers part B. Hope you have enjoyed the lesson. Thank you for being with us, and God bless you.
Welcome to Manifested Publishers.
Hello learners, welcome to our today's session of Revision Management Accounting December sitting. In our previous class, we were looking at question number 2, and today we are looking at question number 3 of the same sitting. So welcome, have your calculator, let's walk through together. Question number 3, part A, reads as follows. The cost accountant of ABC Limited has provided the following information relating to production of a single product branded Z. So we've been given details for 3 periods. That's period 1, 2, and 3. We have production in kilograms, sales in kilograms, opening stock in kilograms, and closing stock in kilograms. Then additional information note number 1, the financial details for 1 unit of Z based on the normal activity level of 30 kilograms are as follows. So we have the cost per unit for direct materials, labor, production overheads, and the selling price per unit. Then note number 3, we are told that administrative overheads are fixed at 25,000 per period, whereas 1/3 of production overheads are fixed. And then required, prepare operating statements using Roman 1 variable costing. So we want to begin from there. Roman number 1, variable costing. So in management accounting, we have 2 methods of costing that we use, and one is a variable, or what's called marginal costing, and then the other one is called absorption costing. So in variable costing or marginal costing, we normally include variable costs only in the cost of sales. So when we are computing the cost of sales, ensure that we are separating the fixed cost and the variable cost, so that we only consider the variable production cost. And that's what we are required to do. And since we have 3 periods, we need to show all the periods on one sheet. So we'll not prepare for period 1, 2, and 3 separately, but you show it as one statement. So you can prepare that. So this is ABC Limited variable costing income or operating statement. Variable costing operating statement. So we were not given the year. If we had at the year, then we say for the year ended, but we do not have that. So we only have that included. So we have period 1, period 2, and period 3. So for each period, we'll have 2 columns. So we have 3 periods, which will show it all together. And so we begin with the sales. So we normally have the format for preparing the operating statement. We'll have the sales, we less the cost of sales, we less the closing stock, the cost of sales, we less the fixed cost, and we'll be able to get the net profit. So we calculate the sales. We are beginning with the period 1. Period 1 sales were 30,000, and in note number 2, we are told that the selling price of product Z is 9 shillings per kilogram. So to calculate the sales, we are taking 30,000 multiplied by the selling price of 9, which will give us 270,000. Can put in thousands of shillings so that we have smaller figures. So we have 270 as the sales for period 1. Then we less cost of sales. So cost of sales comprise the opening stock. When you look at the question, period number 1, we were told production was 30,000, sales was 30. And then we do not have any information about the beginning inventory. So we assume that there was no opening stock. So you just put a nil where we have opening stock. Then we add production cost. Production cost will comprise variable production cost only. So the main variable production cost as given in the question is we have direct materials. We were told that it is 1.5 shillings per kilogram. So when we are calculating the variable costs, we base on production. So we take 1.5 multiplied by 30,000. 1.5 times 30,000 kilograms, and that will give us 45,000. We also have direct labor. We have direct labor, which was 1 shilling per kilogram, and production was 30. So 1 shilling multiplied by 30 will give us 30,000 shillings. Then the next one is production overhead. Production overheads. So the production overheads that we are including are the variable production overheads only. In note number 3, we were told that the administrative overheads are fixed at 25,000 shillings per period, whereas 1/3 of production overheads are fixed. So meaning the 3/4 of the production overheads is variable. So we are to get that variable part, and that's what we will include in the cost of sales for that variable statement. So how do we calculate that? So working 1, we are calculating the variable production overheads, which is simply variable 2/3 of 2/3 of 3 shillings. A third is fixed, so means 2/3, means 2/3 is variable. So we multiply by 3 shillings, and this will give us 2 shillings. So to calculate the variable production overhead, this is our working number one. Working number one, we are taking 2 and we are multiplying by the production. So the production was 30,000 times 2, and that will give us 60. So we take 60 and then we add this. This gives us 135. Before we bring it here, this will give us 135, and this is the cost of goods available for sale. Then we less closing stock. So we were told that production was 30,000, sales were 30,000, meaning there was no closing stock. So we have nil stock, and therefore the amount will simply be 130, which is our cost of sales, and then we subtract it from the sales to give us what we refer to as contribution. So contribution is simply sales minus the cost of sales. So when you subtract this, you'll get 135, and once we get the contribution, we less all the fixed costs. So in variable costing, whether it is a production fixed cost or a non-production fixed cost, we subtract it from the contribution. So we are to identify the fixed cost in the question, and we will calculate the fixed. This is 2 fixed production overheads, which we were told that was 1/3 of that which was given, and this is simply 1 shilling. So we have fixed cost under which we have production overheads, the net profit. So the net profit will be 80. That's for period 1. We do the same for period 2 and 3. We do the same for period 2 and 3. So for period 2, the sales, we need to calculate the sales, which we are basing on the sales in kilograms times the selling price. So the sales in kilograms were 27,000 multiplied by 9 shillings. So this will give us 243,000. Then we are lessing the cost of sales under which we have opening stock. So we need to know whether there is opening stock. In period number 2, the production was 38,000. The sales were 27,000. So when you take 38,000, remember we do not have any closing stock from period 1. So when we have closing stock in period 1, this closing stock will automatically be the opening stock in the next period. So that simply means in period 2, we do not have opening stock. Why? We do not have closing stock from period 1. So for opening stock in period 2, we also put a 0. And I was explaining we had 38,000 units produced, and we are told that 27 were sold, and then we have 11,000 remaining in stock, meaning there was no opening stock. From there, we add production cost. So production cost comprises direct materials. We are including variable cost only. So direct materials for period 2, we are taking 1.5 shillings. That was the cost per unit, and we multiply by production of 38,000. And this will give us 57,000 shillings. Then direct labor is given at 1 shilling per kilogram. So we take 1 multiplied by production of 38. 1 times 38, we will have 38,000. And then production overheads for period 2, we were told that variable production were 2/3. Still working number 1, 2/3, which gave us 2 shillings per kilograms. So 2 shillings multiplied by 38,000. 2 times 38,000 will give us 76. And then we add. So the total is 171. And in period number 2, we are told that we have closing stock of 11,000. So we need to calculate the closing stock value. This is working number 3, closing stock. Closing stock, this will simply be based on variable cost only. So we were told that closing stock, that is for period 2. Period 2. We have 11,000 units times. So the question is, what is the cost per unit? The question per unit, the cost per unit will comprise the cost per unit of direct material, the cost per unit of direct labor, and the cost per unit of production overheads, which we've already been given in the question. So we are taking 1.5, which is the cost per unit for direct materials, plus 1, this is 1.5, plus 1, that's the cost for direct labor, plus 2, which is the cost for production overheads. And what we get will be the value that we will use in period 2. So 1.5 plus 1 plus 2 will give us 4.5 times 11,000, and this is 49,500. So our closing stock here is 49.5. Subtract that. And this will give us 121.5. So 121.5 is the cost of sales, which we subtract from the sales. And this will give us 121.5. Then we come to fixed costs. The fixed costs, we say that was 1/3. Fixed production overheads, 1/3 of 3 shillings, which is 1. So we take 1 and then we multiply by the production. And production for period 2 is 38. So the fixed production overhead here is 38,000, and fixed administrative overhead remains fixed at 25. So add that, and this will give us 63. We subtract it from the contribution, and we'll get a profit of 58,500. That's for period 2. Then we move on to period 3. In period 2, we had closing stock of 49.5. So this closing stock will automatically become the opening stock for this period. So for opening stock, we have 40, sorry, we've not calculated the sales. We begin from sales. So the sales for period 3, according to the question, production was 27,000 and sales were 38. So take 38,000 times the selling price of 9 shillings, which will give us 342,000. And then we less cost of sales, of which we have the opening stock. So the opening stock is here. Here is 49.5. This is the balance to be carried forward, which was 49.5. So we bring it there. Then we add production cost, and production cost is comprising direct materials. And the direct material cost per unit is 1.5, but production was 27. So take 1.5 times 27,000. It will give you the cost for direct material, which is 40.5. That's 40,500. Then direct labor is 1 shilling per kilogram. Production was 27. So 1 times 27,000 will give you 27,000. We come to production overheads, working number 1. It was 2/3 of 3, which is 2. We take 2, we multiply by production, which was 27. So 27 times 2 will give us 54,000. And then we add that. So this will be equal to 171. Then 171, we see whether there is closing stock. In the question, we do not have opening stock. Production was 27,000. The sales were 38,000. So when you take the sales of 38,000 and then you subtract it from the 27,000 production, you'll realize that there was a deficit of 11, which was just the balance that was carried forward from the closing stock. So there is no closing stock in period 3. So we subtract a 0, we subtract a 0, which will give us 171. We subtract 171 from the sales, and it will give us 171. Then we less the production overheads. Production overhead, working number 2. Production overheads, working number 2. Working number 2, we have 1 shilling times production of 27, and this will give us 27. Then administrative overheads are fixed at 25. So we add that, and this will give us 52 shillings, which we then subtract from 171 to get a net profit of 119. And that's how we use variable. So a point to remember, in variable, we are including variable production cost only. When we compute inventories or stocks, we use variable production cost per unit only. We don't include any fixed portion. And that was Roman 1. Then we move on to Roman number 2. So Roman 2, we use absorption costing. So the company is ABC Limited. So we begin with the sales. So how is absorption costing different from marginal costing? We have three main things that differentiate between marginal and absorption. In marginal, we have said we are separating fixed cost and variable cost so that what is included in the cost of sales is only variable. In absorption costing, the cost of sales will comprise both fixed and variable components. So long as it is a production cost, we consider it both as fixed and variable. Again, in absorption costing, we have what we refer to as product cost and period cost. Product costs are treated, in absorption costing, we treat fixed costs as product costs. But in marginal costing or variable costing, we are treating fixed costs as period cost. We expense them when they are incurred and in that period in which they are incurred. And the last item that differentiates between variable and absorption, in variable, we do not have application of absorption of overheads, but in absorption costing, we have application of the principles of absorbing cost, which is making it different. So we begin with the sales. The sales are calculated in the same way. So for period number 1, we have sales of 30,000 and the selling price is 9. So when you take 9 and multiply by 30,000, we get 270. Then we less cost of sales. So the cost of sales will comprise opening stock. So we didn't have opening stock in period 1, so we put a 0. Then we add production cost. Production cost consists of direct materials. So the direct materials for period number 1 is 30 times 1.5, which gave us 45,000. We add direct labor, and direct labor was 1 shilling per kilogram, and we had production of 30, which is 1 times 30, and that's 30. Then production overheads. So when we come to production overheads, we are not separating fixed and variable. In the question, we were told that production overheads was 300% of labor, and that the amount is 3. And in note number 3, we were told that administrative overheads are fixed at 25,000 per period, whereas a third of production overheads were fixed. So in marginal or variable, we were separating that. But in absorption, we don't separate. Why? So long as it's a production cost, whether fixed or variable, we include it in the cost of sales. And therefore, to calculate production overhead, we are simply taking 3 and we multiply by the production, which is 3 times, this is workings, 1. We are taking, this is production overheads. This will simply be 3 shillings times 30,000 kilograms, and that will give us 90,000. So we will have 90,000 and not 60 as in the case of variable. Then we add so we have 165. We have 165, which is the cost of goods available for sale. Then we less closing stock. Closing stock in absorption costing is based again on both fixed and variable, but according to the question, there was no opening stock. So there was no closing stock, so it is 0. We subtract that and we'll get 165, which is the cost of sales. When we subtract, we now get what we refer to as gross profit and not contribution. So the gross profit will be 105, and once we get the gross profit, we will consider whether there is any over or under. So we add over absorption. Over absorption arises when what we absorb or what we charge is more than what is actually incurred. So when you read note number 1, we were told that the financial details of one unit of product Z based on a normal activity level of 30,000 kilograms. So it means the details we have were based on the activity level of 30,000. So whenever a company produces either more or less than that, it means there will be either an over or under absorption. But in period number 1, we will not have an over or under. Why? This farm produced 30,000, which is equal to the normal level of activity. So for over absorption, there is a nil, and then under absorption will also give us a nil. So this is subtracted. Over absorption is added, under absorption is subtracted to give us the adjusted gross profit. So our adjusted gross profit is 105, and from there we less all the expenses. So in management accounting, expenses are simply referring to all the non-manufacturing costs. Any non-manufacturing cost is considered as an expense. So according to the question, in note number 3, we were told that administrative overheads are fixed at 25,000. So our expenses here are simply the administrative overheads, and is fixed at 25. So you subtract that, and what we get will be the profit, which is 80,000. That was for period 1. We do the same for period 2. The sales remains the same. Sales made were 27,000. 27,000 times 9 gave us 243. Then opening stock, since we do not have closing stock in period 1, opening stock is not will not be there. We add production cost, which is comprising direct materials. So direct materials were 38 times 1.5, which gave us 57. Direct labor was 38,000 times 1, which gave us 38. And then we need to calculate production overheads. This is working number 2. So production overheads was working number 1, and then still working number 1, production overheads. Now for period 2. Period 2, we are using the same formula. We are simply taking 3 multiplied by the production units, in this case, which were 38,000 kilograms. So 3 times 38,000 will give us 114. So production here will be 114. And then we add. This will give us a total of 209. So something to note is the production overhead is 114, and the production was more than that of the normal activity level. We were told that this data provided is based on the level of 30,000. And so if we were to rate the actual amount should have been 90,000, which is based on the activity level of 30,000. But now here we have 114,000, which is above that. So it means that we will have an overabsorption. Why? What we are absorbing or what we are charging, the 114 is greater than what should have been charged under the normal, which is 90. So when we are absorbing more than that which is actual, then we have an over-absorption. Of how much? Of simply the difference. So we show the over-absorption of overheads, which will be equal to 114,000 minus that of the actual activity, which is 90,000. So this difference and this will be 24,000. So we will adjust that on our profit. So we now have the cost of goods sold, which is 209. Then we see if there is any opening closing stock. We were told that closing stock was 11,000. So how do we calculate closing stock? So closing stock will be based on all the production cost, both fixed and variable. And so in this case, closing stock will now be 11,000 multiplied by the cost of direct material plus that of labor plus that of the production, both fixed and variable. So when you calculate that, this will give us 60,500. So the closing stock will be 60,500. This will be 60,500. We subtract that and then we get the cost of sales, which is 148.5. Subtract the cost of sales from the sales to get gross profit of 94.5 or 94,500. Then we check if there was an overabsorption. There was an overabsorption of 24,000. So we add 24,000. There was no under absorption. And then we get the adjusted profit. So this will give us 118.5. Then we less expenses, which are just the 25,000. Then this will give us a profit of 93.5. 93.5. We move on to the last period. That's period number 3. The sales are remaining the same. That is 342. Then we add, we less cost of sales, of which we have opening stock. So in period 3, we will have opening stock. Why? Because we had closing stock in period 2. So opening stock will be 60.5. Then we add production cost, which is comprising direct materials. The direct materials is production 27,000 times 1.5. Which gave us 40.5 or 40,500. Then we add direct labor, that's 1 shilling times 27, and that gave 27. And then we calculate production overheads. So production overheads for period 3. Period 3 production overhead. Period 3 production overheads. This will be equal to 3 shillings times 27,000. And this will amount to 81. So for the normal activity level of 30, the production overheads were 90. So the actual production overheads are 90, but now what we are absorbing is less than that which is actual. So when the absorbed is less than the actual, it means that we have an under absorption of overheads. And under absorption is the difference, which is 90,000 minus 81,000. So this will give us 9,000 shillings. So we will use that again to adjust our gross profit. So we add this. This will give us 128. There was no closing stock in period 3. So we have nil closing stock. And so we'll have 128 cost of sales. We subtract the cost of sales from the sales. And this will give us 214,000. So we do not have over absorption, but we have an under absorption of 9,000, which we subtract, and then we remain with 205,000. So 205 less expenses of 25,000 will remain with so the profit will be 180,000. And that was part A of question number 3. We now move on to part B of the same question. Summarize 4 assumptions of cost, volume, profit analysis. Assumptions of cost, volume, profit analysis. So cost, volume, profit analysis is comprising 3 variables. We have one variable, cost, another one is volume, and the other one is profit. So in cost volume analysis, we are looking at when one variable is changed, what will happen to the other variable? Are fixed costs remaining constant? What will be the effect on the revenue, and so on? So what are the assumptions? Assumption number 1, we say that total costs can be separated into their fixed and variable components. This is question 2, part B. 2, volume is the only factor affecting sales and expenses. Number 3, the theory of cost volume profit analysis. The theory of cost volume profit analysis applies to only a single product. Applies to a single product, only applies to a single product or service only. Then number 4, the selling price per unit, variable cost per unit, and fixed cost remains constant. I can add one. There is only a single product, there is only a single product or service there is only a single product or service, and in case of more than one, then a product mix will be applied. So those are some of the assumptions of cost volume profit analysis. Number 1, we are saying that total costs can be separated into their fixed and variable components. So whenever you are given a total cost, we normally say that total cost equals fixed cost plus variable cost, so that given a total cost and a proportion of either fixed or variable, we can be able to separate them. Then 2, volume is the only factor that is affecting sales and expenses. So when we change, we assume that in a cost volume profit analysis, whenever we change volume, there will be a change in sales that will bring about a change in expenses. So we say that the only factor that is affecting either sales or expenses is volume, and that happens when volume is changed, whether either being increased or decreased. And then the theory of cost volume profit analysis applies to a single product or service only. So it is not applied where we have more than one product. So in the last part, we have said that if there is only one product, we are assuming that cost volume is being applied where we only have one product or service. And in case we have more than one product, then we must have a product mix being applied. But it cannot be applied where there is more than one product. And again, we assume that the selling price per unit, the variable cost per unit, and fixed cost per unit remain constant. And we assume from 0 capacity to 100, especially in the case of fixed costs, they do not change. That was part B. Then lastly, we move on to part C. We are told that Britain Limited makes a single product branded P with a sales price of 100 shillings and a variable cost of 60 shillings, full stop. Fixed costs are 600,000 per annum. They are required, assuming the taxation rate is 40%, determine the number of units to be sold to make a profit after tax of 200,000 shillings per year. So assuming taxation, you have to ask yourself, what are you being asked to calculate? You are simply being asked to calculate in Roman 1, part C, Roman 1, You are being asked to calculate the level of sales to realize a target profit after tax, and that is in units. Level of sales to realize a target profit of after tax. So you've already been given the target profit, you have the tax. So how do we calculate this? This is the formula that we will use. We will have fixed costs plus target profit, and this target profit is to be exposed to tax. So we take 1 minus tax, or T, and then we divide the whole of this by CM. CM is simply contribution margin. So we calculate that. We were told that the annual fixed costs are 600,000 plus the target profit assumed is 200,000. We divide this by 1 minus tax, and the tax rate given is 40%, which is the same as 0.4. We divide the whole of this by contribution margin, and contribution margin is simply the sales price, which is 100 shillings, minus minus the variable cost per unit of 60 shillings. So we normally refer to this as CM, which is simply the selling price per unit minus the variable cost per unit. So we calculate this. So this will give us 23,333 units. So that's the level of sales that you will need to sell for you to realize a target profit of 200,000. Then Roman 2, we are told that as a result of increasing costs, the variable cost is expected to rise to 65. So it is rising from 60 to 65 shillings per unit, and the fixed cost to 700,000 shillings per annum. So we are told that assuming the selling price cannot be increased, determine the number of units required to maintain a profit of 200,000 shillings per annum. So we are told to ignore inflation. So in other words, we are to calculate, determine the level of sales to realize a target profit. Just the level of sales to realize a target profit. So how do we calculate this? This is simply equal to fixed costs plus target profit, and then we divide the whole of this by contribution margin. So the fixed costs, we are told that the fixed costs are increasing to 700,000 plus the target profit of 200,000. Then we divide the whole of this by CM, and the CM is changing. So we are told that the selling price is remaining constant, but variable costs are rising to 65. So what will be the sales? So this will be 25,714 units. And that's all about question number 3. So to give a summary of question number 3, you are to read more on marginal and absorption costing and application of break-even point in decision making. And so when we are calculating the break-even point, be able to know how to calculate the break-even point in different situations. When there is tax, when there is no tax, when there is a target profit, when there is no target profit, and the mathematical formula that are applied in all those situations. So that brings us to the end of our question number 3, and let's meet in the next session.
So let's move to part B of that question. Part B, the examiner was requiring the preparation of the statement of changes in equity. Statement of changes in equity for the year which ended 31st of December 2022. Now remember, we say that this is prepared basically to show or to explain why there was a change in the various items of what? Of equity. In preparing this statement, we have said we start with the details column, and then we identify the items of equity our company had during that year. So items of equity include ordinary share capital and items of reserves. So if we go back to the trial balance, I think from where we have ordinary share capital, that is the first item, share premium, the second one, retained profit, that is the third one. Do we have any other like general reserve and revaluation reserve? No. So mean that in our case, we only have 3 items of equity, and then automatically we need to have what? We need to have the total what? The total column, the total column. So let's have those columns here. We have those columns here. I've said we have, we're going to have a number of columns. The first one will be the details column, details column, and then ordinary share capital, ordinary share capital, share premium, and then retained what? Retained profit, and then the total column, Also our figures here, we indicate they are in thousands of shillings. They are in thousands of shillings. So what do we start with here? We always start with the opening balances. The opening balances brought down. So the balances brought down, these are the figures we have in the trial balance. These are the figures we have in the trial balance. For ordinary share capital, the opening balance was 200,000, share premium 50,000, retained profits 223, 640, 223, 640. Then what we need to do, basically we get now the totals. We get the totals. So we have 200,000 plus 50,000 plus 223, 223, 640, and that will give us a total of 473, 640. And then what we need to do is basically to take into account the transactions which occurred during the current year, and which affected those items. The first adjustment which we need to make to this particular retained profit is what we were given in the additional information number what? Number 5. Not number 5, but not number 3, in relation to these particular budgets which were supposed to be written off, which related to the prior year. So remember we said that this is a prior year adjustment. So therefore the first adjustment we make is to adjust this opening balance with the prior year adjustment. We say that the prior year adjustment, these are the adjustments which were supposed to be factored in to be taken into account in the prior years, in the previous years, but they were not taken into account. Remember, this amount of budget was supposed to be written off in the previous year, but it was not written off. So what we do is that we deduct it from the opening retained profit, and then from there we take into account the transactions which occurred during the current year. I think we can start by taking this right issue. The right issue 1, we said we need to add to the ordinary share capital, we add 40,000 because this amount was not accounted for, but it was credited in the suspense. And then to the share premium, we add what? We add 20. So that will give us a total of 60. We take it to the last what? To the last column. What else do we need to capture here? The profit for the year. The profit for the year here. The profit for the year, that will be added to the retained earnings at the start, and the profit for the is 371,490, and we take it to the last column there. Yes, that's what we have. What else do we need to capture here? In the trial balance, we have some interim dividends which were paid. So basically we know that dividends are paid from the profit, and therefore we need to list them here. So the interim dividends paid as per the trial balance were 10,000. So we list them here, and also we take that to the last column. Do we have anything else we need to capture? We need to take into account here from the trial balance. Okay, from the additional information, note 1, note 2, note 3, note 4, note 5, note 6, note 7. Yes, I don't think we have anything else. So what we need to do here is basically to get now the balances carried down, and we say that these are the balances now which we transfer to our statement of financial what? Position. So let's get those balances. The ordinary share capital here, the balance at the end will be how much? Will be 240. What about the share premium? It will be 70,000. What about the retained earnings? The retained earnings, the opening balance is 223,640 minus 5,000 plus 371,490, which is the profit for the current year, minus the interim dividend, which is 10,000. So that will give us what? It will give us 581 what? 130. And then we get now the total there. The total you can work out all that, or you add across. So let's just add across, and then we will confirm whether it is correct. So these we add 70,000, we add 240,000, 240,000, 240,000, 240,000. Yes, so this will give us what? This will give us 720, 130. Maybe we can work this downward. We see whether that is the same figure we are going to have. 473, 640 minus 5,000 plus 60,000 plus 371, 490 minus 10,000. Is that what you're going to get here? No. So let's I'm getting a figure here of 890, 130. So basically we can confirm again. So let's take 240,000 plus 70,000, 70,000 plus 580, 130, 130. Yes, the correct figure should be this one. So that is 890, 130, 130. Yes. So basically that is our statement of what? Changes in equity. Our statement of changes in what? In equity. And basically that what was required in part B. Remember this is part B, not part A. Part B. So then finally, we prepare now the statement of financial position. Statement of financial position. Position as at 31st of December 2022. 31st of December 2022. 31st of December 2022. So this is quite simple because we have most of the items to be included here. For example, we have all the items of what? Items of equity. So when preparing the statement of financial position here, we said we start with the assets. First of all, we record the non-current asset and then current what? Asset. So what we start with are the non-current assets. The non-current assets, we need to have a single column here, and also we have to indicate that all our figures are in thousand of shillings. All our figures are in thousand of what? Of shillings. So these are non-current what? Assets. Non-current assets. So what we start with here, definitely we're going to start with the PPE, the property, plant and what? Equipment. And in our case here we have various items of PPE. We have property, we have plant, we have motor vehicle, we have office what? Equipment. So what we need to do as far as those items of PPE are concerned is we compute their total net book value at the end of what? Of the year. And basically we include that here as a single figure of what? The PP. Remember what you have said here is that when preparing a statement of financial position for publication purpose, you don't record those items here separately. For example, you compute the net book value of plant, you include it here separately, plant the same. No, we don't do that. In fact, in an exam situation, if you do that, those items will not be marked for you. So what you do as far as the tangible and current asset are concerned, you compute their total net book value, all of them, and then you include that here as PP. As what? PP. So let's start with the property. Property, the cost is 60. And because this property include building, we have now to less the accumulated depreciation of buildings at the start of the year. Or basically, we have to less the accumulated depreciation for buildings at the end. So what would be the accumulated depreciation for buildings at the end of the year? Accumulated depreciation at the end of the year. So in terms of how we compute this, we take the accumulated depreciation at the start, which is part of the trial balance, or which is in the trial balance, and then we add the depreciation for the current year. The depreciation for the current year for buildings is how much? Is 10. So this will give us a total of 90. So we let's start now from the cost. From the cost. Then to this, we add plant. Plant, that is, the cost is 2 what? Is 280. And then what will be the accumulated depreciation of plant at the end of the year? We take the accumulated depreciation of plant at the start as given in the trial balance, 111, 160, and then we add the depreciation for the year here. How much is it? 14.5. 14.5. So this will give us an accumulated depreciation of what? It will give us accumulated depreciation of 125, 560. So let's just confirm that. We confirm whether that is correct. That addition is correct. We have 111, 160 plus 14, 500. So which will give us a total of 125, 560. Yes. So we less it here. 125, 560. But also, as far as the plant are concerned, we have to remember something. There was a plant which was disposed, and that plant is part of this. So what we need to do, the plant which was disposed, we need to less it from this net book value which you're going to get. Can you remember the net book value of this plant which was disposed? I think we can compute its net book value. Its net book value will be 39,700, and then minus accumulated depreciation. Its accumulated depreciation of 15,860. So therefore, its net book value was 23,840. So what we have deducted here is the plant which was disposed because it was not accounted for. So then from there, we add the net book value of motor vehicles. So what will be the net book value of the motor vehicles? We take the cost, which is 70, and then equally we compute the net book value at the end. The net book value at the end will be equal to the the accumulated depreciation at the end will be equal to the accumulated depreciation at the start, 42, and then to this we add the depreciation for the current year. How much is it? 14,000. 14,000. So that will give us a total of 56,000. So we less it from the cost, which is coming to 56,000. We less it from the cost, and finally we add office equipment. Office equipment, the cost is 40, and then we compute the accumulated depreciation at the end for office equipment. The accumulated depreciation at the start, as given in the trial balance, is 15. What about the depreciation for the year? 5. So the accumulated depreciation at the end for office equipment is 20,000. So we less that now from what? From the cost of 20,000. Yes, so that basically how we compute what? The net book value for the property, plant and equipment. Remember, property, plant and equipment here, these include all tangible and current assets. So let's work out that. We have 600,000 minus 90,000 plus 280,000 minus 125, 560 minus 23, 840. This is the plant which was disposed, plus 70,000 minus 56,000 plus 40,000 minus 20,000 minus 20,000 minus 20 what? 1,000 minus 20,000. So I think we can confirm that working so that we get the correct figure. Let's confirm that. So the first figure is 600,000. 600,000 minus 90, that is okay. And then plus 280,000 minus 125, 560. 125, 560 minus 23, 840. Plus 70,000 minus 56,000 plus 40 minus what? Minus 20, yes. So I'm getting a final figure here of 674, 600, yes. So that is the final figure for the PP. And then here we said we check for other assets like intangible asset, the investment, and so on. So let's go back to the information which we have in the trial balance. I think in the trial balance we have already captured the first items of PP: property, plant, motor vehicle, office equipment. Below that we have accumulated depreciations. Then we have in opening inventory, purchases, distribution, admin, revenue. We have already captured all those particular items here. Trade receivables, trade payables, those are items of current asset and current liabilities respectively. And then that bank balance, you can see that is an overdraft because the balance is on the credit side, is still a current liability. Deferred tax, that is an item of non-current liability. Current tax, we have already captured that. Bank interest, we have taken into account that. And then ordinary share capital, share premium, retained profit, all those are items of equity. Interim dividends, but this figure will need to be adjusted with this particular amount of 12 million, which was included as part of the receivables, but you're told those receivables are non-existent. So we reduce our receivables with an amount of what? 12. So we deduct 12 here, which will give us 62,500. Okay. And then from there, we check whether we have any other item of current assets. So the bank balance, which you're given in the trial balance, you need to know that that is a bank overdraft because it is on the credit side. The examiner will not tell you that. It is upon you to know that that is a bank overdraft and therefore is a current liability. Yes. In the trial balance, we don't have any item of current asset. What about the additional information? Number 1, you have dealt with that. Number 2, 3, 4. In note 5, we have the closing inventory. The closing inventory is included here as part of a current what? A current asset, which is 85. And then I think we are through. Yes, we don't have any other item. So what we need to do now is to get the total assets. To get the total what? The total assets. So let's add these particular items, and PPE, and then the 2 items of what? The 2 items of current liabilities. So we have 674,600 plus 62,500. 62,500 plus 85,000 plus 85,000. So that will give us total assets of 822,100. 822,100. And then from there, we proceed and record what? Equity. Now for equity, this is quite simple because we have all the items of equity to be included here. From where? From our statement of changes in equity. So we just need to copy paste those items here. We start with ordinary share capital. Ordinary share capital, the balance at the end of the year was 240,000. We have share premium. Share premium. The balance at the end of the year for share premium is what? 70,000. 70,000. Then we have the retained profits. The retained profits. At the end of the day, it was 580,130. And now what will be our total equity is what we have here. Total equity. Total equity. Total equity is what? Is 890. Is 890,130. 890,130. Okay. So then from there we proceed and we record the non-current liabilities. The non-current liabilities. Non-current liabilities. So which non-current liabilities do we have here? So for non-current liabilities, we say these include things like the bank loan, things like debentures, redeemable preference shares, and maybe something like the deferred tax. So what we need to check are the non-current liabilities which we have here. And in this question, we don't have bank loan, we don't have debentures, we don't have redeemable preference shares. I think in our case, we will only have one non-current liability, and that is the deferred tax. And the deferred tax which we include here, first of all, if we go back to the trial balance, we are given a deferred tax of 32,400. But remember what we are told in note number 4, that the deferred tax provision is to be reduced with how much? With 3 million. So therefore, the amount of deferred tax to be recorded here, the amount of deferred tax which will be recorded here as a liability, we take the amount given in the trial balance, which is 32,400, and then we reduce this with how much? We reduce that with 3 million. So this will give us what? This will give us 29,400. 29,400, and equally we can confirm whether that is working is correct. 32,400 minus 3,000. Yes, that will give us 29,400. So do we have any other non-current liability? I don't think so. We don't have any other non-current what? Liability. So finally, what we need to record are the current liabilities. Current liabilities from the trial balance. We have what? Remember the liabilities have a credit balance. So check the items on the credit side. So one, we have the trade payables. The trade payables. The trade payables is an amount of 68,800. Then below that we have the bank balance, or basically the bank overdraft. The bank overdraft. And the bank overdraft is 15,500. 15,500. Yes, I think those are the two items which we have in the trial balance here. In the trial balance. And then in the additional information, we check whether we have any other item of current liability. Note 1, we don't have any item of current liability. Note 2 is about depreciation. Note 3. And then note 4, we have the current tax for the current year. The current tax. So that tax, remember, had not been paid. And you are told in this case the company was supposed to pay, or the estimated tax liability for the current year was how much? Was 52. That's what we include here. Yes, and then note number 4 is about, note 5 is about inventory. Note 6 is about what? About now the right issue, the amount of what? The right issue. So I don't think we have any other item of current liability to be included here. To be included here. So what we need to do here is to get the total equity and liabilities, the total equity and liabilities. But there is something we need to adjust here. There is something which we added longly, because if you check on what we got here as the total equity, definitely you'll be able to see that that is more than total asset, which is basically long. So the figure which is long is this figure for retained earnings, or basically the retained profit. So there is something we added longer here. We need to make some changes quickly. So what do we have here? We have 138,000 plus 667,000 minus 85,000 plus 3840 plus 14,500. So that will give us what? That will give us 738. So this figure, instead of adding what we did, we deducted, which was actually long. So the correct figure here should be 738. 738 what? 340. So then we get the correct figure for the gross profit here. That was an error. So let's get the correct figure for the gross profit. We deduct that from our revenue, 1103, 500, and that will give us now the correct figure for the gross profit here to be 365, 160. So what else do we need to change? Our profit here before tax. Our profit before tax. So our profit before tax, we take 365, 160, minus now the three expenses, 58,000, minus 115, 500, minus 2,400, 2,400. So that will give us a figure of what? 189, to what? 260. And then we less the current tax, which is 54,600 plus the deferred tax income of 3,000. Yes, and our correct figure here for the profit for the year would be 137,660. Equally, that will be the total comprehensive income there. Yes, so that was basically a small addition, mistake or error. So we also need to adjust this figure for the profit for the year, because the correct profit for the year is how much? Is 137, 660, 137, 60. So meaning that this will also change here. This will also change here. Those two figures will change. So let's work out this. The retained profit at the end of the year. So we take the opening balance here, 223, 640, minus 5,000, which was the prior year adjustment, plus the profit for the year 137, 660, minus the interim dividends which were paid of how much? 10,000. 10,000. So that will give us a figure of 346, 300. Yes, and then we get now the total equity there. So we can work out that we take 346, 300 plus the 70,000 which we have here, plus 240,000. 240,000. So that will give us now the correct figure here of 656, 300. So therefore here we equally need to change this figure here. The retained earnings at the end, the correct figure is what? 346, 300. And the total equity as per our statement of changes in equity is 656, 300. I think now we can get now our total equity and what? Liabilities. So our total equity is 656, 300, plus now the deferred tax 29,400, plus the payable 68,800, 68,800. I hope that figure is correct. Yes. Plus the bank overdraft, which is 15,500, plus the current tax 52,000. 52,000. 52,000. So let's take that again. We start from equity there, 656, 300, plus 29,400, plus 68,800, plus 15,500, plus 52,000. 52,000. Yes, that will give us what? That will give us a figure of what? A figure of 822, 100. 822, 100. 822, 100. Yes. So basically that is it. That what was required as far as that question is concerned. That was an illustration question on the topic of what? A published financial statement. So basically that brings us to the end of that particular class. We meet in our next class as now we look on how we prepare the statement of cash flows. Remember what so far we have covered here is the preparation of the statement of comprehensive income, statement of changes in equity, statement of financial position, and then what is remaining is for us to discuss something to do with the statement of cash flows, the presentation of the same, and so on. So see you in the next class as we look on that.
Learners, welcome to the economics lesson. The chapter is agriculture and industry. In our today's lesson, we will study the benefits of small-scale industries in developing countries. By the end of this lesson, you should be able to elaborate the benefits of small-scale industries in developing countries. And the first benefit of small-scale industries in developing countries is to do with the potentiality of large employment. Potential for large employment. Potential for large employment. Small-scale industries have the potential for large employment. Large employment. Okay? They have the potential, small-scale industries have the potential to create employment opportunities on a massive scale. Why? Because small-scale industries are labor-intensive in character. They use more labor than other factors of production. They can be set up in a very small period of time and can provide employment opportunity to more number of people. Potential for large employment. Another benefit is that one that we call requirement of less capital. Less capital is required to set up small-scale industries. Okay? They require less capital when compared to large-scale industries. So a developing country is a capital-scarce country. A developing country is a capital-scarce country, and therefore small-scale industries are more suitable. That's a characteristic of a developing country. The developing countries may not have enough capital. Okay? And due to that reason, small-scale industries become better or suitable to operate in developing countries. And again, they can be started and run by small entrepreneurs who have little capital resources. Requirement of less capital is another benefit. The third benefit is the contribution to industrial output. Contribution to industrial output. How is it a benefit? Now, products manufactured by small-scale industries form a significant portion of the industrial output of the country. They produce a number of consumer goods as well as industrial components in large quantities, and therefore they satisfy the needs of consumers. The consumer goods are produced by small-scale industries, and these goods that are produced by small-scale industries are cheaper, and they satisfy the requirements of the poorer sections of the society. 4, contribution to exports. Contribution to exports. Small-scale industries contribute majorly to the industrial exports of a country. Further products produced by small-scale industries are used in the manufacture of products manufactured and exported by large-scale industries, and therefore they contribute both directly and indirectly to the exports and also earn valuable foreign exchange. A good example in Kenya here is production of tea, production of coffee. Coffee in Kenya is produced both on large scale and also on small scale. We have small scale farmers who produce tea, and that tea is exported. All right, it's put together in factories, processed, and also exported. Okay, they contribute both directly and indirectly to in order to earn what we call foreign valuable exchange. Okay, by exporting, and that is another benefit. By exporting, then that gives the other benefit, which is earning of foreign exchange. Earning of foreign exchange. Earning foreign exchange. Small-scale industries earn valuable foreign exchange. By doing what? By exporting products to different countries of the world. In point 5, we said that small-scale industries contribute to exports. After contributing to exports, these exports as a result, they help to earn foreign exchange. And at the same time, the imports are very little. Okay? And so there is less foreign exchange outgo. Therefore, small-scale industries are net foreign exchange earners. Point number 6, equitable distribution. Equitable distribution. Candidates, the large-scale industries lead to inequalities in income distribution and concentration of economic power. But small-scale industries distribute resources and wealth more equitably. And it is because income is distributed among more people or more workers, since it is labor intensive. And that results to what we call economic and social welfare. Small-scale industries do what? They contribute to what we call equitable distribution of wealth. Why? Because if you are to compare with the large-scale industries, the large-scale industries lead to inequalities in income distribution, because you may find one corporation earning a lot of money. Okay? When a company produces on large scale, many of the income is retained, maintained, or concentrated in one company, because a large scale industry is not labor intensive, it is capital intensive. Large scale industries use machineries, plants, and all that mechanization in production. But in small scale industries, it's labor intensive. Therefore, if it's labor intensive, it means the income is distributed amongst many people. Many people are employed. When dealing with small scale industries, you have many people being employed, and therefore income is distributed among many people or many workers, because it is labor intensive. And that results to economic and social welfare, where there is equitable distribution of wealth. So small scale industries help in the equal distribution of wealth as contrasted with the large scale industries. Use of domestic resources, number 7. Use of domestic resources is another benefit of small scale industries. Small industries use locally available resources in a productive manner, which would have otherwise gone to waste. The small amounts of savings which would have remained idle is channeled into setting up small enterprises, and that increases capital formation and investment in the economy. Number 8, opportunities for entrepreneurs. Opportunities for entrepreneurship or entrepreneurs. Okay? Small-scale industries provide opportunities for entrepreneurs with limited capital. Why? Because setting up a small-scale industry requires less capital and lower investment in technology and machines when compared to large-scale industries. And therefore, small-scale entrepreneurs can start small-scale industries easily and succeed. Cost efficiency. Number 9. Cost efficiency. Small-scale units can adopt lean production methods which offer better quality and more variety of low-cost products. They can be more cost efficient when compared to large-scale units because their expenses are lower. Flexibility in operation, number 10. Flexibility in operations. Small-scale entrepreneurs are more flexible. They can adapt themselves to changes in the market requirements very fast and benefit from new opportunities. And related to flexibility in operations is the advantage of adaptability to change. 11. Adaptability to change. Adaptability to change. Small-scale industries can understand the changing requirements of the customers and adapt themselves much quickly. They can change their procedures, they can change their markets, they can change their techniques faster and cater for the new requirements of their customers. 12. Less industrial disputes. Less industrial disputes. How is it a benefit to in relation to small-scale industries? Candidates in large-scale enterprises, workers are more organized and they join strong trade unions. The trade unions fight for the workers' rights, but in small-scale industries or enterprises, workers are not well organized and union activities is less. So there is very little possibility of industrial disputes to occur. So that's a benefit. When it comes to the affairs of small-scale industries or workers, there is likelihood to be less industrial disputes because they are not as organized as the large-scale industry. So that becomes an advantage. So candidates, there are many benefits of small-scale industries. I can go on and mention benefits like the personal contact with employees. Small-scale industries have personal contact with employees. And I can also mention another advantage being that there is personal contact with customers, right? Personal contact with customers. Another advantage could be self-interest. And how is self-interest a benefit? Is because candidate small business is generally run by the sole proprietors of the business. The sole proprietors earns all the profits and bears all risk. So self-interest acts as a strong motivator. And therefore, the sole trader would put in his or her best efforts to make the business a success. So these are benefits of small-scale industries. And to just recap what we have learned, candidates, we sought to elaborate on the benefits of small-scale industries in developing countries. We've said, point number 1, that small-scale industries have potential for large employment. Small industries employ large number of people in developing countries compared to large-scale companies or industries. The second benefit is the requirement of less capital. To set up a small-scale enterprise, you require less capital compared to large-scale industries. Number 3, contribution to industrial output. Number 4, contribution to exports. Number 5, earning foreign exchange. Small-scale industries help in the earning of foreign exchange. Number 6, equitable distribution. Number 7, use of domestic resources. Number 8, opportunities for entrepreneurs. Number 9, cost efficiency. Number 10, flexibility in operations. Number 11, adaptability to change. Number 12, less industrial disputes. These are the benefits that I wrote on the board. I also mentioned 3 other benefits, which are self-interest, personal contact with customers, personal contact with employees. So in total, these are 15 benefits of small-scale industries. To close this lesson, I will leave you with one assignment. Elaborate on the benefits of small-scale industries in developing countries. That is your assignment. When doing the assignment, ensure that you don't refer to the notes. Try and actively recall what you have learned in today's lesson. Thank you. God bless you. Let's hope to meet in our next session, where we'll proceed with the topic agriculture and industry. In our next session, we are going to study the obstacles of industrial development in developing countries. Bye-bye.
Hello Lana, welcome to Manifested E-Learning platform. My name is Emily Ngwiri, and today, ladies and gentlemen, we are discussing business and data analytics. The focus is on December 2022, question 24. The question reads as follows. Bermuda Limited has presented the following information for the purpose of preparing a statement of cash flows. So you are provided with an extract of the statement of profit and loss for the year ended June 2022 with the following subheadings: the revenue, the cost of sales, the gross profit, gain on financial asset at fair value, the investment income. Then you're also provided with the expenses, other expenses, administration expenses, distribution costs, finance cost, profit before tax, income tax expense, profit for the year. You're also given an extract of the statement of financial position, the assets being as follows: the non-current assets, property, plant and equipment, PPE, intangible assets, financial assets at OCI, then the current assets, inventory given as trade receivables, financial asset at fair value, cash and cash equivalents. You're given the total assets. You're given now the section that relates to equity and liabilities, ordinary share capital, 10 each, share premium, revaluation reserve, financial asset at OCI, that is the equity reserve, the retained earnings, the retained profit. You're given the non-current assets, 10% convertible loan stock. The current liabilities are given bank overdraft, the trade payables, the interest payable, income tax expense, total liabilities, and you're given the total capital and liabilities, or total equity and liabilities. Additional information. Number 1, property, plant and equipment. The property, plant and equipment of PPE held by Bermuda Limited are items of plant and equipment and freehold premises. During the year ended 30th June 2022, items of plant and equipment which originally cost 40 million shillings were disposed of, resulting in loss of 6 million charged in administrative expenses. These items had a net book value of 28 million as at the date of disposal. Number 2, depreciation charge for the year was 43 million. Number 3, 50 million shillings of convertible loan stock were converted to 50 million ordinary share capital at par. You are required to prepare statement of cash flows for Bermuda Limited for the year ended 30th June 2022 as per IAS 7 cash flow statement. So I'll be able to just walk you through the steps, the requisite steps that are going to enable us achieve our objective of the cash flow statement. But as you can see over here, the word stock wasn't written properly over here, so we just make a small adjustment over here. Stock, sorry, that's in caps. Stock were converted to 50 million ordinary shares per share capital there. So we've adjusted that, and we can begin with our solution, which is on the right of your screen. So the first step, ladies and gentlemen, is to compute or have some side workings based on the financial asset at fair valuation. So we are going to have items listed, and then you'll be able to now have the changes being the description of the figures being given on this. So we'll first of all begin with balance brought forward. So brought forward, CF, like that. So we begin with financial asset at fair value, right over here. So financial asset at fair value, that. So don't worry even if it crosses like that. So I'll just double click right here, and it will be able to give us a space over here. If you prefer it not to have any space over here, you just delete that space like that, so that you can be able to have the values close to the narrative over here. So we can pick over here, or we can be able to also insert over here, because we're dealing with shillings. An accountant is supposed to have at least proper values given properly over here in terms of the given currencies, so shillings, and also in terms of thousands, millions, billions. So we need to provide that for completeness sake. So shillings, and we are saying that it is in millions. So we can put M like that. You can see it's over here, shillings in millions over here. So we need to honestly do the same over here. Shillings, caps, millions, like that. So we put it in small letters like that for consistency. That bring it close to each other over here, or we can just decide we just delete that and then plus that there, and it will just pick, and we drag that. Remember that plus sign, guys, it has to be plus like that, not plus like this. It has to be plus like that, black. You just drag it like that. So financial asset at fair value, we can pick these values that have been given from the balance sheet over there. So we can check from the statement of financial position right over here, financial asset at fair value. We can see over here financial asset, as we just scroll down over here, 1 second. That means that we need to actually get it from the balance sheet right there. So just 1 second as I try and trace it over here. Oh, it's actually under current assets. I hadn't seen it. I was just really trying to take my time. So it's under current assets over here. Financial asset is right here. Yes, you can see it. You can see here. So we are going to indicate the values there. So balance brought forward, we have 30 over here. So we pick it because we are using Excel plus. We do not want to cook and just put our figures over here, because I can decide over here to put 30 over there like that, and then we can be able to also put over here as 65, because we've seen right over here current assets, this one, financial asset at fair value right over here. If it allow me to maybe just highlight it like that, I can decide to put 30 and 65 based on the figures, but because we are accountants, we need to properly relate or link the value. So plus, so you can put over here that one, enter, and then plus 65 there, enter that. So once we've done that, then we can be able to now proceed on to now incorporate the changes due to fair value gain over there. So changes due to fair value gain over there. And why we are creating a space over here is because we want to also include it in terms of millions. So there's no need for us to actually indicate over here that it's millions, because going down over here is in millions. So we just copy this, just put them down there like that in millions. So as you can see, if you don't copy them properly, copy, paste special, guys. And what do you want to paste? You want to paste just the way the values are like that, or do you want to complete the formulas? We want to the format over here, or do you want to keep source formatting so it give you like that? So we are interested in the values. You can see over here values there. So interested in the values, let it stay like that. So the changes due to fair value gain are given to us over here. You can check from the income statement or the balance sheet over there, changes due to fair value gain. You can see it here, actually. It's given to us over here, highlighted there. It's 5. Right? So we put it as negative value there. We are following based on this statement over here, IAS 7 cash flow statement. So we are picking the value of 5 over here, and that is gotten from the revenue, from the income statement here. So plus, minus, because we want it as a negative value, that one there, put there, 5. Then cash and cash equivalents. And cash equivalents. So cash and cash equivalents, where do we get the values for cash and cash equivalents? From the balance sheet over here. So cash and cash equivalents, you can see them right over here, cash and cash equivalents right here. So we pick which one? We pick the most recent value. For 2022, we pick the 29 right over here. So you can pick that value there. If you allow me to use red to highlight that. So we pick the 29. So plus, so we go on to the balance sheet and pick the 29 right there. Enter. Here, we're going to put a 00 value. So 0. It means like that. Next, we're going to pick the bank overdraft. So bank overdraft. That. So pick the bank overdraft. We're going to pick it from the statement of financial position. So we just try and see from right over here, the bank overdraft. That should be current liabilities. You can see 22 over here. So we're picking 22, and that is what we're going to pick, 22 plus 22 right here. Bank overdraft is here. So once we pick that, for this other year over here, carried forward. So this has been brought forward from the previous year, because you're seeing, ladies and gentlemen, over here, the 22 bank overdraft here was from the previous year, 2021. So it has been brought forward to 2022. So I need to highlight that in red there. It's been brought forward. Then we now get the totals right there. So the total from the beginning is going to be plus sum. You can see sum over there. It's going to add from here, moving down. close the bracket, 60. What I did was I put the cash equivalents. Remember what I did to the cash equivalents? I picked 29 over here, but the way I put it, or I put it as if it was 2021. So I should have put it on this other further end over here, because that would mix things up over here. So I just pick this over here like that. I just wait for the plus sign, not that plus sign. I'm looking for this sign that appears to black. I just put 29 right there like that, and here 0. I hope you've understood that. I can really explain it. So this one is going to be 2021. Allow me to put 2021 so that I cannot be able to mix myself up. 2022 like that. I think that seems to be better. Or I can be able just to insert this moving down. Down. You can see down, the option down, it gives me down like that. And this one should also move down. Cut. Control V. 2021, 2022. So bold. So if this is 2022, we got 29, and that's where we put the 2029 over here. It is 22 over there. Remember the 65 over here, financial asset fair value, 65, we put it under 2022. So it was me who did an error. Apologies for that. So the bank overdraft over here changes the cash and cash equivalents is that the bank overdraft is given to us there. The bank overdraft should be 22, and here we are saying it should not be the sum. Here should be 00, because we're saying the bank overdraft for 2021 was 22, and which we've gotten right over here, 22. You can see the 22 relates to the year 2021. Right above over here, so that is 0. So now we're going to get the totals over here. Total. So this should be bolded. That, and we can say we're just going to get plus sum to give you a prompt. You click the first one, not sum if. That we go from there to down over there, and then we close the bracket. Enter. We get that as the total. We can drag this. We don't have to now do the same, because once we put the formula over here, we just drag it moving backwards like that. So this bank overdraft, ladies and gentlemen, should it be positive or negative? A bank overdraft should indicate that we owe individuals. So it should be plus minus like that. So plus minus. So this should be a negative value. So we can now do the format, yeah, like that. So we just put formatting. We click on this one that has got brackets like this if you want this to be in brackets, and then you select format painter. That this is now, of course, just presentation and all. We don't have to underline this over here. We just remove the underline there. So this one is negative, that's negative. So negative and so on and so forth. So once we have that, we can then move on to get workings on purchase of PPE. So purchase of PPE, put workings on purchase of PPE. So workings, purchase of capital, PPE, property, plant and equipment. So we'll still go by this, will be our guide, 2021 and 2022. So we begin by analyzing the balance at the beginning of PPE. Working, spelling. Working, I-N-G, working of purchase property PPE. So you can put that as bold. So our first talking point over here is the balance at the beginning. The beginning. Balance at the beginning, we're dealing with 2022. So the balance at the beginning, we should be able to get from the balance sheet. You can see this is the 264. It was balance at the beginning. over here. So we select plus that value. Why are we putting it under 2022? We're putting it under 2022 because the closing balance over here, over here becomes the opening balance in this year. So balance at the beginning of 2022 was that one. Place it down over here because we're not dealing with the working, it's down over here. Then we move ahead and assess the loss, revaluation loss, if there was any loss. Revaluation loss. Loss. So we are not interested in giving it whether it's bolded. That. So the revaluation loss would mean that we'd have to go to the balance sheet. So we just get the statement of the equity and liabilities section because we have the revaluation reserve here. So for us to get the revaluation loss, we'll have to get the difference between this one and that value there. So it begins by getting, we begin by getting the 2022 value over here, 67 minus the 36 over there. So plus, move up over here, plus 67. We are not going to put the figures. I'm just going to go over here, 67, because you're dealing with revaluation reserve, minus 36. Click there. That. Get 31. And so we need to highlight that, revaluation reserve. The permission. I hope it's not too bright, guys. So once we've done the revaluation loss, the difference, the revaluation reserves is amount of money that is kept in a revaluation account, so that if you want to finance any future expansion, or you want to maybe issue additional shares, then you can be able to do so using, of course, resources from this revaluation reserve. So that's revaluation loss. Once we have that, we move on to get the net book value on disposal. Net book value on disposal. Value on disposal. So the net book value on disposal we get it from the balance sheet. So the net book value on disposal, we should be able to try and get it from over here, from the balance sheet over here. Net book value on disposal, we can see it under the additional information. Property, plant and equipment. This is information that relates to PPE. PPE, property, plant and equipment, held by Bermuda Limited are items of property and equipment and freehold premises. During the year ended 30th June 2022, items of plant and equipment which originally cost at 40 million were disposed of, resulting in a loss of 6 million charged in administrative expenses. These items had a net book value of 28 million. So this is the 28 million that we're going to use over here. We're going to use it as a negative value. So negative. So I cannot be able to use it directly over here because it's in continuous prose over here. So just allow me to use it to hard code it and key it in like that. So we need it to be similar format there as this one here. Then we assess depreciation. Depreciation. So depreciation, we can be able to get it. Let's check the additional information over here. Number 2, depreciation charge for the year was 43 million. So depreciation, we include the 43 million as a negative value. Like that. So we just use format painter. Let's move along. So once we've done that, this also needs to be a negative because we're talking about a revaluation loss. So revaluation losses are given negative values, or is represented as a negative value. So you put negative there, then we open the bracket there like that and close the bracket there like that. So it gives us minus 31. So format painter again like that. Once we've done depreciation, we need then to get the purchase of new asset over here. So purchase of new asset of new asset over here. So we don't have the value of the purchase of the new asset over here, but we already know what the balance of the PPE is. So the balance of PPE, or balance of property, plant and equipment. Yeah, pardon me for that. Balance of PPE. So the balance of PPE, with your permission, I'll just bold it like that. Or if I bold it, it would mean that it is a subheading over here. So let me not, let me just undo that. So this value over here, I can put the totals as like so, double underline like that. You can also do that for these values here. So you double underline that to represent that those are totals. Will be the balance of PPE over here. So the ending balance of PPE, we can be able to see clearly it's right over here. So plus that value there. The purchase of new asset would be the difference between 327 and these totals over here. So I'll insert a formula over here, plus 327 minus, open the brackets, the sum of the beginning balance at the beginning through to depreciation there. Sum there like that, put it like that, then we close the brackets and we say, okay, there's another bracket that I need to close because we're saying we have two brackets. So there's this opening bracket, so there are two brackets that need to close like that. And those are just function arguments, 165. So this should be the purchase of the new asset there. We need to have these workings over here because these workings will be contributory towards the preparation of the statement of cash flows based on IAS 7. So once we've done the working of purchase of PPE, we move ahead and now analyze the share capital component, which represents the final working before we prepare the final statement of cash flows. So we can say here, balance at the beginning. So I skip over here. So balance at the beginning. Balance at the beginning. What are we talking about balance at the beginning? We're talking about share capital over here. So share capital, pardon me. Once we have share capital over here, what are we talking about? We're talking about millions. So we just copy these values, copy. And what did we say above there? Paste special. If you paste, ladies and gentlemen, let's just do what we did. It will not give you exactly what you want. So we just come and undo like that, paste special. Paste special, and we want values. It gives you that. So then you can escape like that. Now we can say share capital relates to that part there. And you're also talking about share premium, if any, share premium. Over here. And then we have now the total value right here. Total value given to us there. And these are in millions. So we just do the same right here, are in millions. So what is the balance at the beginning right there? So the balance at the beginning given to us there is, let's see, down here. We can just come, we can see note number 3. Shillings 50 million of convertible loan stock were converted to 50 million ordinary share capital at par. So that does not relate to that. Pardon me for that. I'm just trying to. This is the part over here that I'm talking about. Balance at the beginning. Well, this is convertible loan stock. That should not be the one over here. Just a second. This is the part that relates to share capital over here. Balance at the, yes, it's right here. It's this 150 here. Balance at the beginning, the 150. So we pick balance at the beginning share capital, 150, but we do not do that. Pick plus the 150. I just seen it just now. We pick that. Enter. Then there is nothing to do with share premium. 0. Then the total should be given as plus that value there. Enter. Then we talk about conversion of loan stock. Conversion of loan stock. Spelling conversion. Loan stock. We have some information given to us there at the additional information. That is what I had initially read, thinking that that was the beginning, balance at the beginning. So 50 million convertible loan stock were converted to 50 million ordinary shares. So conversion of loan stock, how much? Just put 50 there plus 50. So the 50 does not represent any figure, it's continuous prose, so we just put 50. That. Do we have share premium for that? Nope. So put 0 there, and then we just drag the formula here. Remember that plus sign? We drag it like that. Conversion of loan stock, after that, we try and assess the changes over here, changes. Over here, so we put 2 lines that go like so. So we come over here. So we try and assess the bottom border, and you can be able to put the top border like that. What is the effect? It gives us just that line like that. So the changes is plus that one plus that one. We get 200. And we just drag the formula like that. So it will always speak like that. So we just drag it like that. Here there is nothing. So you can be able to just put the comma format, come to comma, or we can be able to, you press Alt H. Now the comma format, you can see K, where the comma is, K. So what happens is that it puts dashes like that for items that don't exist there. So here we just put the same, the comma format, just click it like that, just for presentations purposes. So once we have that, then we can proceed on to identify the ending balances. Ending balance. There. So the ending balance, right over here, we assess the ending balances right over here from the expenses. You can see them here. The 230 was the current, is the most recent over here. So we pick plus, go all the way here, like that, down. 230. Enter. Once we pick the 230, the share premium, was there anything to do with share premium? You can see just beside it, right here. So plus, just come down here, share premium, enter. It didn't pick, so plus, I think it didn't pick, can just come directly there, enter. And then we get the total over here. So remember, the total will be given based on whatever I've already calculated, but not in this format over here above, but we're saying, but it will just be plus that value. So that will be the ending balance. So what is the increase due to the new issue? Increase due to the new, of course, the new conversion of loan stock, the new issue. Over there, we can see we'll just subtract upwards. So plus that value minus 200. Enter. Here we just pick the formulas right here, that plus sign like that. 60. So that is the increase due to the new issue over there. Now, ladies and gentlemen, the moment of truth has arrived. We now prepare a statement of cash flows based on IAS 7. So with your permission, once we have these values over here, I can just start over here, scroll down here. Cash flows from operating activities. From operating activities. I'll bolden that. So we are interested in the statement of cash flows. So it's always good to write statement of cash flows for the year ended 30th June 2022 before we just go directly to write the cash flow from operating activities. Prudent as an accountant. So Bermuda Limited statement of cash flows, for the year ended 30th June 2022. That. So maybe you could decide to merge the cells so that now, at least for presentation purposes, so you come over here, merge cells, merge and center. So that now it can indicate that now it's the entire, whatever side workings we have over here, at least it relates to Bermuda Limited. So cash flow from operating activities. We can be able to put now shillings, millions over here. So similar format over here. You can just do it something like this. Copy, paste special, values. There. So we start off based on IAS 7, profit before tax. So profit before tax, we pick it plus this one. You can see it over here. This is the value over here. We're talking about statement of profit and loss. It's 114. So we pick that, enter, and then we proceed on to do the adjustments for non-cash incomes and expenses.
Welcome to Manifested Publishers.
We can be able to move on towards the right of the screen. I had initially mentioned we'd move down, but because we already have the formulas working down, we can be able to just move on towards the right here. We copy the pessimistic case, right over here, pessimistic case. pessimistic case, and of course because it's capitalized, so pessimistic. That. For consistency, just pick that. Format painter, you can see format painter. Also good for presentation. We copy the years 2020 to 2022, like that. Because we're talking about the forecast period for the pessimistic case is going to be different from the base case. Copy. We can, right there, Control V. So we move towards the right, and one of the skills that you should also do or know is that we can be able to just hide this part here. Question is, will we be able to use all of this? We need them over here. So what I can do first of all, guys, before I hide, is to first of all pick these values over here. I'll just copy this, cut this, paste it right over here. Control V. So it moves towards the right. Now, if you allow me, I can pick right over here, up to that point, hide. How do you hide? You can, or you can be able to even group it. You can either right click and hide. You can see hide. It will hide. But we are accountants and we are experts like that. What we are saying is that we need to just put groups. So you come to data, then you group. Just click group. It will create this kind of thing. So you just click on this and it will just hide the data like that. If you want to unhide the data, you just click the plus. You open it up like that. That's what true accountants are actually supposed to do. So let's use the grouping outline. Now we come to pessimistic case. The reason for doing that is so that I can be able to look at the question and adjust them based on the inputs that, or these assumptions which have actually been provided right over here. So in a similar fashion, we forecast these values here, and we've already done that. So I ungroup this and allow me to pick these forecast values here like that. Copy. I press it back there. Control V. That. Now let's see how it actually changes the pessimistic case. We start all over again. I can put a white background home so that we can highlight as we make the changes. No fill, like that. Now we are doing the pessimistic case, guys, so please pay attention. Revenue growth rates are forecast under 3 scenarios, namely base case, optimistic case, and pessimistic case. The base case growth rate is the first year forecast in year 2022 CAGR. This is expected to reduce by 2% annually until the last year of the forecast, subject to a minimum of 15%. The optimistic case is 20% above the base case, while the pessimistic case is 10% below the base case in all forecast periods. So 10%. So what are you saying? 2022 CAGR over here. You can see in section, I can come down over here, 2022, the CAGR is down over here. You can see it right here. So we are saying what? We are saying that we are going to increase our revenue by, for the pessimistic case, is going to be 10% below the base case. So we are saying that even if the CAGR is increasing by 21%, the pessimistic case is going to be below by 10%. So we can come and say, right over here, the revenues, like in the pessimistic case, so you can click right over here, you can see is 115. So we are increasing this from the previous value, this one multiplied by 1 plus the growth rate which was there in M21A over there. And then once we have that, it's going to reduce by, it's going to be reduce yes, by 2%, but it's going to be 10%. So pessimistic case, what we can do, we can just pick plus this value times, open the brackets, so 10%, 1 minus 10%, close the brackets like that, and you enter. We are accountants, analysts, we need to highlight that, put a bracket for consistency. Then we are saying that that is for pessimistic case because it's 10% below. And if that's the case for 2023, like that, then you are saying it's going to reduce by 2%, like that. So even if we were to decide to go this other direction, guys, like that, if you're able to go like this, plus that value times, we go to question 21A, this one times 1 minus, we're saying 10%, 10%, it gives us 18, but perhaps the formula should be delete that. No, it's not giving us that value, correct value, so pardon me for that. Let me just undo that. We are saying that it should be able to go down by 20, so 21%, it should reduce by 10%. So we delete here. We are saying this 21% of ours should reduce by 10%. So plus that one times, open the brackets, 1 minus 10%. Then we close the brackets. Comes to 18.8%. Put percentage like that. This is pessimistic case. Pessimistic. That 19%. Then what do we do after that? We come over to the second tab, tab 21B, you can see here, and we feed in the formula plus that sales, we multiply into brackets 1 plus this pessimistic rate over here, like that. Then we close the brackets like that and you press enter. So you can see it comes to 113. Because it is like the worst case scenario, we are saying compare that value or this 113 value over here, which you can put in a different color like that, with the one under the base case. Under the base case, you can see is 115 over here. So you put the same color like that. So you can see this is 115 base case, and this we're saying is pessimistic case or the worst case. It comes down like that. So I just undo like that, and then I proceed on. So once we have that, we come back now to what the question was actually saying. So the revenue growth rates, so the pessimistic case, optimistic case is 20% above the base case, while the pessimistic case is 10% below the base case in all forecast periods there. So we then reduce, this is expected to reduce by 2% annually until the last year of forecast subject to a minimum of 15%. So that is the limiting factor. That is the limiting factor over here. So plus this one times, open the brackets, and we need the rates over here first of all, sorry. So we come back to 21A over here, 19. So we pick pessimistic case plus that value minus 2%. We get 16.87, but now we are saying we want it to be consistent like that. We want to reduce the percentages to be only with no decimal places, so it's 17%. then plus that one times, we're reducing it by 2%. Remember what we did over here, minus 2%. So plus that one minus 2%, like that. We're saying we're getting 14.87. So because 14.87 is less than 15%, so we're saying the constraint is 15%. So this is 2023, 2024, 2025 should be 15%. So we're saying that now this is our 2023 value, 2024, 2025, and right over there. But 2025 should be 15%. Remember from the question, let me come to tab 21B right here. The question was saying subject to a minimum. You can see it over here. Subject to a minimum right over here of 15%. Subject to a minimum of 15%. So what does this mean? We are saying that we can come over to this other side over here as we try and populate this part. So we're saying it's plus that value times, shift, open the brackets, 1 plus for 2024. So we come back to 2024, we're saying it's 17%. That, we close the bracket, enter. Then these others will be 15%, 15%, 15% over here. So plus that value times, open the brackets, 1 plus 15%. 15%. That is the maximum, or the minimum we cannot go beyond that, beyond that value. We do the same, plus that one times, open the brackets, 1 plus 15%. We close the bracket, enter that. Then we can be able just to, even if we drag that, it will be able to pick like that. It's that value like that. So I was just doing it slowly so that we can be able to just see the values there. The cost of sales, we've been given the gross profit margin. What have we been told in the gross profit margin in the question? Right here you can see the gross profit margin. Let me just put it in beige, somewhat color like that. The gross profit margin for the first year forecast is the 3-year average for the period 2020 to 2022. So this is expected to reduce by 2% annually until the last year of forecast, subject to a minimum of 50%. So what is the gross profit margin? So I can come over here, move towards the right, and we reduce this base case scenario here. How did we do the gross profit margin? The gross profit margin is gross profit over sales. So the gross profit over sales, this one we had already done it like that based on 2020 values. So you can see, even if you're to pick this value over here, or we pick, let's say 2020, you can just decide to pick it over here, plus gross profit, which is over here, gross profit divided by sales, like that. It's 0.5. So for consistency's sake, we do the same right over here, 50%. And it applies all through until 2022. So we're saying that as far as gross profit margin is concerned, we are expected to apply these same rates that we have right above over here. So I can comfortably delete this one over here like that. I delete and say that now for me to be able to get the gross profit, I'll just get, you can see the gross profit right over here. You just multiply gross profit margin times the sales. So gross profit, so I get plus gross profit margin, 57%, multiplied by the sales. There, I get it like that, 64. So I drag the formula like that and it picks. So for us to get the cost of sales, we just get plus 113, but because it is minus, we open the brackets, you can see on the formula bar right over here, we just delete that, say is equals to minus that value minus that value there. We close the bracket, say enter. And we drag this towards, pardon me, undo. So plus or is equals to minus, open the brackets, 113 minus 64, close the brackets, enter 4, then we drag the formula until we get the plus sign like that. We drag the formula like that, then we put it in terms of the format, just put it like that. So we can try and check plus that plus the cost of sales, we're getting 64,381 to 12.29. So we can just, you know, put it like that, and you can see we've gotten the correct answers like that. So we delete operating expenses. We go back to the question, right down here, highlight in peach. Operating expense ratio are modeled as the 3-year averages from period 2020 to 2022. These are assumed to remain constant over the forecast period. So what are we saying? We are saying that the expense ratio will also apply across. You can see the expense ratio just down here. So we pick, for us to be able to compute the operating expenses, because you've already done that in first part here. The operating expenses is just the sales times the expense ratio. So for us to get this, it is just plus the sales times the expense ratio. The expense ratio is right over here. Enter. But remember, it is negative. So we put a minus there and we open the brackets like that. Picks negative. And we just drag it, formula, like that, and it picks. Do the same thing as we've done above, format, that it picks the same format. How about operating profit? Let's see what the question is saying about operating profit. There's nothing about operating profit. It's a formula. So it's only operating expenses was there. So plus, it should be the same, plus that, you should get 42. Drag it like that. Let's see what they say about depreciation. Yes, there's something on depreciation. It's right there. Depreciation to revenue ratio is assumed to remain constant as the 3-year average for period 2020 to 2022. So we apply the same formula we've done just over here. You can see it right here. For us to be able to get the depreciation value, sales times depreciation ratio. So we come back towards the right over here, pick like that, time plus sales times depreciation ratio for 2023. Is that correct? Yes. Enter. And that's it. We drag it. That. It picks. But you can see clearly it's not the same format as this other one. So you do the same thing. Minus, open the brackets, close the brackets, enter. And then now we can redrag it again. Just drag it like that. It picks the negative sign, format, just do it like that, and that's it. Then we can just say profit before tax plus that. And of course, because this also requires the formula, you can see it will not change anything. But the format will change. So let's just undo that. We ensure that the format is the same as the previous income statement. So we just copy it like that, and that's it. What are they saying about finance costs? The finance costs down here, the finance costs are expected to reduce steadily as the loans are repaid. Use the reduction rate 2022 over the forecast. So you can see here reduction rate is 1,000 based on the base case, like that. Let's see how much it's reducing by in this case over here. It's reducing by still 1,000, 1,000, 1,000 like that. So how do we fill it? We just say plus this one plus that, so that we can be able to get 7,000. And we just apply it across. Format painter, to the same there. Profit before tax plus that plus this value. And we drag that. How about the income tax expense? Let's move over to the right, to the left rather. Finance cost we've just done. Let's go to income tax. Is calculated as the historical effective tax rate. Put it as pitch, because we are saying it's just going to be plus that value times the 30% 2023 value there. That's it. Because it's negative, do the same thing. Negative, open the brackets, put it in brackets, like so. So you come over there and just drag it like that. We drag the formula as we move across like that, and then we get the final profit after tax. Plus that, enter. That's the final value that we have. So you can compare. You can see in the year 2023-7 forecast, we are getting 40,000 as the profit after tax in the pessimistic case. How about the base case? Let's remove this plus sign over here, the base case. We are getting 42,694 because it should be higher than this case over here, which you're saying is pessimistic case. So let's now put the format, we just put the paint, or rather the format, we try and format this whole part like that. And that's what we've done. That. So once we have that, we can then just move ahead to the base, to the optimistic case.
Welcome to Manifested Publishers.
Hi candidate, welcome to another session of Manifested Online Classes. So in this session, I want us to continue with the topic for group accounts. So in our first class, or in our first lesson, as far as this topic of group accounts is concerned, we introduced or we defined what are group accounts. We defined some few terms like what is a group of companies, what is a parent company, what is a subsidiary, what is a business combination. And also we looked on the various accounting standards which are applied by the parent company in preparing the group accounts. And then further we went ahead to look on how we determine the goodwill arising from the business combination. And also we have looked on how we deal with the various forms of purchase consideration. So in this session, I want us to continue with the same topic of group account by looking on how we prepare the consolidated financial statement, specifically whereby the parent company has invested in a subsidiary. So you have to remember that a subsidiary is an entity over which the parent company has acquired a control. That is the first thing you have to remember here, that a subsidiary company is an entity which the parent company is the entity which the parent company has acquired a control. So in this case, we have said a control means that the parent company is having a control over the operating and financial decisions made by the subsidiary, or the parent company is in a position to control the composition of the board of directors of the subsidiary. If the parent company is the one which appoint majority of the directors in the subsidiary, the parent company is having what? A control. So therefore, in identifying the control, there are a number of things which you check and which you may be given even in an exam. You check whether a company, or basically you check the percentage shareholding. The percentage what? Shareholding. And if you are told a company has acquired shares which lies between 51% to 100%, it means that that company has then acquired what? A control. Equally, when checking the control, you may be given some other information by the examiner whereby you are told the parent company appoint majority of directors, or majority of the senior managers, senior managers in the subsidiary. So if you're given third information that it is a parent company which appoint majority of the directors or senior manager, even if the parent company shareholding do not exceed 50%, equally we say that the parent company has acquired what? A control. And therefore, a parent company having or which has acquired a subsidiary, this company, we have said, at the end of the year is required to prepare now the group account. The group account or the consolidated financial statements are prepared by which company? By the parent company. And what now this standard IFRS 10 has done is to establish the principles and also the rules to be followed by the parent company in preparing what we refer as the group account. So therefore, what we need to do first of all, let's look on the consolidation procedures. Consolidation procedures are the steps which the parent company should follow to successfully prepare the group accounts. So we have consolidation procedures. Consolidation procedures. Number one is that if you come across a question and you're told the parent company acquired a subsidiary, and then the examiner is requiring you to do what? To prepare the group account. So which procedures do you need to follow? Number one, you need to come up with a group structure. You need to come up with a group structure. A group structure, we can say, is a chart which will be showing the parent company shareholding in the subsidiary and also the date of acquisition. Like maybe let's assume you're told A Limited acquired 80% of the ordinary shares issued by B Limited on 1st of January 2023. So this is now what we refer as a group structure, because from this group structure you can see A Limited will be the parent company, whereas B Limited is a subsidiary. And also from this group structure, we can be able to say that the remaining 20% of the shares issued by B Limited, these shares are held by the minority shareholders. So that is the first thing. Come up with a group structure. Number two, you then need to consider the consolidation adjustment. The consolidation adjustments. Consider consolidation adjustments. Consider the consolidation adjustments. So when talk about the consolidation adjustments, these are the adjustments which are made when preparing the consolidated financial statement. There is something which I think I've forgotten to mention here, that whenever the parent company has invested in a subsidiary, we have said it is a parent company which prepare the group account. And according to this standard, that is IFRS 10, the parent company prepare the group account on something known as the line by line basis. The group accounts are prepared on line by line basis, meaning that the parent company prepare the group account by adding similar items of assets, liabilities, revenue and expenses, those of the parent company and those of the subsidiary company. This is very, very important, that the group accounts are prepared by the parent company by or on something called line by line basis, whereby the parent company prepare the group account by combining, by adding similar items of what? Of asset, liabilities, revenue, and expenses, those of the parent and those of the subsidiary. Therefore, what you are saying, for you to successfully prepare the group account, in any question for group account, the first thing you need to do in such a question is to do what? You need to come up with what? With the group structure. And then once you have that group structure, number two, you need to consider the consolidation adjustment. The consolidation adjustment, these are the adjustments which are made when preparing the group account to the various items of asset, liabilities, revenue, and expenses. Once you have added similar items of asset, liabilities, revenue, and expenses, those of the parent and those of the subsidiary, which adjustment should be made to those particular what? Items. And those adjustment is what you're referring to as what? The consolidation adjustment. So we're going to look on or to discuss on those consolidation adjustment, which include adjustment in relation to intercompany debts, intercompany debts, or intercompany owings. Number two, we have adjustment in relation to an realized profit on inventory, and raised profit on inventory. We also have another consolidation adjustment relating to fair value adjustments. Fair value adjustments. The other one is intra-group sale. Intra-group sale of an item of non-current asset, into a group sale of an item of non-current asset. So this is basically what you need to consider. You need to determine which items of asset, liabilities, revenue, and expenses need to be to be adjusted when preparing the consolidated financial statement. Remember, specifically these are the consolidation adjustments for preparing the consolidated statement of financial position. We are saying come up with a group structure, determine which items of or determine which adjustment will need to be made as far as the various items of asset and liabilities are concerned. And then from there, step number 3, you proceed and you add similar items of assets and liabilities, similar items of asset and liabilities, those of the parent and those of the subsidiary. Remember, these are procedures for preparing consolidated statement of financial position. Add similar items of asset and liabilities, those of the parent and those of the subsidiary. Basically, what that means is that similar items of equity, similar items of equity, those of the parent and those of the subsidiary are not combined. Similar items of equity are not what? Combined. Are not combined. They are not added together. So what we only combine, what we only add together are similar items of asset and liabilities, those of the parent and those of the subsidiary. And then the other step is, that is step number 4, is that you also need to compute something called the group retained earnings. The group retained earnings. Group retained earnings and the non-controlling interest. Non-controlling interest. The group retained earnings and the non-controlling interest. So we're going to look on how we compute those two items. Specifically when looking on an illustration question. When looking on an illustration question, I'll be able to illustrate how we compute the group retained earnings and also the non-controlling interest. The non-controlling what? Interest. So therefore, if you come across a question in an exam setup, you're required to prepare consolidated statement of financial position whereby the parent company has invested in a subsidiary. One, we are saying you prepare that on line by line basis. You have to add similar items of what? Asset and liabilities. But in this case, we have said don't add together similar items of equity, ordinary share capital, and reserves. So, but for you to successfully prepare that consolidated statement of financial position, these are the procedures. 1, you have to come up with a group structure. Number 2, you consider the consolidation adjustment which you need to make to the various items of asset and liabilities. And number 3, you combine, you add similar items of asset and liabilities, and then you compute the group retained earnings and also what? The non-controlling interest. So I want us to discuss on in details regarding these consolidation adjustments. So let's look on the consolidation adjustments. Consolidation adjustments. Consolidation adjustments. So what are consolidation adjustments? We have said that anytime as an accountant you are preparing the financial statements, there are those adjustments which you need to make to various items of asset and liabilities recorded in the statement of financial position. But specifically, when the consolidated statement of financial position is prepared, there are those consolidation adjustments which are made. Majorly, there are four of them, and I've highlighted them here. So let's start with the first one here. Number 1, we have the adjustment in relation to intercompany debt, or in other terms, intercompany owings. Intercompany debt or intercompany owing. When talk about intercompany debt or intercompany owing, this is any amount of a debt between the parent company and the subsidiary. The parent company and the subsidiary. Maybe the parent company owes the subsidiary a certain amount of money, or the subsidiary owes the parent a certain amount of money. And this one arises due to what we refer as sales between the group members. Anytime we have sales between the group members, that will give rise now to amount of intercompany debt. So therefore, maybe first of all, we can say that this arises due to this arises due to intragroup trading. Intragroup trading. Intragroup trading is where we have sales between the group members. For example, in this case, we may be told that the parent company sold or made some sales to the subsidiary, and then we are told that, or we are told the goods which were sold by the parent to the subsidiary had a value of 20 million. So, and equally, we assume that we are told that the subsidiary company had not paid for those goods, goods. So, it means that in the books of account of this company, basically the subsidiary company will be owing the parent company an amount of what? 20 million. So the amount to be paid by the subsidiary company to the parent, that will be part of the trade payables. In the books of account of the subsidiary, the 20 million will be included as part of the trade payables, whereas in the books of account of this company, that is the subsidiary company, the amount of money, 20 million, it expects to receive from the subsidiary will be appearing as part of its what? As part of its trade receivables. There is something equally which I've mentioned here. For the purpose of preparing the group account, these two companies within a group, the parent company and its subsidiary, are actually viewed to be one and the same entity. And this is also something which you have covered in company law, whereby you are told that one of the circumstances whereby the veil of incorporation, the separate legal personality of the company may be ignored, is when we have a group of companies. So whenever you have a group of company, a parent and the subsidiary, for the purpose of preparing the group account, then the two companies are viewed to be one and the same. And therefore, this amount of intercompany debt then should be eliminated from the consolidated statement of financial position, simply because the parent and the subsidiary, we are saying, are viewed to be one and the same what? Entity. So how do we eliminate this from the group account? So this particular amount of intercompany debt, we say it should be eliminated. The amount of intercompany debt should be eliminated. From the group trade receivables, and group trade payables, So what do you mean by that? When preparing the consolidated statement of financial position, we know that trade receivables is part of the current asset. So when recording the current asset in the consolidated statement of financial position, we take the trade receivables of the parent plus the trade receivables of the subsidiary. In this case, we are saying eliminate any amount of intercompany debt. So because this company is expecting to receive 20 million from the subsidiary, you eliminate that here. You eliminate 20 million. Equally, when recording the current liabilities, trade payables is part of the current liabilities. Take the trade payables of the parent plus that of the subsidiary, and equally you eliminate 20 million, which is included in the trade payables of the subsidiary as the amount of money the subsidiary should pay to the parent. Should pay to what? To the parent. That's why we are saying any amount of intercompany debt, eliminate that from the group trade receivables and also from the group trade what? Payables. Now, that is the adjustment now which is we make in the event the amount of intercompany debt is the same. But there are some cases whereby the amount of intercompany debt will not be the same. So let's look on how do we deal with or how do we adjust, or how do we deal with the amount of intercompany debt is not, which is not the same, So we can say we can have a note here. We say that if amount of intercompany debt is not the same, the difference is a cash in transit. The difference is cash in transit, abbreviated as a CIT. So what do you mean by the cash in transit? The cash in transit. What do you mean by the cash in transit? Let's assume that we are told that the subsidiary company, using this illustration, the subsidiary company or the parent 20 million, but when the year was coming to an end, the subsidiary company sent a check of 10 million. Or maybe let's assume we are told it sent a check of 15 million. So the check which was sent by the subsidiary in order to pay for this amount was 15 million. But because this particular check was sent by the subsidiary when the year was coming to an end, then the parent company, when closing its books of account, the parent company had not received and accounted for that check. Check. So that particular check which has been sent by the subsidiary, not yet received and accounted for by the parent, we refer to that as cash in what? Transit. Cash in what? Transit. So this will be a cash in what? In transit. And because this company has already made a payment of 15 million, so the balance which is appearing in its books of account as the amount of money it owed to the parent is no longer 20, but it's how much? 5 million. 5 million. It has already, out of 20, it has paid 15. The amount of money appearing in its books of account as the amount it owed to the parent is 5. Now this company is yet to receive that check. So the amount of money it is demanding from the subsidiary, still remain to be what? To be 20. So in such a case, we say the amount of intercompany debt is not the same. And actually, the difference between 20 million as the amount of money the parent company expects to receive from the subsidiary and 5 million which the subsidiary company expects to pay to the parent, we are saying that difference, which is 15 million, is cash in transit. So how do we deal with such amount of intercompany debt which is not the same in preparing the consolidated statement of financial position? Number one, when recording the current assets, asset, we know that trade receivables is part of the current asset. We take the current asset of the parent plus those of the subsidiary, and then from the trade receivables of this company, we know an amount of 20 million is included as the amount of money it is expecting to receive from the subsidiary. So from the trade receivables, less 20 million. And then this cash in transit, this check which has been sent by the subsidiary but not yet received by the parent, is added to the group cash and bank balance. So therefore, here when recording the cash and bank balance, we take the cash and bank balance of the parent plus that of the subsidiary, and then we add the cash in transit of 15 million. And then finally, when recording the current liabilities, we take the trade payables of the parent plus those of the subsidiary, and then we know that the included in the trade payables of the subsidiary, is the amount of money it owed to the parent is how much? Is 5 million. So therefore, from the group trade payables, we less how much? We less 5 million. We less 5 million. So that's how we or that is the adjustment which is made in relation to amount of intercompany debt which is not the same. So therefore, here as a candidate who is doing this paper, what we must be in a position to do is to make adjustment of intercompany debt which is the same, which you have said should be eliminated from the group receivables and group payables, and also you must be in a position to make an adjustment of amount of intercompany debt which is not the same. We are saying the amount of intercompany debt will not be the same due to something called the cash in what? Transit, CIT. And I think I've explained how the adjustment made in relation to amount of intercompany debt which is not the same. So next I want us to look on the other consolidation adjustment. So we have the other consolidation adjustment number 2. And that is what we refer as the adjustment relation to fair value adjustments. Fair value adjustment. So the fair value adjustment, first of all, is a process through which the subsidiary company revalue its asset on the date of acquisition. Whenever a subsidiary company is to be acquired, it is a normal practice that that company should revalue its what? Its asset. And generally, once the subsidiary company revalue its asset, the subsidiary company do not account for that what? Revaluation, because it is revaluing its asset in order to be able to agree on the purchase consideration which the parent company will pay in acquiring a majority of its majority of what, or basically in acquiring it a part of its net asset, or basically part of its shares. So therefore, fair value adjustment, we can say this is a revaluation of assets by a subsidiary company on the date of acquisition. So on the date the subsidiary company is acquired, it revalue its asset. And basically what I've said is that once the subsidiary company revalue its asset, the subsidiary company do not account for that revaluation. Do not account for that what? Revaluation of asset. And generally what we know is that once a company revalue its asset, it has to account for that revaluation of asset. And because the subsidiary company didn't account for that revaluation, we have two adjustments which are made. So we have two adjustments which are made as far as that revaluation is concerned. Well, number one, we have the adjustment which is known as the revaluation adjustments. The revaluation adjustment, and the other adjustment is known as the depreciation. The depreciation what? Adjustment. So therefore, as a result of the subsidiary company revaluing its asset and basically not accounting for that, we have two adjustments which are made: the revaluation adjustment and the depreciation adjustment. So let's start with the first adjustment here, and that is the revaluation. The revaluation adjustment. So this is an adjustment which is made and it relates to any revaluation gain or loss arising from revaluation of asset. And this particular revaluation gain or loss, because it was not accounted for when preparing the group accounts automatically, it must be considered, or basically it must be adjusted. But first of all, we can say that this is an adjustment. Is adjustment in relation to any revaluation gain or what or loss. Revaluation gain or loss. Remember what you have said is that once the parent company acquires the subsidiary, it's basically a normal practice that this company, because it is to be bought, or basically this company is being acquired, this company revalue its asset. Revalue it what? Asset. And what we are saying is that any revaluation gain or losses which is reported by that company is not accounted for. accounted for. So how do we account for that particular devaluation gain or loss? But even before you look on that devaluation gain or loss, in most of examination questions, the examiner will not tell you whether there was a devaluation gain or loss, but the examiner may tell you that the subsidiary devalued some items of PPE and the fair value of such asset was found to be more than their net book value or their book value or their carrying amount. So if you're given that information that the fair value is more than the book value, then the difference here is a revaluation gain. But on the other hand, if you're told the fair value was less than the net book value or carrying amount, then this is a revaluation loss. Loss. Now, this particular devaluation gain or loss is accounted for one by adjusting it in the group property, plant and equipment. But let's first of all we look on how we deal with the revaluation gain, which is basically a common scenario, a revaluation gain. So this revaluation gain one, we add it to the group property, plant and equipment. So when talk about the group property, plant and equipment, this is the figure which you get after adding the property, plant and equipment of the parent and those of the subsidiary, and then to this you add any revaluation gain. In the event there was a revaluation loss, what you do, a revaluation loss, you less it here. But it is obvious that you can't have the two at the same time. You can either have a revaluation gain or a loss. Number two is that this revaluation gain is accounted for or is basically treated as a pre-acquisition revaluation reserve relating to the subsidiary company. What that means is that when computing the fair value of the subsidiary company net asset at the date of acquisition, which is then used in the computation of goodwill, this is one of the pre-acquisition reserve which you consider. Which you do what? You consider. So that is the first adjustment which is made as far as the revaluation of asset by the subsidiary company is concerned. And number two, we also make this other adjustment which is called the depreciation adjustment. But this adjustment is only made whereby the asset which was revalued by the company or revalued by the subsidiary company is a depreciable asset. A depreciable asset basically is an asset which is ordinarily depreciated. There are those particular assets which you may be told they were revalued by the subsidiary company, something like land. Basically, we know that land is not depreciable. We don't depreciate land. So therefore, this adjustment is only made whereby the asset which was revalued by the subsidiary company is an asset which is ordinarily depreciated. And when computing this particular this particular depreciation adder charge or adjustment, that is depreciation adjustment, it entails determining the depreciation adder charge, or basically the depreciation overcharge. So if the subsidiary company revalued its asset and basically that resulted to a revaluation gain, then we compute something called the depreciation adder charge. If there was a revaluation loss, we compute the depreciation overcharge. And also this particular depreciation overcharge or adder charge, we compute it between two dates. The date when the asset were revalued, that is the date of acquisition, and the date of consolidation. The date of what? Consolidation. So therefore you can say any depreciation adder charge, and basically this is the common scenario whereby you are computing depreciation adder charge, because I've said that once this company revalue its asset, mostly that give rise to revaluation gain. We are saying if there was a revaluation gain, what you do, compute the depreciation adder charge. So any depreciation adder charge we say is computed from the date of acquisition. The date of acquisition is the date the parent company acquired the subsidiary, and date of consolidation. And date of what? Consolidation. Date of consolidation. So in terms of how we compute this depreciation adder charge, we take the revaluation gain, you or we divide that with the estimated remaining useful life of the asset, estimated remaining useful life of the asset, and basically multiply that with the proportion of time. So the proportion of time, we are talking of the time which you have from the date of acquisition there to the date of consolidation. If from the date the subsidiary was acquired to the date of consolidation we have 2 years, that is the proportion of time. The proportion of time there will be 2 years. If from the date of acquisition to the date of consolidation we just have 6 months, then the proportion of time will be 6 all over 12. That's what you mean by proportion of time. Then which adjustment are made as far as this depreciation under charge is concerned? So this depreciation under charge 1, in preparing our consolidated statement of financial position, we less it from the group property, plant and equipment, and number 2, we also deduct it from the retained earnings, the retained earnings of the subsidiary company. We deduct it from the retained earnings of the subsidiary company. We know that if a company undercharged depreciation, it means that the profit which was reported, the retained profit which was reported by that company was what? Was overstated. So therefore, that's how we, or the adjustment made as far as the depreciation undercharge is concerned. Less it from the group PP, less it from the retained earnings of the subsidiary company. But on the other hand, now if there was a depreciation overcharge, we do now the direct opposite of that. Any depreciation overcharge is added to the group PP and also added to the retained earnings of the subsidiary company. So therefore, that is a second adjustment which is very, very important, and basically this is something you'll come across in all questions for group accounts. Anytime you come across this question or a question from this topic of group account at your level, you will be given this particular adjustment. You'll be told the subsidiary company revalued its asset and didn't account for that. You have to determine the revaluation gain or loss. You must be able to know how to account for it. You must also determine the depreciation, undercharge or overcharge if the asset which was revalued is a depreciable asset. But in this case, I've said that if the asset which was revalued is non-depreciable asset, is an asset which is not ordinarily depreciated like clad, don't determine, or basically we don't compute the depreciation overcharge or what? Undercharge. So let's move and look on the third adjustment, number 3, and that is the adjustment in relation to unrealized profit, unrealized profit on inventory. This one is abbreviated as URP, and it is profit on inventory. Now, the unrealized profit on inventory, basically this adjustment is made anytime there was what we refer as a intra-group trading. Intra-group trading is basically whereby we have trading, or basically we have sales between now the parent company and the subsidiary. The parent company and the subsidiary. For example, in this case, let's assume that we are told that the parent company sold some goods, made some sales to the subsidiary company during the current financial year. So automatically, this company which sold goods to the other, that is the company which made sales, the parent company, this company reported a profit. Reported what? A profit on these sales, reported a profit on these sales. But remember what you have said is that for the purpose of preparing the group account, the parent company and the subsidiary are viewed to be one and the same what? Entity. So therefore, these sales between the group members, any sales between parent and the subsidiary, from the group point of view, it should not be accounted for as sales, but should be viewed as a transfer from one entity to another. And therefore, this particular profit which was reported by the selling company, this profit will only be regarded as realized, or will be deemed to have been realized, if all these particular goods which were sold by the parent to the subsidiary company will have sold them to third parties. Will have sold them to third parties when the financial year is coming to an end. So meaning that if some of the goods will not have been sold to third parties at the end of the year, then part of this particular profit or whole of it will not be realized. Will not be what? Realized. So therefore, the unrealized profit, this one arises whereby some of the goods which will have been sold by one of the group member to the other will remain unsold at the end of the year. at the end of what? Of the year. So how do we determine that and erase profit, and basically how do we account for it?
Greetings, ladies and gentlemen, and welcome to the Manifested E-Learning Forum. In our today's session, we will continue with the subject economics. We have been studying the topic agriculture and industry. In our last session, we discussed the role of agriculture in developing the economy or in economic development. Today, we will focus our attention on the challenges facing the agricultural sector in developing countries. So by the end of this lesson, you should be able to discuss the various challenges that face the agricultural sector in developing countries. And candidates, Kenya being predominantly an agricultural country, I know most of you know some of these challenges that we face in Kenya and indeed other developing countries. One obvious challenge is the use of outdated technology. Outdated technology. Number one is use of outdated technology. In developing countries, candidates, we've witnessed the citizens using technology that is outdated. Okay? And this technology that is outdated, we've seen it being employed in tilling of land, in preservation of the harvested crops. We've seen it, outdated technology being employed in even rearing of animals and so on. So, although it is one of the country's most important bets in the future, it has also been a major challenge to have users adopt the newer technology that is made available to them. All right? Developing countries have very huge potential when it comes to agriculture, which is the production of crops and also rearing of animals, the tilling of land and rearing of animals. So the misdirection of efforts, maybe due to poor research, could be a reason why citizens in developing countries rely on outdated technology. Okay? And we're going to display some of the outdated technology that is employed in developing countries. You can see on your screen when it comes to, say, tilling of land. That kind of tilling of land is an outdated technology. You've also seen technology in preservation of food, drying of food. So the technologies that we are seeing, candidates, those are outdated ways of conducting agricultural activities. Another challenge is number two, infrastructure. Infrastructure. Now, candidates, there are some peripheral needs that have to be tackled at a large scale to aid farmers. And one of the main issues in this regard is the lack of appropriate infrastructure. All right? Like linking roads to rural areas, having facilities in place, commercialization, sports, and so on. So the effect of loss of perishable goods increases largely due to unavailability of infrastructure. And candidates, if production costs are higher, they are translated into the final price of the products that reaches commercialization spots in a good shape. When I say commercialization spots, I mean the market. If, for instance, there are poor roads in the country, then that means that transportation of crops or harvest from the rural areas to markets will be high. And if the transportation is high due to poor infrastructure, then that will affect the prices of commodities or agricultural products. So infrastructure is a major challenge that faces the agricultural sector in developing countries. Resource depletion, number 3, is another challenge. Resource depletion. Resource depletion. To deplete means to deteriorate. And candidates, at present, there is a tendency in the field of agriculture toward conserving the fast eroding biological resources. For example, if a disease or pest were suddenly to appear, the entire crop could be wiped out. And such disasters have occurred throughout history. So dependence on a single uniform crop also may lead to mass starvation. So the unprecedented demand for food and the contemporary socioeconomic changes have led to the exploitation of natural resources by causing depletion of resources such as forests, destruction of the ecosystem through deforestation, replacement of natural vegetation by arable farming, and also what we call pasture husbandry. And that may also include the erosion of traditional varieties of important food, feed, and also medicinal plants. In other words, candidates, due to the pressure or the high demand of products, agricultural products, resources have been depleted. We've had forests being cut down so that people can carry out farming activities. We've seen destruction of the ecosystems. We've seen the replacement of natural vegetation. Like in Nairobi, we've seen arable land being converted into real estate, and that poses a big challenge to the agricultural sector. Land that has been used for arable activities or farming, that land has been converted to other activities, which poses a challenge to agriculture. So resource depletion is a challenge that faces that is faced in developing countries. Number 4, population pressure. Population pressure. Candidates, one of the most serious consequences of the continuing population growth is the worldwide shrinkage in the crop land per person. In developing countries, candidates, the per capita land available has been decreasing to an alarmingly small size. And this has brought about stress in form of increasing rural landlessness. It has also led to employment as well as poverty. So the population pressure in developing countries is a serious problem. and it negatively impacts on the agricultural sector. As the population increases in developing countries, the land that is available for farming reduces, and it has been reducing at an alarming rate. So that's a challenge. Then the next challenge is land degradation. Land degradation. Degradation is the opposite of gradation. Land degradation. Land degradation. Now, the most important consequence of deforestation is land degradation. Degraded land is that which has irretrievably lost some of its natural productivity. That's why in most homes, fertilizers have to be employed, fertilizers have to be used for there to be any productivity on the land, because land is degraded. So normally it can still be used for agriculture. Such land can still be used for agriculture, but will often require major investments to be restored to its former productivity. So now it's not possible to just plant seeds or plant crops without investing in the soil, okay, by maybe use of inorganic fertilizers or organic fertilizer and so on. Declining productivity is another challenge. Number 6, declining productivity. Declining productivity. In developing countries, all heavily depend on subsistence agriculture, which is a common limiting factor. And it has the failure of government to recognize either the scale or the national agency of essential technical solutions to the hazards of maybe floods, droughts, soil erosion, soil nutrient depletion, and so on. So these issues that I've mentioned demand both state authority and public consensus to uphold discipline in the organization of land use, which will be used for, say, agriculture and forestry. So crop yields, candidates, have continuously been decreasing over time, largely caused by topsoil erosion and so on. So declining productivity is a challenge that is facing the agricultural sector in developing countries. Declining productivity. The trend has been a decline in productivity of both the crops and animals. So these are 6 challenges facing the agricultural sector in developing countries. They are not the only challenges. There are many challenges, like you can say diversity. All right, diversity. Now, candidates, the phenomenon of diversity has been known and certain of its aspects that have been recognized for many years. So the evolution of crop cultivation and animal husbandry reflects both accomplishments in domestication and the perilous neglect of the significance and potential of biodiversity. And addressing the complex issue of sustainability remains incomplete as long as the question of diversity is excluded. So diversity is yet another challenge. Diversity. So these are 7 challenges facing the agricultural sector in developing countries. They are not the only challenges. Other challenges we can say, other challenge here we can include marketing of the products. Marketing. We've had problems in marketing of agricultural products in developing countries. There are countries that have plenty of products, plenty of animal products, but lack marketing or market to sell the products. It's been a challenge, even exporting some of the products because of lack of proper government policy and so on. So there are various challenges we've mentioned. Technology, lack of proper technology. The world today is moving towards technology in all sectors. In developing countries, technology is not properly applied in the agricultural sector. In developing countries, there is a problem of infrastructure, especially roads to rural areas. Roads in rural areas are not properly constructed. So moving food crops from farms to commercial centers is a challenge. Resource depletion is another challenge. We've discussed the population pressure. Due to pressure, the increase in population, there has been a lot of pressure on land use. Okay? In developing countries, I say that the per capita land availability has been decreasing to an alarmingly small size. And that has brought stress in form of increasing rural landlessness. We have people in rural areas that do not have land for farming. Land degradation, another challenge. Declining productivity, diversity, and marketing. So that marks the end of our today's session. Thank you for attending. Before we close this lesson, I'll give you one assignment. Discuss 7 challenges facing the agricultural sector in developing countries. Please attempt that question. When answering the question, avoid referring to the notes. Try and see if you can actively recall what you have learned today. Thank you. God bless you. Bye-bye.
Yes, good day, my student. Welcome back to Manifested Online Classes. My name is Joseph Kimani. And in this session, or basically in this class, I want us to look on an illustration question regarding the topic of public financial statement. Remember, in our previous classes, we have already looked on how we prepare the statement of comprehensive income, statement of financial position, statement of changes in equity. And in this class, I want us to illustrate how we present the same using a past paper question. I want us to go through the question, and then from there we look on what was required. So the question reads, the following trial balance related to BD Limited as at 31st of December 2022. So we are given a trial balance for BD Limited at the end of the year. First of all, we have the property at cost, and you're told property include a building. Generally, if you're given property include land and building. So in our case, you're told the value of building is 400 million. So mean that the difference between 600 and 400 is the value of land. We have plant at cost, motor vehicles at cost, office equipment at cost, accumulated depreciation as at 1st January 2022 for buildings, plant, motor vehicles, office equipment. And then we have the inventory at the start of the year, purchases at cost, distribution cost, administrative expenses, revenue, trade receivables, and trade payables. We have the bank balance. we have the deferred tax, current tax, bank interest, and then from there we have the ordinary share capital, the share premium, the retained profit as at 1st January 2022, interim dividends paid, and then we have suspense. Then from there we have some additional information, note number 1 up to note number 6. And then what are we required? We are required to prepare the statement of, we are required to prepare the following financial statements in a suitable format for publication. In other terms, we are required to prepare 3 components here of financial statements in a format suitable for publication. 1, we are required to prepare the statement of profit or loss for the year which ended 31st of December 2022. B, a statement of changes in equity for the year which ended 31st of December 2022. And C, a statement of financial what? Position as at 31st of December 2022. Now, before we prepare what was being required here, definitely we need to go through the additional information. We see what we are told, and equally we see whether there is any working which is required. So in additional information number 1, you are told, during the year which ended 31st of December 2022, BD Limited disposed of an item of plant for cash proceeds of shillings 20 million, which were credited in the revenue account, and we are told no other accounting entries were made. The plant had a cost of 39.7 million and had an accumulated depreciation of 15.86 million. And then in the other point, you are told any gain or loss on disposal should be included within the cost of sale. So what you are told here is that this company disposed, or in other terms, sold an item of plant at an amount of 20 million. So this 20 million, which was received from the sale of the plant, we are told it was included as part of the revenue. First of all, that is wrong, because whenever the company sells an asset, that is a capital income. It should not be included in the revenue of the company. So therefore, when preparing the statement of profit or loss, what we are going to do, from the figure for revenue, we are going to less that 20 million. 2, anytime the company disposes or sells an asset, you have to prepare an account called disposal account for you to determine whether that item was disposed at a gain or at what? At a loss. And actually, we are told that profit, all the loss on disposal should be part of what? Part of the cost of sale. So therefore, let's start with that working. Remember, this illustration. This is illustration on the topic of published. So we start with the workings. We start with workings, and working 1 will be the preparation of the disposal account. I've said this is an account which is prepared anytime the company do what? Sells or disposes an asset, and we prepare this account to determine whether the asset was disposed at a gain or at what? At a loss. So how do we prepare this account? We prepare this account by debiting it with a cost, crediting it with 2 items, the accumulated depreciation and also the sales proceed. Then from there we balance our account. Any balancing figure on this side is a loss on disposal. Any balancing figure on this side is a gain on what? Disposal. So we are given those items. 1, we are told we are given the cash proceeds. The cash proceeds is the amount which was received by the company after selling that asset. And if you check on the figures given in the trial balance, our figures are given in thousands of shillings. So therefore, for us to be consistent, we have to work with all our figures in thousands of shillings. So 20 million is the sales proceeds. And then we are also told that this plant had a cost. The cost was 39,700. That is a cost. And then we also given the accumulated depreciation as 15. Okay, that is the accumulated depreciation we recorded up there. 15 what? 15,860. So what we need to do, we balance our account here, and the balancing figure, if on the debit side is a gain, if on the credit side is what? If on the credit side is a loss. So let's add what we have on the credit, 15 860 plus 20,000. So that will give us 35,860. So mean that this side is more, and therefore our balancing figure will be on which side? It will be on the credit side. And how much will be our loss? It will be, we take that minus what we have on the debit, 39,700, and that will give us 38,40. So this particular 38,40, this is what? This is the loss on what? The loss on disposal. And what you are told is that this particular loss on disposal should be included as part of the cost of sales. And basically that's what we said in our previous class, that any gain or loss on disposal should be part of the cost of what? Sales. So that will be added in the cost of sales. And equally, we have said as far as that point is concerned, there are a number of adjustments we are going to make. The 20 million, this is the amount received from the selling that particular plant. We are told it was included as part of revenue. That is wrong. We are going to less that from the revenue. And then we also told that this particular plant which was disposed or which was sold had not been accounted for. What the company had accounted for is purely the amount received. And therefore, this plant which was disposed, we are going to less it from the plant of this company. The moment the company sells an asset, disposes an asset, such an asset should be derecognized. It should be removed from the company's books of account. That was not done. So therefore, we are going to make that adjustment, but you're going to make that adjustment specifically when preparing what is required in Part C. So let's move to the last point of note number 1, and you're told it is a policy, it is the company's policy to provide a full year depreciation in the year of asset purchase and none in the year of disposal. It basically means that whenever the company has acquired an asset in a certain year, even if the asset is acquired some few months to the end of the year, the company provide a full year depreciation, but none, no depreciation which is provided in the year of disposal. Basically, that information is to help you in terms of computing the depreciation for plant in note 2, because there was this plant which was disposed during the current year. So this plant which was disposed during the current year, no depreciation will be provided as far as that plant is what? Concerned. But you're going to use that information on note 2. So let's go to note number 2, and you're told depreciation on plant, property, plant and equipment is to be provided and allocated as follows. So let's compute those particular depreciations. As per note number 2, we compute the depreciation of items of PPE. We start by computing depreciation of the first item, which is what? Which is buildings. Buildings. So we are told buildings are depreciated at the rate of 2.5%. Using which method? Using straight line. So at a straight line, you have to recall we compute depreciation based on the cost. So what is the cost of buildings in the trial balance? The cost of buildings is 400 million. So we get 2% of 2.5% of that, 2.5% of that. And then also in note number 2, we compute the depreciation on plant, which is at the rate of 10%. Using which method? The reducing balance method. So under the reducing balance method, we compute depreciation based on what? Based on the net book value. Based on the net book what? Value. So what will be the net book value of a plant and the plant? So we take the cost, which is 280, and then we less the accumulated depreciation, which is 111, 116, 16. But now equally here, you have to remember there was this plant which was disposed. So therefore, because no depreciation which is provided in the year of disposal, we automatically need to eliminate that particular plant here. And basically we eliminated here at its net book value. So what will be the net book value of that plant? So the net book value of this plant which was disposed will be, its net book value will be equal to its cost, which we have here, 39,700 minus the accumulated depreciation, which is 15,860. 860. So that will give us now the net book value of this particular plant which was disposed, which was sold during the current year. We have 39,700 minus 15,860. So that will give us a net book value of 23,840. So because it's part of this and we are told no depreciation in the year of disposal, we need to deduct it there, 23,840. And basically you can see we are deducting it there at what? At net book value. So we are going to come back and compute these particular depreciations. Then let's go back to note number 2, depreciation on motor vehicles, which is at the rate of 20%, using which method? Straight lines. At a straight line, we compute depreciation based on cost. The cost of motor vehicles is 70 million. 70 million. So we will compute that. We go back to note number 2. We compute depreciation on office equipment. Office equipment, which is 12.5%. Using straight line. Straight line, we compute depreciation based on what? Based on the cost. Based on the cost. Yes. So what now we need to do? We compute these particular depreciations. And remember in our case here, what you have said is that depreciations on items of PPE, this one is included as part of the cost of sales unless told otherwise. If you go back to that particular point, you'll be able to see how those particular depreciations are supposed to be classified. For example, depreciation on building is administrative and so on. But you have said if the question is silent, you always account for this depreciation as part of the cost of sales. So let's compute this. We start with the depreciation on buildings, which will be 2.5%. 2.5% times 400,000. 400,000. So that will give us what? That will give us 10,000. Will give us a figure of what? 10,000. 10,000. And then you are told that this particular depreciation on buildings, as per note number 2, this one will be part of administrative expenses. Will be part of the administrative what? Expenses. That is important. Then let's compute the depreciation on plant. First of all, we compute this, and this was a figure of 280,000. This is a 280,000. 280,000. I hope that is correct. 280,000. Yes, we take 280,000. 280,000 minus 111, 160. 111, 160. I hope that also figure is correct. 111, 160. So and then to this we less now the net book value of the plant which was disposed, 23,840. Okay, and then we get 10% of that, which will give us 14,500. 14,500. How is this depreciation to be accounted for? As per note number 2, this will be part of the cost of sales. This will be part of the cost of sales. Then let's compute the depreciation on motor vehicles, which is 20% of the cost, which is 70. And that will give us 14,000. As per note number 2, this depreciation on motor vehicle should be classified as part of distribution cost. Part of distribution cost. Then we compute depreciation on equipment, which is 12.5% of the cost. And this will give us what? 5,000. 5,000. And equally, as per note number 2, this is a part of admin. This is part of the administrative what? Expenses. So those are the depreciations. So and I think we are done with that particular point. Let's move to point number 3. In point number 3, what are we told? We are told that it has been discovered that the former financial controller of BD Limited engaged or basically was engaged in fraudulent financial reporting of shillings 12 million of trade receivables that were non-existent and need to be written off. So basically what that means that the former financial controller of this company included in the receivables an amount of 12 million, which are non-existent receivables, and therefore they need to be written off. So we are told that out of this amount, 7 million relate to the year which ended 31st of December 2022, which is now the current year, and therefore that particular amount of 7 million which relate to the current year, we are going to write it off and basically include it as an expense for the current financial year. So remember, these bad debts which are written off, this is written off as a result of a decision which has been made by the board or basically by the management, and therefore such an expense which arises as a result of a decision which is made by the management of the company, by the board of directors, then we classify that as part of administrative expenses, and then you're told with the balance relating to the prior year. So therefore, those particular bad debts which are to be written off, which are for non-existence receivables, bad debts written off, So in that case, we are told that is an amount of 12 million. Is an amount of 12 million, but we said we are working with all our figures in thousands of shillings. So we are told 7,000 relate to the current year. So therefore, in preparing our income statement, this one we are going to include it as part of admin. And then now the difference, which is 5 million, this one is a prior year adjustment. Adjustment. Basically what that means, this amount of 5 million, it related to the previous year. We don't include it in the income statement for the current year. It's not an expense for the current year. So what we do, we adjust it in the opening the opening retained profit or the retained earnings, because it was an amount which was supposed to be written off in the previous years, but it was not written off. So what we are only including in the income statement for the current year is 7 million. So let's go to note number 4. And in note number 4, we are told the existing debit balance on the current account in the trial balance represent the adder or over provision for previous year's tax. So if you go back to the trial balance, there is an item which you are given there, which is an item of current tax. So that item is below the bank balance, is below the deferred tax, and that item is an amount of 2600, the item of current tax, and you can see this is a debit balance. It is on the debit side of the trial balance. So this particular amount here, this one is what is under provision. Of what? Of current tax, because under provision of current tax from the previous years has a debit balance, in the trial balance. But if it was over provision will be having a credit balance. That is something which the examiner will not tell you, but any other provision of current tax from the previous year, this one will always be having a debit balance in the trial balance, and any over provision of current tax in the from the previous year, this will be having a credit balance. This is something you'll come across in most of the questions for published, but the examiner will not have specified whether it is over or under. Is upon you to know that other provision has a debit balance, other provision has what? Has over provision has a credit balance. So therefore, that is over. That item which we have is under provision. So how do we treat under provision of current tax from the previous year? So such under provision, we bring it forward to the current year and we add it. We do what? We add it to the current year's estimated tax liability. We add it to the current year's estimated tax liability. But if it was an over provision, we bring it forward to the current financial year and we less it from the current year's estimated tax liability. That's basically what you need to know, and therefore that's what you're going to do as far as that other provision is concerned. And then you're told, number 4, the second sentence, we are told the provision for current tax for the current year, that is the year which ended 31st of December 2022, was 42 million, or was 52 million. 52 million is required together with a decrease to the deferred tax provision of 3 million. So therefore, we are told the estimated tax liability for the current year is 52 million. So mean that we need to determine the amount of current tax to be charged in the income statement. So the amount of current tax to be charged in the income statement, what we do is that we take the current year's tax estimate, which is 52 million. But remember, in the previous year, we had a provision. The other provision which we have in the trial balance of how much? Of 26. And we have said that that other provision from the previous year, we added to the current year's tax estimate. And this will give us now a total of 54,600. So this is the amount of current tax to be charged in the income statement. In the same point, we are told there was a decrease in deferred tax provision. A decrease in deferred tax provision in the income statement, that one is accounted for as a deferred tax income. As a deferred tax income. So because it's a decrease, just the same way how we account for a decrease in provision for doubtful debt. A decrease in provision for doubtful debt, we account for it as an income. But an increase in any provision is accounted for as an expense. So therefore, that amount of 3 million, that is a deferred, tax income. A deferred tax income of how much? Of 3 million. Remember now these two items will be adjusted in the profit before tax. That's what we said in our previous or in the introduction class, that to the profit before tax we adjust two items, the current tax and also the deferred tax income, or expense. So we have that. Then let's move to the other note number 5. And note 5, we are given the inventory at the end of the year. This is now the closing inventory, no working which is required. And then number 6, you are told on that 30th of December 2022, the company directors invited the current shareholders to subscribe for a right issue on the basis of 1 share for every 5 shares which were held at an exercise price of 15. And then you're told the come right price on the last day of trading was 20 shillings per share. So, and then you're told the proceeds from the fully subscribed right issue were credited in the suspense account. So I think what we need to do there is to determine how many shares were issued by the company during the right issue. How many shares were issued by the company during the right issue? So we are told this right issue which was made by the company to the existing shareholders, it was on the basis of 1 share for every 5 shares held. For every 5 shares which were held. So what we need to do first of all is to determine the shares held by this company, not held by this company, but the shares held by the members, the shareholders of this company. How do we determine that? We take the ordinary share capital of the company, which is given in the trial balance, which is 200,000. And to determine now the shares issued by the company, we divide that with the par value. The par value is the value per share given in the trial balance, which is 10. And this will give us 20,000 shares. So these are the shares which were held by the shareholders of the company. So the company was to, during the right issue, was to issue 1 share for every 5 shares which were held. The shares which were held were 20,000. So we need to determine how many shares were issued during the right issue. We take 1 times 20,000, we cross multiply, then we divide. Divided that with what? With 5. So this will give us what? 4,000 what? Shares. And we are told that these shares were issued at an exercise price of 15. So therefore what we need to do, we multiply the 2, and basically this will give us the amount which was received by what? By the company. The amount received by the company from the right issue, which automatically this one will give us what? 60,000. Now what you are told is that this particular amount in the last sentence of note number 6, the proceeds, the amount received by the company was credited in the suspense. Was that correct? No. Because what we know is that once the company make a right issue, the amount which was received should be debited in the bank account, debited in the bank. That entry was made, but now the company credited suspense account. Is this what the company was supposed to do? No. So because these are shares which were issued, this account is not the one which was supposed to be credited, but the company was supposed to credit which account? The company was supposed to want to credit the ordinary share capital account. The amount credited in this account is always based on the par value per share. You take the shares issued by the company, 4,000 times the par value. The par value is the amount or is the value per share we have in the trial balance, which we know is 10. So the amount to be credited in this account will be what? 40,000. So this amount of 40,000, we are going to add it to the ordinary share capital of the company. And then the amount which is above 10 shillings. You remember the shares were issued at 15. The amount which is above 10 shillings is a premium. So therefore, that would be credited in which account? The share premium. The shares issued, 4,000 times what? 5. Times 5. Times 5. So the total, which is 20,000, that is a share what? A premium. So therefore, the adjustment which will be made as far as that note is concerned is that when preparing the statement of changes in equity, to the ordinary share capital, we are going to add 40,000. To the share premium, we are going to add what? 20,000 in relation to these particular shares which were issued by the company during the current year. And I think we are through now with the notes. What we need to do, basically we can proceed and prepare what is required. So let's start with the part A of that particular question. And what is required is the statement of profit or loss. So first of all, we need to have the name of the company. The name of the company is BD Limited. And this is a statement of a profit or loss. Statement of profit or loss for the year which ended 31st of December 2022. 31st of December 2022. So that is basically our title there. Our title. And then now we have to use the format which I gave you. Remember, I gave you the format for this. That is the exact format we use here. So, and remember, all our figures are in thousands of shillings. And here we only have one word, one column. So what do we start with here? We always start with the revenue. The revenue. And the revenue is something which is given in the trial balance. The revenue for this company in the trial balance is given as a figure of what? As a figure of 11,23,500. But remember, there is an adjustment which you are going to make here as far as note number 1 is concerned. So this plant which was disposed by the company, we are told this amount which was received, the sales proceeds, this was included as part of the revenue. Yes, so to this figure, we need to less 20,000, which was included here as the amount which was received from selling the asset. That amount should not be recognized as a revenue because this is basically a capital income, a capital revenue. So any amount realized from the selling an asset should not be included here. So I think that now will give us a figure of what? A figure of 11,03,500. So, but we can confirm that. Let's confirm whether that is correct. So we have 11,23,500 minus 20,000. Minus 20,000, that will give us 11,035,500. And then to this, what do we need to do? We need to less the cost of sales. We need to less the cost of what? The cost of sales. Cost of sales. Now, are we given the cost of sales? No, we have to compute it. Remember, I gave you the formula for computing this. We take the opening inventory plus purchases minus closing inventory plus any depreciation plus any loss on disposal minus any gain on disposal. So what we include here, one is the opening inventory, which is given in the trial balance, 138,000. To this we add purchases, which is just below the opening inventory, which is 667,000. To this, we less the closing inventory. Where do we have the closing inventory? Note addition information number 5, which is an amount of 85,000. And then to this, we add any loss on disposal. Remember here we have a loss on disposal, which is 3840. And any depreciation on PP. We have various depreciations here, and part of them should be included as part of the cost of sales, starting with the depreciation on plant, which is 14.5. Do we have any other depreciation which should be included as part of the cost of sales? No. So that's how we are going to arrive at the figure for the cost of sales. Opening inventory, purchases, closing inventory, loss on disposal, and then the what? And then this depreciation on what? On plant. So let's get the final figure here. We get the final figure. So we have what? We have 138,000. 138,000 plus 667,000 minus 85,000 plus 3840 minus 14,500 and that will give us a figure of what? It will give us a figure of 709,340. 709,340. 709,340. So we let's start from our revenue up there, and whatever you get here is the gross profit. The gross profit. So how much would be our gross profit? We deduct that from 1103 500, and this will give us a 598,990. That is our gross profit. So to this gross profit, next we said we add other income. So when checking for other incomes, what basically you do, you go back to the trial balance and you check other incomes on the credit side. All incomes, they have a credit balance. So we go through the items on the credit side of the trial balance. We see whether we have any other income. Up there you can see we have accumulated depreciations. Those are not incomes. Down here we have revenue, payables, bank balance, and then deferred tax. And then we have ordinary share capital, share premium, retained profit, and down there we have what? Suspense. So basically in our case here, we don't have any other income. We don't have any other what? Any other incomes. We don't have any other what? Income. So then to this we go straight to deducting our expenses. Our expenses, we can start with just what we have in our trial balance. Below the opening inventory and purchases, we have the distribution cost. Distribution cost. So the distribution cost in our trial balance is given as an amount of 44,000. So there are some depreciation which are part of the distribution, and that is the depreciation on what? On motor vehicles. So that one we included here. And that is an amount of depreciation on motor vehicles is an amount of 14,000. 14,000. So this will give us a total of 58,000. So below the distribution, we have the admin expenses, administrative expenses. So equally that need to be adjusted. We can do our adjustment with here. So we have 93,500. So and then we need to include the depreciation on what? On buildings, which is 10,000. And then also this depreciation on what? On office equipment, which is 5,000. Which is 5,000. There is something you should also, we also need to remember to include here. There was this bad debt which was to be written off and which related to the current financial year. The amount of how much? 7,000. We said it should also be part of administrative expenses. Yes. So I think now we can get the total administrative expenses. We have 93,500 plus 10,000 plus 5,000, or we can just take 5,000 plus 7, which will give us a total of 12. Yes, and that will give us total administrative expenses of 115 500, 115 500, and then below the administrative expenses, I think we have revenue. Okay, we have trade receivables, bank balance, deferred, current, and then we have the bank interest. Now, this bank interest will be included here, but we include it here as part of the finance cost. And I think this is the only item which will form part of the finance cost, and that is an amount of how much? That is an amount of 24. And then now what we need to do is we check whether we have any other expense, or this company had any other expense which has not been classified as part of cost of sales, distribution, admin, or what? Finance. So we just go through the trial balance and we check the items which we have on the debit column, because all expenses, they have a debit balance. So first of all, up there we have assets. Those are not expenses. Down there I can see inventory purchases. Those are not expenses. We have already captured distribution, admin. Down there we have receivables, that is an asset. Down there we have current tax. Remember that was under provision. That is not an expense. Bank interest, we have already captured that there in our income statement as what? As finance costs. And then down there we have interim dividend. So basically that is not what? An expense. And I think then what we have in the additional information, number one, we had the loss on disposal. We have already captured that as part of cost of sales. Note 2, we have these 4 depreciations. Depreciation on buildings, that was supposed to be included as part of what? Admin. We can confirm whether this has been included as part of the admin. 10,000 is there. Then depreciation on plant is part of the cost of sales. Have we included that here? Yes. Motor vehicles, its depreciation is part of distribution. 14,000. Have we included as part of the distribution? Yes. Office equipment, its depreciation is part of admin. 5,000. Has it been included as part of that? Yes. Okay. And then number 3, we have this amount to be written of 7, which should be part of admin. Have we included that there? Yes. And then number 4 is about tax, current and deferred. That will be deducted from our profit before tax. And then number 6 is all about, number 5 is about crossing inventory. We capture that there. Number 6 is about late issue. That do not affect our what? Expenses. So basically what that means is that we don't have any other expense. We don't have any other expense. So what we need to do here is we get the profit before tax. The profit before tax. Our profit before tax will be, we take now the total incomes minus the expenses there. So we have 598 990 minus 58,000 minus 115 500 minus 2400, and that will give us a figure of what? A figure of 423,090. So that is a profit before tax. And then to this we need to less what? We need to less the income tax expense. Income tax what? Expense. And for the income tax expense, this comprises of 2 components of tax. The current tax. And the current tax, we computed that figure there, which is 54,600. And then we also have the component of deferred tax. What did we have here? We had the deferred tax income. Deferred tax income. And because this is an income, a deferred tax income, we don't less it from our profit, but rather what we do, we add it. That's why we refer to it as a deferred tax what? A deferred tax income. So we take our figure here, which is 423,090 minus 54,600 plus 3,000. And that will give us 371 for what? 490. So what is this? This is the profit for the year. the profit for the year. So to this profit for the year, we said then we proceed and we add other comprehensive incomes. Other comprehensive what? Incomes. Other comprehensive incomes, we said these include revaluation gain or loss on PPE, revaluation gain or loss on a financial asset at fair value through other comprehensive income. But if you check on what we have in this particular question here, we don't have any other comprehensive what? Income. So basically what that means is that our total comprehensive incomes will be the same with the profit for the year, 371 for what? 490. So basically that is it. That's what was required as far as Roman 1 of that question is what? Is concerned, or part A of that question is concerned. Hi there, my student. Welcome to Manifested Online Classes. My name is Joseph Kemani. So in this session, I want us to look on illustration question on preparation or presentation of a statement of cash flows. And I want us to go through that particular question, and then we see what was required. So the question reads, Rilongwe Limited is a public listed company. Details of the company statement of financial position as at 31st of March 2022 and 31st of March 2023 are shown below, together with other relevant information. So we have the statement of financial position as at 31st of March 2023 and 31st of March 2022. So we have non-current assets, which include property, plant and equipment, intangible assets, and then other current asset we have inventory, trade receivables, interest receivable, short-term deposits, and then we have bank. Other share capital and reserves, we have ordinary share capital, and then reserves include share premium, revaluation reserve, and then we have retained earnings. Then we have the total equity. We have non-current liabilities, which include 12% raw notes, 8% variable rates raw notes, and then we have deferred tax. Other current liabilities, we have trade payables, bank overdraft, and then we have what? Taxation. And then we have some additional information, number 1, 2, 3, 4, 5. And then what are we required in our question here? We are required to prepare a statement of cash flows for Rilongwe Limited for the year which ended 31st of March 2023 in line with International Accounting Standard number 7, which governs the presentation of the statement of what? Cash flow. Now, first of all, if you check on this particular question here, the examiner had not specified which method you should use in preparing that particular statement of what? Cash flows. But generally, anytime you come across a question for cash flows and you are given the income statement, you are given the statement of financial position, always use the indirect what? Method, unless otherwise what? Required on, unless otherwise what? Stated. So therefore, in this case, we are going to prepare now our statement of cash flows using what? Using the indirect method. But before we do that, I want us to go through the additional information, and basically we see whether there are some workings which are required as far as that particular question is concerned. So let's go through the additional information. We see what you are told. Number 1, you are told details of property, plant and equipment as at 31st of March 2023. Basically, that is the end of the current financial year, and therefore those are the closing balances. And then 31st of March 2022. 31st March of 2022 is basically the end of the previous year, in which case those balances at the end of the previous year will be the opening balances in the current what? Year. So we are given 3 items for each year: the cost stroke valuation, the depreciation, the carrying amount. And then we are given that for 100 buildings and plant and what? And plant. So basically what that means is that the property, plant and equipment, which is in our statement of financial position, comprised of 2 assets: landed buildings, plant, and then we are given their what? Their cost, the accumulated depreciation, the net book value both at the start and also at the end. So no working which is required at this point, but we may be required to come back to that note. Let's move to note number 2. We are told the company revalued the carrying value of RAD and buildings by an increase of 70 million on 1st of April 2022. So 1st April 2022 is automatically the start of the current year, because the current year ended 31st of March 2023. That year started on 1st of what? April. And therefore, you're told land and buildings were revalued upward, and there was a revaluation gain of what? 70 million. And then you're told in the other sentence, on 31st of March 2023, that is now at the end of the year, the company transferred shillings 3 million from revaluation reserve to the retained earnings relating to depreciation on revaluation of buildings. Equally, no working which is required as far as that point is concerned. In note number 3, we are told during the year the company acquired a new plant at a cost of shilling 60 million and sold some old plant for shillings 15 million, incurring a loss of 12 million. So in that point, we are given two transactions. One, there was a new plant which was acquired, and you have now to remember any activity relating to acquisition and disposal of asset, this is an investing activity. So therefore, in preparing our statement of cash flow, this plant which was acquired will be one of the item you're going to take into account in computing the cash flow from investing activities. Also in the same note, we are told there were some old plant which were disposed. Remember, what you have said is that once the company sells an item of PP, you have to prepare what? The disposal account. And in this case, as per the information which is given there, we are given the sales proceeds, because you are told that old plant was sold for 15 million. That is the sales proceeds. And also now we have what? We have the loss on disposal, which is how much? 12 million. Anytime you see the examiner having given you the gain or the loss on disposal, then there is an item which the examiner may not have given you. So therefore, I think we can start by preparing that particular account there, which is the disposal account. Disposal account. Disposal account. So remember, I've said that in preparing this account, on this side we record the cost of the asset which was disposed. On the credit side, we record the accumulated depreciation and the sales what? The sales proceeds. And then the balancing figure in this account, we have said will be a gain or a loss. But in that point, we are told that this item was disposed at a loss. So we already given the loss, and the loss in our case is how much? Is 12 million. So, and all our figures are in million of shillings. So for us to be consistent, we are going to work with all our figures in million of shillings. And then which other item are we given here? We are given the sales proceeds. We are told it was disposed at an amount of what? 15. So if you check on the information which is given there, we are not given the accumulated depreciation. Equally, we are not given what? The cost of that particular what? Item. So, but we will see how to determine those particular what? Values there. Okay, before we go to note number 4 there, and also note 5, 6, there are a number of accounts maybe we can prepare here relating now to the PP. Relating to what? To the PP. For example, from the information we have in note number 1, we can open a number of accounts there. We can open the account for added buildings. We can open the account for plant, because there are a number of items which we must compute here and which are not given. So let's start with the account for what? The account for plant. Plant account. a plant what? Account, and for this particular account we are going to prepare it at cost. So if we prepare that account at cost, we have now to prepare a separate account for something called the accumulated depreciation. Accumulated depreciation on what? On plant account. We also prepare that particular account here, this account, and also we prepare the other account that is for land and what? Buildings. Land and buildings account. As you are going to see, the number of items we are going to determine by preparing these accounts. So the first thing we need to record here, remember I've said this account will be prepared at cost. Prepared at what? Cost. So what we need to do is to record the cost of the plant at the start of the other. This is in note number 1. So what is the cost of the plant at the start? The cost stroke valuation. Remember I've said what you're given as the balances on 31st of March 2022. These are opening balances. 31st March 2023, these are the closing what? Balances. So the cost stroke valuation of a plant at the start of the year is 445. What about at the end of the year? The end of the year is 440. Is 4 what? 40. That is balance carried down. Balance carried down, which is 440. Then we record the accumulated depreciation both at the start and at the end. Now the accumulated depreciation, this account do have a credit balance because this is a provision account. So what is the accumulated depreciation on plant at the start of the year? It was 105. It was 105. And the accumulated depreciation for plant at the end of the year, which will be on this side, is an amount of what? 148. 148. So then we also do the same for building. What was the cost stroke valuation of buildings at the start? It was 500. And then at the end of the year, it was how much? It was 600. It was 600. Yes. So that's basically what we have in note number 1. And then can we go to note number 2? In note number 2, we are told that the company revalued the carrying amount of landed buildings by an increase of 70 million on 1st of April. So basically what that means is that these particular landed buildings, they were revalued at the start. It is important to note that once the assets have been revalued at the start of the year, then the depreciation for the current year will be computed based on the revalued amount. And therefore what we do is that we ignore the previous accumulated depreciations. We ignore the previous accumulated what? Depreciations. For example, in note number 1, I hope you can see the depreciation which are given there for landed buildings for the current year. That is 31st of March 2023. Now that amount of 12 depreciation for landed buildings, that is the depreciation for the current year, because I've said that depreciation was computed based on the revalued amount. Once the assets have been revalued, the depreciation for current year we computed based on the revalued amount, and the previous accumulated depreciation are ignored. That's why we are not preparing the accumulated depreciation account on land and what? A building, simply because I've said that the depreciation for the current year for land and buildings was computed based on the revalued amount. In fact, I've said that amount which we have there for the current year, the depreciation on landed buildings for the current year, the amount of 12 million is the depreciation for the current year. So what we need to do then, can we go to note number 2? Note number 2, we are told landed buildings were revalued upward with an amount of 70. Generally, remember what you have said is that in preparing any asset account, the number of items you should record here, like in this case, you have said any revaluation gain recorded on this side, and any disposal of asset, and take into account this account we are preparing it at cost. We are going to have now the asset which were disposed at cost. At what? Cost. And take into account also this account is at cost. Depreciation is not recorded here, but it should be on this account here. So the depreciation for the current financial year for plant should be the balancing figure there. I don't think we have that figure. That is one of the items definitely we need to compute. Then on this account, we should have any revaluation gain. And basically, we know that during the current year, landed buildings were revalued upward with an amount of how much? 70, and then what we should have on this side is any disposal. Any what? Disposal. Well, there are some items of landed buildings which were disposed. Are we given such? I don't think so. I don't think we have such disposal. I don't think we have any disposal on land and what? Land and buildings. So, but we have a revaluation gain of what? Of 70. Yes. So that's what we have in note number 2. But also in note number 3, we have this new plant which was acquired. So a new plant which is acquired, remember for plant and equipment, okay, for plant there was no any revaluation gain, but you are given the acquisition. The acquisition is an amount of how much? The new plant acquired had a cost of how much? Had a cost of 60. I think that's what you're given in note number 2. So as far as that plant which was disposed is concerned, you can see we are only given the sales proceeds and also what? The loss on disposal. The loss on what? The loss on disposal. The loss on disposal. Yes. So that I think what we have. So what we need to do now, I think we can start by balancing these 2 accounts here. These 2 accounts. So of which you can see what we don't have here is now this disposal. And basically this disposal is what we are going to record here. This is a cost of this item which was disposed and which are not given there. So therefore, can we do that? What we have on the debit side is 445 plus 60. That will give us 505 minus what we have on the credit side, that is 440. So that will give us 65. So basically it means that this item of plant which was disposed, it had a cost of 65. It had a cost of what? 65. And automatically, then we can get the balancing figure here, which represent the accumulated depreciation of that item which was disposed. So we take 65 minus what we have on the credit side, 15 and 12. So that will give us 38. So this is the accumulated depreciation of the plant which was disposed. Now this particular accumulated depreciation, the figure of 38, then we should bring it to this account because this is part of this opening balance and that plant was disposed. So we have the accumulated depreciation for the item of plant which was disposed. How much is that? Is 38. Then we balance this account. The balancing figure here represent the depreciation for the current financial year and which was taken to the income statement. What we have on the debit side is 148 plus 38 minus what we have on the credit 105. So which will give us 81. So this 81 now represent the depreciation for the current year. Represent the depreciation for the current what? Yes. We also need to balance this account and basically the balancing figure in this account will be the acquisitions. Because in our case here we don't have any disposal. Anytime there are some items of PP which were disposed, you must be given that particular information. So in our case we don't have any disposal, and then because you are preparing this particular account also at cost, we don't have to credit the depreciation on this side. But there is a figure which I think I recorded the wrong figure here. So this is the closing balance. So I need to record the opening balance, which was how much? Which was 420. Which was 420. Yes, 420. And then from there, what we need to do is basically we balance that account. So let's balance that account. We see what will be the balancing figure. What we have on the credit side is 600 minus what we have on this other side, 420 and 70. So we are going to have a balancing figure here of 110. So this 110 represent now the items of or basically represent landed buildings which were acquired during the current year. So I think we are through with that additional information, number 1, number 2, and also number 3. So let's move to note number 4. Note number 4, you are given the statement of profit or loss. I don't think we have any working which is required as far as that is concerned. There was an operating loss, interest receivable, finance cost, loss before tax, income tax, repayment claim, and then we have the deferred tax charge, and then we are told we are given the loss for the period, and then you're told the finance cost. The finance cost is which we have in the income statement up there, the figure of 24. It included the interest expense and also the penalty on early redemption. So this penalty on early redemption is basically a penalty which was which the company paid to the bondholders for redeeming the loan notes early. So basically these are not an operating expense, and therefore when computing now the cash flow from operating activities, we are going to add it back to our profit, or basically to our loss, because it's not an operating expense. And then number 5, we are told the short-term deposits are deemed to be cash equivalents. And then number 5, we are told the dividends paid by the company amounted to what? 25 million. So I think no workings which are required, and I think now with that we can go straight to what is required. We prepare our statement of what? Cash flow. So we need to have the title here. The name of the company is Lilongwe Limited, and this is a statement of cash flows, statement of cash flows, which is for the year, which ended 31st of March 2023. Remember, in this case here, the examiner had not specified which method to use, but I've said once you're given the income statement and also the statement of financial position, then always use the indirect method. Use the indirect method. So here we start by determining the cash flows from operating activities. From operating activities, we need to have 2 columns, and our figures are in million of shillings. Our figures are in millions of what? Of shillings. So what do we start with here? I said we start with a profit before tax, but if you check on what you're given in the income statement of this company, in the additional information number 4, we are not given the profit before tax, but we have the loss before tax. That's what we start with here. The loss before what? Before tax. Before tax, how much is that? Is a figure of 44, and because it's a loss, we record it there as a negative. And then we make a number of adjustments to this particular what? To this particular loss. And the first adjustment, recall what we said when we were looking on the format. We say the first adjustment you make to this particular profit or loss is the finance cost, because essentially I said you should start with the profit before interest and tax, or the loss before interest and tax. But because you'll not be given that, start with what you're given, that is the profit or the loss before tax. The first item we need to adjust to our profit there is the finance cost or interest. The reason why we do that is for us now to have the profit before interest and tax. Now that is given in note number 4. In note number 4, just before, above the loss before tax, we have the finance cost, which is 24. We add it back to that, so that now we have the loss before interest and tax. And then we have said to this particular profit here, when using the indirect method, basically there are a number of items we adjust to that profit, and I gave you a certain acronym which you can use in terms of remembering those items. Dial G, you check for depreciation, any impairment, loss on goodwill, any amortization on intangible assets, any loss on disposal, and the gain on disposal. And I think in our case we have a number of items. So first of all, we have the depreciation. So for the depreciation, we have the depreciation for what? For plant. And basically that is what you have determined here. We have depreciation, the depreciation on plant. How much is that? Is a figure of 81, because that was deducted in arriving at that particular profit. Add it back. And then the depreciation on land and buildings. So this is in note number 1. That depreciation for the current financial year for added building, that is a figure for 12. I've said that is a depreciation for the current year. take into account our land and buildings were revalued at the start. So meaning that the depreciation for the current year was computed based on the revalued amount. How much is that? 12. We add it back to that because it was deducted and is a non-cash item. So we have captured this depreciation on a plant. We have also taken into account the depreciation of what? Land and building. So we don't have any other depreciation. So what else do we have here? We also have the loss on disposal. This one. So we have the loss on disposal. And this is the loss on disposal of plant. Still an amount of 12. That was deducted in arriving at our loss there. Add it back. So I think that's what we have here. So do we have gain on disposal? No. Do we have amortization of intangible asset? Amortization of intangible asset? Yes. In this question here, if you go back to where we have the non-current asset in the statement of financial position, under the non-current asset, you can see we have two assets, PP, property, plant and equipment, and then intangible asset. What was the value for intangible asset at the start? It was 510, but at the end of the year, the value for intangible asset reduced to 400. What causes the value of an asset to reduce? It can either be disposal or amortization in case of intangible asset. And because there was no disposal, basically I've said anytime the company sells some asset, you must be given that information. So that decrease for intangible asset automatically is what? Is amortization of what? Of intangible. Amortization of intangible assets. And that is a figure of 110, which is now the decrease. Equally, we add it back now to the profit there because it was deducted, but is a non-cash item. So I think that's what we have. In our case, do we have impairment loss? No, we don't have that. So I think those are some of the items which we have from our acronym third ILG. But I think before we consider the changes in working capital, if you go back to the income statement which we have in note number 4, you'll be able to see that in arriving at that loss of 44, there was a finance cost which is above that, and then you can see there is interest receivable. This interest receivable, we have said that this is a form of an investment income. In arriving at this particular loss, there is the interest receivable, which was deducted, but this interest receivable is not what? Is not an income from operation. So therefore, because it was added in arriving at that, what we do, we less it. I think that's what we have in note 4. Note 5, note 6, no adjustment here. And then I think we have captured most of the items in note number, actually all items which need to be adjusted in our profit, note 1, note 2, and also note 3. So what we need to do here is to get something known as cash flow before changes in working capital. Cash flows before changes in working capital. And then from there we consider the changes in working capital. So let's compute that figure there. That is cash flow before changes in working capital. So we need to work out of that. So we have negative 44 plus 24 plus 81 plus 12 plus another 12 plus 110 plus 110 and then minus 12, and that will give us what? That will give us a figure of 183. So that we refer to it as what? The cash flows before changes in what? Before changes in working capital. And then from there we consider the changes in working capital. For the changes in working capital here, we said we consider 3 items. You just need to remember this, RIP, not less in P's, but we consider receivables, inventory, and what? Payables. So you just determine, was there an increase or decrease? This is always 3 marks in an exam setup, So therefore what you do, you go to where we have current asset, consider 2 items there, receivables and inventory, and then other current liabilities we consider payable. So let's go back to the statement of financial position given under paragraph 1. We consider what? Inventory. So we just need to determine for inventory, was there an increase or decrease? And inventory at the start for 20, at the end 350. So in that case, we can see we have a decrease. We have a decrease. Decrease in what? In inventory. What causes inventory to reduce? Because the company disposed or basically sold inventory. So the decrease is 70. What about receivables? Receivables increased. So therefore, this decrease in inventory is a cash inflow because inventory increases. So it reduces, that is, inventory decreases because inventory was sold. And then we have increase in trade receivables. Increase in trade receivables means that we extended more credit to our customers. If we give our customers some credit, it is basically a cash what? A cash outflow. So let's determine the increase there. So the receivables increase from 372 to 808. That is an increase of what? Of 436. And I've said this means that we give our customer some credit. If we give our customer some credit, what is that? That is a cash outflow. Yes, I think that's what we consider here. And then we go to where we have payables, we consider, or to where we have current liabilities, we consider payables. And I can see also for payables, we have an increase in trade payables. The trade payables increase from 515 to 530. That is an increase of 15. Increase of 15 in payables of 15 million means that our suppliers, our creditors extended more credit to us. That is a cash what? Is a cash inflow. Yes. Then what we need to do, we basically get the rent amount, we take it to the last column here. So we have 70 minus 436 plus 15 plus 15 plus 15 plus 15, which will give us negative 351. So we deducted from the figure up there, the figure of 183, which is 168, and which is a negative. And then to this, we have said, from the format I gave you, we less the tax paid, and also the interest. The interest paid. So I think here we can start with the interest. Remember, I said interest is another name for finance cost paid. Finance cost paid. So in determining the finance cost, or basically the interest which was paid, here you consider two items. One, the finance cost in the income statement. I hope you can remember that figure in note 4, which is a figure of 24. And then you go to where we have current liabilities. In your statement of financial position, you check, was there any accrued interest at the start and also at the end? At the current liabilities, we don't have such. But if you had accrued interest at the start, what you do, you take the accrued interest at the start, which we don't have, then add the interest or the finance cost in the income statement in note number 4, which is 24. But we also have to remember, we are given a breakdown for that finance cost down there. A finance cost, we are told, include the penalty on loan redemption. That penalty, we are not going to consider it here. We only consider, we take into account the figure of 18. So we add 18. After adding the two, the accrued interest at the start and the interest for the current year, which is in the income statement, less the accrued interest at the end. And basically that will give you what? The interest, which was paid. But now for this tax here, we have to prepare something called the tax account. Remember, we have looked on the format for this. So therefore, we have to prepare that account to determine how much tax was paid during the current what? Year. So let's prepare that account here. The taxation account. Remember, you have looked on the format for this, and I've said in this account what we record is the deferred tax at the start, the current tax at what? At the start of the year, and also we record the same at the end. The deferred tax, current tax at the end. So the deferred tax and the current tax is part of the liability. So can we first of all go to where we have non-current liabilities? Yes. At the non-current liabilities, I can see we have a deferred tax at the start of 75. At the end, we have a deferred tax of what? Of 90. At the current liabilities, we have taxation. Taxation, that what in other terms we refer to as current tax at the start, 110. And then at the end of the year, this 90 is the deferred tax. The current tax at the end of the year was 15. So then we take into account the tax for the year. So can we go to where we have income statement in note number 4? In note number 4, just below the loss before tax, we have income tax repayment claim. So this is an income tax repayment claim. This is not a tax expense, but this is now what the company was claiming to be refunded by the government. So that item we basically recorded on this side, income tax what? A claim. But if it was an income tax expense, then we record it on which side? On the debit side. I hope you're together on that. So therefore the income tax claim is 14. And then below that we also have something called a deferred tax charge. A deferred tax charge, you can see there is a negative, meaning that this is a deferred tax what? Expense. And just like the income tax expense, any deferred tax expense equally is supposed to be credited in this account. How much is it? Is 15. And then from there what we do, we balance our account. And we said the balancing figure in this account, which now is on this side, that is the tax paid. That is the tax which was paid. So let's compute now the tax which was paid as a balancing figure. What do we have on the credit side? 75 plus 110 plus what? 15, which will give us 200 minus what we have on the debit side, 14, 90, and 15. Yes, so we have a balancing figure here of what? Of 81. So this particular 81, this is the tax which was paid. And that's now what we need to capture here. The tax paid during the current year was how much? Was 81. So, and these two items, the tax paid and also the finance cost paid, those are cash outflows. And then finally now here what we do, we determine the cash flows from operating activities. From operating activities. Net cash flows from operating what? Activities. So how much amount will be that? So we have negative 168. What we have there? Minus 81 minus 18. So this will give us a 267, which is basically a net cash outflows. Net what? Net cash outflows. So that's how we determine the net cash flows from what? From operating what? Activity. So having determined that, then we proceed and now we determine the cash flow from what? The investing activities and the cash flow from what? Financing activities. So let's start by determining the cash flows from investing activities. And basically this is quite simple because we have computed all the items which we need to take into account here. So what you have here to remember is that investing activities, these are activities involving what? The acquisition and disposal of asset. You take into account the asset which were acquired, the asset which were disposed, and any income from what? Investment. So I think from what we have in working one there, There was a disposal of plant, disposal of what? Of plant. And what we consider here, or what we take into account here, is what we refer as the sales proceeds. The sales proceeds. So this item was sold at how much? At 15 million, which is basically a cash inflow. Remember, you said any amount which is a cash outflow, we record it as a positive. Any amount which is a cash outflow, we record it as what? As a negative. Also, as far as the plant are concerned, we know there was acquisition. There was acquisition of what? Of a plant. The plant which were acquired had a cost of 60, which is a cash outflow. Record it as a negative. And then this will not has nothing to do with asset acquired or disposed. And then from this account for added building, we have these landed buildings which were acquired. So there was acquisition of land and buildings at a cost of 110 million, which is still a cash what? A cash outflow. So I think that's what we have. Then the other item you should also always remember to include here is any income from investment. And in our question here, I hope you can remember we had this what? Interest receivable. So interest receivable, or in other terms, you can just refer to that as interest received. So in our case, we are not going to take into account this because this is the amount which was received during the current year, simply because if you go to where we have current liabilities, you'll be able to see we have interest receivable at the start and also at the end. At the current, not at the current liabilities, at the current asset, we have interest receivable at the start and also at the end. So how do we compute the actual interest which was received during the current year? We use the same approach I've explained here for computing the interest paid. So that means we take the interest receivable at the start, which is 3 million. We add the interest for the year, which is 12, and then deduct the interest receivable at the end. So that will give you the actual amount of interest which was received during the current year. This 15 minus 5, which will give us 10. So that represent the interest, the actual interest which was received by the company during the current year. So, and I think those are the only items you're going to consider here. So what we need to do before we determine the cash flow from financing activities, so let's get the net amount. We have 15 minus 60 minus 110 plus 10. So this will give us a net cash outflow of what? Of 145. And then finally, we need to determine the cash flows from financing activities. From financing activities. And basically I've said that all the items which we include here, we get them from equity and non-current liabilities section of the statement of financial position. So can we go to where we have equity and non-current liabilities section? So we start with the equity section, and the first item there we have are ordinary shares. Ordinary shares at the start 200, at the end of the year 300. What causes the shares to increase? The issue of shares during the current financial year. So the company issued some ordinary shares during the current year, and they had a value of 100, which is now the increase. So the moment the company issues shares, the company receives money, so which is a cash inflow. Then below that we have share premium, which also increased from 0 to 60. So we have increase in share premium. The reason why share premium increases is because these shares which were issued at a premium, so which is still a cash inflow. And then below that we have revaluation reserve. Revaluation reserve, we don't consider it here because these are non-cash item. It basically these are reserve which changes because there were some assets which were revalued. The other item which we have below there is the retained earnings. Now this retained earnings is used in terms of computing the dividends which were paid. But if you can remember, in note number 6, we are given the dividends which were paid. We don't need to compute the dividends which were paid, but we just take into account the dividends paid as given in note number 5, which are 25. So basically dividends paid, these are cash outflow, recorded there as a negative. You can see all those items, we have gotten them from equity. So we then go to where we have non-current liabilities. Non-current liabilities, we have 12% loan notes, which at the start of the year were 150, at the end of the year were 0. So the reason why loan note reduces from a certain figure to 0 is because of redemption. And I hope you can remember in note number 4, there was a penalty which was incurred by the company here for redeeming this loan note early. So therefore here we can say there was a redemption of loan notes. So how much amount was paid on redemption? The amount which was paid on redemption is the principal amount, which is 150, and now to this we also include the penalty. Can you remember that penalty? Yes. You should go to note number 4. The penalty paid on early redemption was 6 million. So therefore the total amount paid by the company redeeming those particular loan notes was 156 million. Then we go back to where we have non-current liabilities, and we have 8% variable rate loan notes. And basically at the start of the year they were 0, at the end of the year they were 160. So these are loan notes which were issued. So we can say there was issue of 8% variable rates loan notes. And basically you can see the figure was, they increased by 160. So basically this is the amount which was received by the company by issuing other loan notes. So I think that's what we have. Deferred tax, we don't consider it here because we used that in terms of computing the tax which was paid. So therefore you can see all those particular figures there. We have gotten them from where we have equity and non-current liability. So what we need to do, can we get now the net cash flows from investing activities? We have 100 plus 60 minus 25 minus 156 plus 160. So that will give us 139, which is a positive. And then from there, next what we need to do is we determine something called the net changes. The net changes in cash and cash equivalent. So we determine that by adding 3 items: the net cash flow from operating, net cash flow from investing, and also what? Financing. So what do we have here? We have negative 267 minus 145 plus 139. So that will give us negative 273, negative 273. And then to this we add cash and cash equivalent at the start of the year. So in this case, when we talk about the cash here, we said we consider cash in hand, cash at bank, including bank overdraft and cash equivalent. These are short-term investments. So what we do here, we go to where we have a current assets. We take into account the items of cash and cash equivalent. So at the current asset, which items of cash and cash equivalent do we have there? First of all, we have the bank balance, which was at the start was 75. Equally, we have short-term deposit. Short-term deposit is part of cash equivalent, and I think we also given some information in respect to that in note number 5. So we have those 2 items, short-term deposit, then we have bank. Then it's also important for you to go to where we have what? We have the current liabilities. Check whether there was any overdraft. And we have an overdraft, but the overdraft at the start of the year was 0. So any overdraft, you don't add it because money which is owed to the bank, money which will have to be paid to the bank, you take it as a negative here, figure here. So this will give us a total of 195. 195, which is a positive figure. And then what we do is to get now something called what? The cash and cash equivalent at the end. Cash and cash equivalent balance carried down, which is now at the end of the year. So we need to add these 2 figures here. What we have there plus this. So we have negative 273 plus 195. Okay, negative 273 plus 195. So this will give us negative 270, negative 78, and actually this one should be the same with the cash and cash equivalent in the statement of financial position. So how do we get the cash and cash equivalent at the end of the year? We take the short-term deposit at the end of the year 32 plus now the cash, the bank balance at the end of the year 15, and then to this we less the bank OD, the bank overdraft, and the current liabilities. So whatever you get here, should be the same with that. And if that is the case, automatically we are correct. So we have 32 plus 15 minus 125. Yes, so that will give us, this will give us negative 78. And basically you can see that is the same with what we have there, Yes, so that is it, that what was required as far as that question is concerned. It was a question, an illustration question on the statement of cash flows, and basically that bring us now to the end of that particular topic. So what I need to do is maybe to give you an assignment. If you go to the past papers, specifically the paper for August 2022, financial reporting and analysis paper, and also the paper for December 2022, you'll be able to see there was a question on what? On cash flow. Make sure you attempt those two questions so that you can be able to understand this particular topic. Otherwise, we come to an end of our class. See you in our next class.
Hello and welcome to the lesson. The subject is Introduction to Law and Governance. We continue with the topic Introduction to Corporate Governance. In our previous sessions, we defined corporate governance as the way in which corporations are controlled and managed and also directed. In our today's lesson, we will study the role of stakeholders in corporate governance, in corporate governance. Candidates, we know that organizations cannot achieve their intended objectives without involvement of various stakeholders. For a company to achieve its objectives, then it requires the input of various stakeholders like the shareholders, the management, the employees, the suppliers, the customers, the government, and so on. In our today's session, we are going to study roles of stakeholders, specifically the shareholders, the directors, and the government. We will restrict our study to three stakeholders. Number one, the shareholders. Number two, the board of directors, and the government. Let's begin with the shareholders. What is the role of shareholders in corporate governance? What is the role of shareholders in corporate governance? Now, candidates, shareholders of a company, both jointly and severally, are expected to protect, preserve, and actively exercise the supreme authority of the company in general meetings. The voice of the shareholders, as far as corporate matters are concerned, is to be expressed in the general meetings. They have a duty jointly and severally to exercise supreme authority. Of course, shareholders are the owners of the company. Shareholders appoint the directors to run the affairs of the company on their behalf. So they have certain duties to perform in relation to corporate governance, which is said corporate governance is a way in which corporations are managed and directed. So what is the role of the shareholders in directing and managing a corporation? Number one, shareholders have a role to ensure that the directors who are appointed are persons that are competent and reliable, persons who can add value to the company when elected or appointed. So directors or the board of directors is a group of individuals who are appointed by the shareholders. So that is the first important role of the shareholders, to appoint the board of directors. And when appointing board of directors, the board should comprise of individuals who are competent and reliable. So when appointing the directors, the shareholders ought to ensure that the individuals who they are putting in office are people who will discharge their functions as required. They ensure that only competent and reliable persons are appointed. So their role is to ensure only competent and reliable persons or individuals are appointed to the board. To ensure only competent and reliable persons are appointed to the board. That is supreme authority of the shareholders, to ensure only competent. Competent means persons who have the required skills, persons who have the required experience. So when appointing these board of directors, they should be persons that have the relevant skills, relevant traits to discharge the functions of a director on a board. Now, the second role of shareholders in corporate governance is to ensure that the board of directors is constantly held accountable. To ensure that the board of directors are constantly held accountable, because they ought to account their responsibilities to the board. So the shareholders should ensure that the board of directors are constantly downwards, held accountable. They are constantly held responsible for the efficient and effective governance of the company. All right? Held accountable and responsible for the effective and efficient governance, right, of the company. Efficient corporate governance of the company. Corporate governance of the company. So the shareholders should ensure the board of directors are constantly held accountable and responsible for the efficient and effective corporate governance of the company. All right? What is the third role of shareholders in corporate governance? Is to change the composition of the board of directors that do not perform to expectation. Where the shareholders have appointed a board and the board is not discharging its functions as required, then the shareholders have a role to change the composition of the board of directors. To change the composition of the board of directors. To change the composition of the board of directors that does not perform to expectation, all right? That does not perform, because when the board of directors are appointed, there are certain expectations. They have certain duties that they need to perform. They have certain responsibilities. When they do not perform to the expectation of the company or the board of directors, or to the expectation or in accordance with the mandate of the corporation, then the shareholders have a duty to ensure that they are removed from the board. Where directors are not performing or discharging their functions as they ought to discharge their functions, the shareholders have the duty to ensure that they are removed from the board, so that more competent and reliable directors are appointed. Confidentiality is another role. Confidentiality. Shareholders, candidates in a limited liability company are obligated to protect and maintain the confidentiality of company secrets. Shareholders of a company, by virtue of their position, may or will come into contact, will have access to certain information that may be considered secret, company secret. And such information should not be disclosed to third parties. And therefore, the shareholders have a role to maintain confidentiality. They are obligated to protect and maintain the confidentiality of company secrets. Now let's move on to the second stakeholder. The first stakeholder is the shareholders. The second stakeholder is the board of directors. 2, what is the role of board of directors in corporate governance? Now, the board of directors exercise all the powers of the company subject to the limitations contained in the law and the memorandum and articles of association. That means that the powers or the duties or the responsibilities of the board of directors is limited to what the law says, is limited to what is contained in the memorandum and articles of association. And therefore, one of the roles of directors in relation to corporate governance, number 1, is that they exercise leadership enterprise. Exercise leadership. Board of directors exercise leadership. They do what? They exercise leadership. They are also expected to make sound judgments in directing the corporation so as to achieve continuing prosperity and to act in the best interest of the enterprise while respecting the principles of transparency and accountability. They exercise leadership, they act, they make sound judgments, and when exercising leadership, they're supposed to exhibit high levels of integrity, because these are individuals who've been entrusted with the duty to steer the company to prosperity. So exercise leadership. The second role of board of directors in corporate governance is to ensure that through a managed and effective process, board appointments are made that provide a mix of proficient directors, each of whom is able to add value and bring independent judgment to bear on the decision of the company. Independent judgment. They have a role to bring independent judgment. The board of directors exercises its functions through board meetings. When decisions are to be made, the board sits, and therefore, the directors who sit on the board are expected to bring independent judgment, which is expected to bear on the decision-making process. Independent judgment is a judgment that should be objective. Judgment should not be biased. Judgment that is in the best interest of the company. Judgment that is free of conflict of interest. The third role of board of directors in relation to corporate governance is to determine the corporation's purpose and values. Determine the corporation's purposes and value. To determine the corporation's purpose and value, to determine the strategy to achieve its purpose and also to implement its values in order to ensure it to ensure that it survives and thrives, and ensures that procedures and practices are in place that protect the corporation's assets and the reputation of the corporation. To determine the corporation's value, to determine the corporation's purposes, and to ensure that there is a strategy in place for implementation of the purposes and the values of the company. To monitor and do what? And implement. To monitor and implement. To monitor and evaluate the implementation of strategies. Monitor and evaluate implementation of strategies. First of all, the board envisions. The board envisions or comes up with what we call a picture of what the company should be in future. The board determines the strategic direction of the company. The board develops strategies, and then the strategies are to be implemented by the management on day-to-day basis. So they come up with a vision of the company, where the company ought to be and all that. They come up with strategies, but the implementation is carried out by the management. And therefore, the board will evaluate the implementation of strategies. Okay? To do what? To monitor and evaluate the implementation of strategies, the implementation of policies, and management performance. Policies and management performance. These directors are monitored by shareholders, and these directors monitor the management. So it's a very key role that the board of directors plays in corporate management, that one of evaluating the implementing of strategies, policies, and also evaluating the performance of management. Number 5, the board of directors should also ensure that the company complies with various laws to ensure compliance to various laws, regulations, and so on. Ensure that the corporation complies with all relevant laws, regulations, codes of best practices, and so on. Regulations, codes of best practice, like the one we are studying. We are studying the code of corporate governance, which is a set of guidelines on how corporations are to be managed. So the board of directors should ensure that the company complies with the laws. These are laws that are put in place by the government, the acts of parliament, the taxation laws. There are also regulations that are put in place like authorities like the capital markets authorities, the securities exchanges, and also the codes of best practice. The board ensures compliance to such laws. The next role of directors in corporate governance is to ensure that the corporation communicates with shareholders. The corporation communicates, is to ensure the corporation communicates with stakeholders. To ensure that the corporation communicates with the stakeholders and the shareholders and stakeholders effectively. Effectively. There ought to be communication. The company is required to communicate with all the stakeholders. The government, the shareholders, the financiers, the customers, and all that. There has to be proper communication because candidates, we know that the company cannot achieve or attain its objectives without the input of different stakeholders. Number 7, the board of directors serves the legal interests of the shareholders. That's another role of the board of directors, to serve the legal or the legitimate interest of the shareholders and the corporation, and also to account to them fully. Serves the legitimate, let me use the word legitimate, to serve the legitimate interest of the shareholders. They have a role to do what? To serve the legitimate interest of the shareholders. So these are seven roles. Let me add another one, 8. Regularly review processes and procedures. Board of directors have a role to regularly review processes and procedures. And why should the board regularly review and review processes and procedures? So that the board can ensure effectiveness of its internal systems of control, so that decision-making capability and the accuracy of its reporting and financial results are maintained at a high level at all times. So the processes and procedures of the company ought to be regularly reviewed by the board of directors. Number 9, appoint the CEO, Chief Executive Officer. It is the role of the board of directors to do what? To appoint the chief executive officer of the company. And they should at least also participate in the appointment of senior management to ensure the motivation and protection of intellectual capital intrinsic to the corporation. Remember, candidates, corporate governance refers to the way in which an organization is managed and directed. The chief executive officer of a company plays a key role in proper management of a company. The chief executive officer is the one who is in charge of the day-to-day operations of a company. Then, if that be the case, then the board of directors should be responsible for the appointment of such an individual. Of course, you have seen here that the board of directors develops strategy, policies that the company ought to be guided with in the process of discharging its function. They develop strategies. They give strategic direction. But the day-to-day operations of the company are left in the hands of the CEO. So this CEO ought to be a person who has the required skills, the required expertise, the necessary experience in order to steer the company to the desired end. And therefore, the board of directors should appoint the chief executive officer. And we know the chief executive officer does not work as an individual. No, there's a team of management, the management team. So the board of directors should at least participate in the appointment of senior management to ensure the motivation and protection of intellectual capital that is intrinsic to the corporation. So that is appointment, but that's not enough. The board of directors should ensure that this team of managers, these senior managers, are continuously trained. They should have continuous training, continuous training, so that they discharge their functions effectively. Appointment of the CEO and the senior management. So we can go on and on, candidates, and mention roles like that are related to technology. We can say that the board of directors ensures that technology and systems used in corporations are adequate to properly run the business. All right? So that such technology can help the company to maintain what we call competitive edge. The board of directors, you can also say, that has a role in relation to risk. The board of directors have a role to identify key risk areas. Identify key risk areas. Identify key risk areas. Identify the key risk areas and also the key performance indicators and key performance indicators. Key performance indicators of the business. And the board should not just identify, but should also do what we call monitoring. They should monitor the key performance indicators of the company. Yet another role is in relation to going concern. Going what? Concern. The board of directors should ensure annually that the corporation will survive, the corporation will thrive, and the corporation will continue as a viable going concern. as what? As a viable going concern. So these are 13 roles of board of directors in corporate governance. We are going to discuss the last stakeholder, C, the government. The first role that the government plays is legislative and regulatory. Now, government through parliament makes public policy, it legislates, and also makes what we call statutory instruments. The government creates a conducive environment for business to operate. The government regulates and comes up with what we call the statutory frameworks. And the government, through the courts, also interprets and enforces the legislation that is done through the courts or the judiciary and other national enforcement agencies. So legislative and regulatory role. Government through parliament, I've said, makes legislation, makes statutory instruments. The government creates a conducive environment for business to operate, and through making regulatory and statutory frameworks, the government can also the interpretation and the enforcement of legislation is done by the courts and other national enforcement agencies like the Kenya Police and other such bodies. So legislation ensures fairness, legislation ensures a level playing field, legislation ensures transparency in business dealings, and that is very important. It's an important tenet of corporate governance. Transparency, disclosure and transparency is a key component, is a key tenet of good corporate governance. Through legislation, we know the government can, for example, determine what kind of financial records are to be published, right? We know candidates that the company law provides for the financial statements that the public limited companies ought to make public, to disclose. That's a legal requirement. And transparency and disclosure, those are important tenets of good corporate governance. So the first role is legislative and regulatory. To legislate and to regulate. And by legislating and regulating, the government creates a conducive environment for business to operate. Is that clear, candidates? The second role of government in corporate governance is a monitoring role. Monitoring. Monitoring what? Monitoring. The government ensures that there is fair play in business through monitoring. How does that happen? The government oversees and monitors organizations such as the Securities Exchange Commission, the Stock Exchange, and other financial institutions. Another role that the government plays is an overall role, or what we can call an overarching role. The government provides an enabling environment within which the private sector can thrive. The government is responsible for example, for providing basic what I call basic security. The government, through the public law, maintains order. The government ensures the protection of private property. And it also has an obligation to protect the vulnerable members of the society. All right? Overarching role. Let me call it overarching role. The government has an overarching role. It provides a general basic security, it provides a law, it provides order, it helps in the protection of property, and so on. The fourth important role that is played by the government is that one of solving disputes. Solving disputes, and when disputes are solved, then justice is ensured and ensures justice. And where there is justice, candidates, there is most likely to be peace. So the government helps to bring justice in corporate leaders, because corporate leaders who are from time to time involved in scandals. The government does what? Solves disputes among the corporate leaders, disputes between companies, disputes that may arise because of financial scandals, because of fraud. And the government can also help gather enough evidence against the corporate leaders who are involved or who are involved in scandals. The government can gather enough incriminating evidence against such individuals, and that is a very important role in corporate governance. Justice. The government does what? Ensures justice. So these are four roles that are played by the government in corporate governance. And that will mark the end of our today's lesson, where we've discussed the role of stakeholders in corporate governance. The syllabus restricted us to study the three stakeholders, that is the shareholders, the board of directors, and the government. Today we have learned that the shareholders ensure only competent and reliable persons are appointed to the board. We also learned that shareholders ensures that the board of directors are constantly held accountable and responsible for the effective and efficient corporate governance of the company. Efficient, good corporate governance of the company. The third role played by shareholders is that they help change the composition of the board that does not perform to expectation. In case there are directors who sit on the board who do not perform their duties as expected, then the shareholders have a role to remove them from the board. There is also the role in relation to confidentiality. Shareholders are under obligation to maintain information that is considered secret. The company secret should be protected by the shareholders of the company. We went ahead in this lesson to discuss the role that is played by the board of directors in corporate governance. We saw that board of directors exercise leadership, they bring independent judgment, they determine the corporation's purpose and value, they monitor and evaluate implementation of strategies, policies, and management performance. The board of directors also ensures compliance to various laws, regulations, and calls of best practice. The board of directors communicates with stakeholders efficiently. Number 7, they serve the legitimate interest of the shareholders. Number 8, they regularly review processes and procedures. They also have a role to appoint the chief executive officer. And number 10, they identify key risk areas and key performance indicators. Then there is a role in relation to going concern. We've also discussed the role that the government plays in corporate governance. The first is the legislative role and regulatory role, the monitoring role, the overarching role, and the role of solving disputes and ensures justice. The government helps to bring justice in corporate leaders who are involved in scandals, who are done what? Who are involved in scandals. So candidates, I'll leave you with an assignment based on what we have studied today. Discuss the role of the following stakeholders in corporate governance: A, shareholders; B, board of directors; C, the government. Thank you for taking time to attend today's lesson. When answering this question, close the notes, close the video, try and see if you can recall what you have learned in today's lesson from your memory. God bless you. Bye-bye. Greetings and welcome back to the lesson. The subject is Introduction to Law and Governance. We today going to study compliance obligations. But first of all, we define compliance. Now, compliance, candidate, is the act of adhering to and the ability to demonstrate adherence to mandatory requirements. The law requires companies to do certain things or not to do certain things. So the act of obeying the laws, the act of obeying the regulations is what is known as compliance. The act of adhering to mandated requirements that are defined by law, that are defined by regulations, as well as voluntary requirements resulting from contractual obligations and also internal policies of the company. And compliance mainly operates at two levels. One is compliance with the external rules that are imposed upon an organization as a whole. Then the second level of compliance is compliance with internal systems of control that are imposed to achieve compliance with the externally imposed rules. So compliance can be seen from two levels or two perspectives. That is the compliance with the external rules, then compliance with the internal rules or regulations or internal systems of control. Now, candidates, compliant organizations need an effective approach to verify that they are in conformity with the external standards or regulations and also internal policies. A company that complies, what I'm calling a compliant company, needs an effective approach. There has to be a system in place to verify that the company is adhering to rules and regulations. There has to be an approach because we know, candidates, companies operate within a certain legal environment. Companies are expected to adhere to many laws. Many laws have to be adhered to. So it's important for an organization to have a system or an approach which can help the company in verifying if the rules are being adhered to. And such an approach or a system is assisted by what we call risk management. Risk management, which must identify and prioritize risks that are already aligned with corporate objectives defined by governance. So compliance with law and regulation must be managed as an integral part of any corporate strategy. And the board of directors and management must recognize the scope and implications of laws and regulations that apply to the company. They must establish a compliance management system. Compliance management system. Compliance management system. There has to be a system in place to verify that the company is adhering to rules and regulations. And that's the role of the board. The board and the management as well must recognize the scope and implications of laws, the scope and implications of regulations that apply to the company. They must establish a compliance management system. And this compliance management system is a system that helps support the risk management system. Because when a compliance management system is put in place and there is a risk management system that is also put in place, that reduces compliance risk to a great extent. Compliance risk management, compliance risk candidates is the risk that the company or the risk that the company may face as a result of failing to adhere to regulations and laws. And to ensure an effective approach to compliance, the participation of senior management in development and the management of compliance program is necessary. They should review the effectiveness of its compliance management system at periodic intervals, so as to ensure that it remains updated, so as to ensure that it remains relevant in terms of modifications, in terms of changes in the regulatory regime, including acts, rules, regulations, and so on. And also due to changes in the business environment. Compliance what? Obligation. So in today's lesson, candidates, we will study the approaches of compliance. We are going to study 3 approaches or aspects of compliance. Aspects of compliance. The first aspect is legal compliance. The second aspect is corporate compliance. Legal compliance, corporate compliance, and also the third one is regulatory compliance. Regulatory what? Regulatory compliance. 3 aspects. Now, legal compliance, candidates, is the process of, or the procedure to, to ensure that the procedure that the company puts in place to ensure that the organization follows relevant laws, relevant regulations, relevant business rules, and so on. Legal compliance, I repeat, is the process or the procedure to ensure that an organization follows relevant laws regulations and business rules. Okay. Failure to which will failure to ensuring that the company complies to laws and regulations and business rules, then there is that what we call a compliance risk. All right. There has to be an approach or a process through which the organization checks or verifies that the company is obeying or adhering to regulations, adhering to laws, adhering to business rules. And there are two requirements for an enterprise to be compliant with the law. That is we may have the policies, all right, the organization's policies, and that need to be consistent with the law. Then we also have its policies that need to complete with the respect to law. So there are two aspects: the policies that ought to be aligned with the law, and also its policies that need to be complete with respect to the law. So the role of legal compliance has also been expanded to include self-monitoring. To include what? To include self-monitoring and the monitoring of the non-governed behavior. And that is mostly in respect to industries and also corporations that could lead to workplace indiscretions. So there are certain aspects that are not regulated, but which could lead to risks. The organization should ensure that such areas are also looked into. So the role of legal compliance, I'm saying, has been expanded not only to laws, explicit laws, but also the non-governed areas with the industry and corporations that could lead to problems at the workplace. And it is also important to keep in mind that if a strong legal governance component is in place, then risk can be accurately assessed and the monitoring of legal compliance can be carried out efficiently. And therefore, companies today are challenged to comply with laws and regulations while also increasing shareholder value and protecting the brand of the company. Legal compliance with laws, regulations, and business rules, now expanded to cover areas that are not regulated. Then there is corporate compliance, Now, corporate compliance program, on the other hand, is generally defined as a formal program specifying an organization's policies, procedures, and actions within a process, to help prevent and detect violations of laws and regulations. So this is limited to a certain process within the organization. And it goes beyond a corporate code of conduct, since it is an operational program. It's not just a code of conduct. No, it is a program. It is a program. It could be a program that is used in carrying out a certain operation, or what we can just call an operational program. It's not just adhering to a code of expected ethical behavior, no. Because clearly, candidates, a code of conduct is an important component of compliance program and ethics, which remains the heart and the soul of all corporate compliance programs. However, a comprehensive program goes further by applying the code to the specific risks of organizations and also integrating measures to address those risks. So a more integrated approach also focuses on legal as well as internal compliance to mitigate the risks of fraud, to mitigate areas to do with strategy, operations, the financial reporting objectives, and so on. So a corporate compliance program is a magnet that brings all of a company's regulatory and internal compliance requirements, as well as a roadmap to action. A roadmap to what? To action. It is a comprehensive program that helps position a company to divert disasters, to meet objectives, and grow shareholder value. Corporate compliance. Then the other aspect of compliance is a regulatory compliance. Regulatory compliance. Now, candidates, regulatory compliance is an organization's adherence to laws, regulations, guidelines, and specifications that are relevant to its business. And violations of regulatory compliance regulations often result into what we call legal punishment, including penalties, including fines, and such like. So regulatory compliance has become more prominent in a variety of organizations today. And we have seen the trend towards creation of positions within the company, like the chief regulatory compliance officer. Such a position is used to hire employees whose sole focus is to make sure that the organization conforms to stringent, complex legal mandates. So regulatory compliance varies not only by industry, but also by location. And the financial, the research, the regulatory structures in one country, for example, may be similar, but with particular difference in another country. So there could be similarities and differences, which often lead to changing of objectives, changing of requirements in different countries, in different industries, and also different policy contexts. So regulatory compliance, we have bodies that regulate the conduct of companies, like the stock exchanges. They have regulations. We have capital markets authorities. They regulate certain industries. So each industry could have some bodies that put in place measures or laws that companies within that industry should adhere to. Legal compliance, on the other hand, mainly these are laws that are put in place by the government through statutes, statutory instruments, and so on. So these are three major aspects of compliance: legal compliance, corporate compliance, and regulatory compliance. So that will mark the end of the lesson. I'm going to give you one question. Explain assignment. Explain the following aspects of compliance in the context of corporate governance. A, legal compliance. B, corporate compliance. C, regulatory compliance. Thank you for attending today's session. Bye-bye. Hi everyone, and welcome to the economics learning session. We will continue with the topic agriculture and industry. In today's session, we will study the obstacles to industrial development, in developing countries, obstacles to economic development. what are the barriers to economic development in developing countries. By the end of this lesson, you should be in a position to discuss the barriers to economic development in developing countries. The first barrier is debt. Number one is the public debt, or what we call government debt. Countries that are developing are characterized by high levels of public debt. The major projects candidates are financed, we know, by the national and international sources. The interest rates and terms of loans mainly favor the foreign donors. Government debts also expose the country to economic leakages. For instance, the multi-billion projects that are financed by foreign entities enable them to repatriate the profits to their countries. So you find that there is what we call capital flight, or money being repatriated back to the donor country. So that's a barrier to economic development, the government debt. So the next obstacle number 2 is poverty and inequality. Poverty and inequality. Poverty and inequality. Developing countries are countries of extreme contrast. The gap between the rich and the poor is, I can say, unforgiving, or it is too wide. So the low per capita income translates to low voluntary savings, extending to what we call the vicious circle of poverty. And the majority of rural population are poor due to policies that deprive them of factors of production such as land, such as capital, and so on. So poverty and inequality is an obstacle to economic development. You cannot develop economically if there are no savings. And if the majority of the people are poor, they may not have anything to save in order to invest in economic development. The third barrier is population. Population. How is population a barrier to economic development? Now, candidates, scarce capital is shared in supplying a large quantity of tools over a large population without raising per capita productivity. So the rapidly growing labor force cannot find jobs in the rural areas, hence their movement to the urban centers. And as time passes, open and disguised unemployment is rife. Increased unemployment candidates means increase in crime and also increase in insecurity. So high populations in developing countries is an obstacle to economic development, right? That's a barrier to economic development. Over-reliance on agriculture, over-reliance on agriculture. The developing countries rely heavily on agriculture, and domestic resources we know may be insufficient. So things like severe droughts, poor government policies, deforestation, and other human-induced factors have rebuffed development of the economy in developing countries, and more so, the development of the agriculture sector. So population increase and high food prices coupled with lack of arable land is a problem to many citizens, because in developing countries, we saw earlier that their mainstream is agriculture, and they heavily rely on agriculture to produce food and to produce surplus for economic development. So population increase and high food prices, I've said, coupled with lack of arable land is a problem. Why? Because the majority of the people rely on agriculture, which is the cultivation of land and the rearing of animals. Agriculture is the cultivation of land to produce crops and rearing of animals. If 80%, for instance, of the population rely on agriculture, then there is a lot of pressure on the factors of production. So the country allocates plenty resources in improving nourishment instead of investment in economic development. Number 5, foreign exchange gap. Foreign exchange gap. Now, candidates, foreign exchange enables countries to import capital goods, and unstable microeconomics affects investor confidence. So most developed countries have employed various protectionist policies that make it difficult for developing countries to freely export her goods. So the developing countries they've somehow protected their home industry so that the developing countries are unable to export to such countries, thereby creating a foreign exchange gap. And that becomes an obstacle to economic development. Earlier on, we said the ideal situation is that a country should produce for its own consumption and surplus for export. But sometimes the developed countries, they employ various protectionist policies that make it difficult for the developing countries to freely export, and that hinders economic development. Next, insecurity and political instability. Insecurity and political instability. Now, candidates, businesses have not been performing well in developing countries because of insecurity as well as political instability. For example, we've seen here in Kenya, the tourism sector, which is struggling despite being a large source of foreign exchange. And the vicious circle of political instability is observed every electioneering period. And usually the economic activities slag the year preceding and succeeding the general elections. So investors become reluctant. Okay? And there are investors who even withdraw the investments, and that affects economic development. As we are speaking, there are more than 10 countries in Africa that are politically unstable. They are fighting. So in such an environment, then the economy cannot develop. So economic development is hindered by insecurity and political instability in developing countries. Education, poor education. And related to education, there is the human resource. Okay, poor education, and let me say, and human resource constraints. Poor education and human resource constraint is another obstacle to economic development. Majority of population in developing countries is not well educated or trained. And the most affected in developing countries are women and the rural population. So without proper education and without proper human resource development, a country cannot grow economically. I'm not saying people have not gone to school in developing countries. I'm saying people are not properly trained. You may find there is a gap between the curriculum for training and job market requirements. What the job requires is not what is being produced by the training institutions. So there is that constraint. And if there is no proper human resource, then that can be a barrier to economic development. Corruption is another obstacle. Corruption. Corruption. Related to corruption is poor governance. And this poor governance can be at the corporate level or even at the national level. Political leaders have no interest in may have no interest in the welfare of the citizens, and unethical officials may also misuse the authority for their own selfish interests. The industrialists also join politics to secure the industries, while the nobles, what we call nobles, are interested in status. So they may be interested in status and just money and power. And there are, in developing countries, regular economic crimes and scandals that hinder development. So candidates' corruption, favoritism, nepotism befoul every post-colonial regime, and poor governance, poor performance is also rampant in both private and public companies. And it seems in developing countries, no one takes any responsibility. All that hinders economic development. Another point, number 9, research and development. How is research and development an obstacle? Here we are discussing failure to invest in research and development, where a country fails to invest in research and development, then that becomes an obstacle to economic development. Countries that have are well developed economically are countries that invest in research and development. Research involves finding new ways of doing things. Research involves innovation. It involves coming up with the new methods, new procedures on production and in industrialization. Where a company fails to invest in research and development in relation to industrialization, then there can be no economic development. So failure to research and develop will lead to becomes an obstacle or a barrier to economic development. So these are some of the obstacles. They are not the only obstacles. One, we've mentioned the public debt. Public debt is a barrier to economic development. Poverty and inequality is another obstacle. Population, where the population increases and there is no corresponding ways of maybe having increasing the per capita income, that becomes the pressure, population pressure may force a company or a country not to economically grow because of pressure on the factors of production, because high population require a country to have sufficient supplies of food, to have sufficient opportunities for employment and so on. Another one is over-reliance on agriculture. We explained foreign exchange gap, insecurity and political instability is a barrier. Poor education and human resource constraint is another barrier to economic development. Explained corruption and governance, poor governance. I've explained how poor governance and corruption can hinder economic development. Then lastly, research and development. I'll give you one question based on what we've learned today. This is your assignment. Examine 5 barriers to economic development in developing countries. That is your today's homework. When answering the question, try and practice active recall. Do not refer to the notes. Try and see if you can recall the points from your memory. Thank you. I hope to meet you in our next session, where we will study the policies to enhance industrial development in developing countries. Bye-bye.
Hello learners, welcome to Manifested Publishers e-learning portal. My name is Celestine Wandabusi. In our today's session, we are looking at a revision of Management Accounting April 2022. I just urge you to follow closely. Make sure you have your calculator with you so that we move together. Welcome. So I'm beginning with question number 1, part A. The question reads, cost accounting uses information provided by financial accounting together with other details of internal operations of an organization. With the reference to the above statement, describe 3 similarities between cost accounting and financial accounting. So we want to look at what are the similarities between cost accounting and management accounting. Number 1, we have periodicity of reporting. 2, accuracy is maintained in both systems. 3, the results of the business is revealed in both systems. 4, vouchers and we have vouchers and invoices. forms the basis for recording of transactions, for recording business transactions. Number 5, we have fundamental principles of double entry is maintained in both systems. So these are some of the similarities between cost accounting and financial accounting. We have periodicity of reporting. In cost accounting, periodicity is more frequent than in financial accounting, where in financial accounting we have reporting done either semi-annually or yearly. But in cost accounting, it may be done weekly, monthly, or on yearly basis. But in both systems, we have that periodicity of reporting. Then we have accuracy of accounts being maintained. In both systems, we ensure that there is no biasness, there are no mistakes, errors, or omissions. So accuracy is maintained in both systems. Then number 3, we have results of the business revealed. The intention is simply to know whether there is any profit or loss being made, or to know the financial position of the business. And therefore, in both systems, we have results of the business being revealed. Note number 4, vouchers and invoices form the basis for recording of business transactions. They form as part of the books of books of subsidiary entries, which help in like creation of any other account. So we apply that in both systems. Number 5, we have fundamental principles of double entry. Whenever we are passing entries in both systems, double entry principle must be applied. So those are the similarities in the two systems. We move on to part B of the question. We are told that Rengo Limited has provided the following data for the financial year 2022. Number 1, we have budgeted output for the year, which was 9,800 units. Note 2, we have standard details for 1 unit. Under that, we have direct materials, we have direct labor costs. We've been given variable overheads and fixed overheads. So required, prepare a standard cost statement of unit, cost showing prime cost, Roman 2, variable production cost, Roman number 3, total cost, and Roman number 4, selling price per unit at a notion profit of 15% on cost. For you to be able to answer this question, you need to understand what you need to consider, especially pertaining the data that you've been provided with. The question requires you to compute the total cost, but in that total cost, you need to show the subtitles. Prime cost, show the variable production cost, the total cost, and the latter show the selling price. So the best way of answering this question is simply preparing what we refer to as the cost sheet, which will enable you to show all the costs incurred, get the total cost, and then show the selling price. So this will be computed as follows. This is Rengo Limited. Note number 2, we are told that standard details for 1 unit, direct materials is 4 square meters at 530. So to know the amount for that particular, for the raw materials, we are simply taking that quantity and then you multiply by the price. So we'll have 40 meters times the price, which is 250, which gives us 10,000. Then we have direct labor. We are told this was incurred in 2 departments, so we have bonding cost center The quantity is 48 hours. You multiply by the price per hour, which is 250. Sorry, this should be 530, not 250, 530. So we calculate this. This should be 21,200. This is 12,000. Still under direct labor, we also had another department which is finishing cost center. The hours used were 30 hours and the price per hour is 190. So you simply multiply 30 hours times 190, which will give us 5,700. So add this. This is 17,700. In our part 1, we were required to show the prime cost. You now show the prime cost. Prime cost is simply the total of direct materials, direct labor, and direct expenses. So since we do not have direct expenses, the total prime cost will simply be direct materials plus direct labor. So this will amount to 38,900. So you've already answered part 1. In Roman number 2, you are told to calculate the variable production cost. So we now calculate variable production cost. When you look at note number 3, we are told that budgeted costs and hours per annum. Variable overhead, you've been given hours, and then we have shillings. So we have bonding cost center. Hours were 500,000 and the amount is 3,750,000. So we have not been given the cost per unit. For you to calculate the cost per unit, we do what we refer to as calculation of an absorption rate, which is simply based on the cost that is given divided by the number of hours that have been given, and that will give you the cost per unit. And therefore, in the bonding cost center, to calculate the cost per unit, you are simply taking 3,750,000. Then you divide that by 500 hours. You divide that by 500,000 hours. And then we were told that it is related to direct labor. So the direct labor hours that were incurred in the bonding cost center were 48 hours. So once you get the cost per unit, you now multiply by the number of hours that were incurred in that particular department. And this will give us the cost per unit for that center. So when you calculate, you will get 360. You do the same for finishing cost center. For cost finishing, we have 1,500,000 shillings. We are dividing by 300 hours to get the cost per unit. Then you multiply by the number of hours that were incurred in the finishing department, which was 30 hours. This will give us 150. Then you get the total. And this is 510. And that's part 2 or Roman 2 of that question, variable production cost. Then we move on to Roman 3. We are to compute the total cost. Still on that note number 3, we were given fixed overheads. So we are to calculate the fixed overheads. And under the fixed overheads, we've been given the amount for production. And remember, in note number 1, we were told that budgeted output for the year was 9,800 units. So to get the cost per unit, you are to take the production amount of 39,200,000. Divide this by the number of units that were produced, which is 9,800 units. Then multiply that. Sorry, we don't need to multiply, and get the cost per unit. So calculate that. This will give us 4,000 shillings. We also have selling and distribution, fixed overheads, and the amount is 19,600,000. Divide this by the number of units that were produced, which is 9,800 units. Then divide that. So this will give us 2,000. And then lastly, we have administration. Administration overheads, the amount is 9,800,000. Divided by the units of output to get the cost per unit. And this will give us 1,000. Then get the total, which will give us the total cost. So we are adding from 38,900 plus 510 plus 4 plus 5,000 plus 5,000, which will give us 44,410. So that is the total cost. In Roman number 4, the question requires us to calculate the selling price per unit at a notion profit of 15% of cost. 15% of cost. So we already have the total cost of 44,410. We need to calculate profit, which we are told it is 15% of the cost. So calculate 15% of 44,410, which will give you 6,662. And then from there we now get the selling price, which is now the total of the cost plus the profit. And this will give us 51,071.5. This will be the selling price. So that's how you are to answer part B of question number 1. We proceed on to to part C of the same question. We are told that Jumbo Limited manufactures bracelets for export trade. The sales revenue is dependent on level of advertising expenditure per month. The company has recorded the following sales information for the past 6 months. So we've been given the information about advertising expenditure and sales revenue. And then we are told that the following has been calculated. So you don't need to calculate, the figures have already been given. Then required, estimate fixed and variable elements of the sales revenue using the least square regression analysis. To use least square regression analysis, you need to know how to determine the values of A and B. And therefore, we have a formula which we use to calculate the values of A and B. So the regression formula is as follows. Sum of y equals NA plus B sum of x, and sum of xy equals A sum of x plus B sum of x squared. So these are simultaneous equations which must be solved together, and the intention is simply to find the values of A and B. So we have already been given information. We are told in that question that sales revenue is dependent on the level of advertising. Whenever you are answering this question, always be able to identify the independent and dependent variable. So the question has already interpreted for you what is the dependent variable and what is the independent variable. We have advertising expenditure and sales revenue. You've been told that sales revenue is dependent, meaning the sales revenue is our y variable, which is the dependent variable, and advertisement is the x variable, which is the independent variable. Under that table, you've been given the values. So what we need is sum of y. Remember, we are saying that sales revenue is the dependent variable, and dependent variable is abbreviated by y. So sum of sales revenue is given as 192,000. So just reduce the zeros based on the table that we've been given above. So we'll have 192 shillings equal to, N is referring to the number of observations or items that we have, which are already listed, and there are 6. So we have 6A plus sum of x. What is the sum of x? X is referring to independent variable, which is advertisement. You are given sum of advertising expenditure, which is 13.5. 13.5b. So this will become our first equation. Then we move on to equation number 2. We have xy, which is referring to advertising expenditure times the sales revenue, which again we've already been given. So this is 147,000.25 equals sum of x, that is sum of advertisement, is 13.5a plus sum of x squared, that is advertisement expenditure squared, which is 32.125b, and this will become our second equation. So from there we solve the equation simultaneously. We want to eliminate a. So to eliminate a, we must make values at a equal. To make equal, simply cross multiply. We have line 1 being multiplied by 13.5, multiply line 2 by 6. And remember that 6 and 13.5 is affecting all other values. So you multiply 192 times 13.5, which will give us 2,592. These are shillings, equals 6 multiplied by 13.5. This is 81a plus 13.5 squared. This is 182.25b. Do the same for the second line. We are multiplying all the figures by 6. So 147.25 times 6. This is 883.5, which will equal to 13.5 times 6 will give us 81A plus times 6. So this times this will give us 192.75B. Then you subtract. We are using elimination method. Subtract the values. So we are using elimination method. This should be 447, not 147. So 447.25 multiplied by 6 gives us 2,684. So we then subtract the figures. 2592 minus 2684. This will give us negative 92, which will be equal to, this is a 0. Then 182.25 minus 192.75 will give us negative 10.5B. From there, our intention is to find the value of B. So we divide both sides by negative 10.5. Divide both sides by negative 10.5. So B will be equal to it will be equal to 8.76. 8.76. So once we find the value of B, we now use that to calculate the value of A. So regression analysis equation is in the form of y equals A plus bx. And so for us to find this A, we are to use the first equation because it has smaller figures. So we'll have 192 equals 6A plus 13.5. We already have the value of B. Replace that with 8.76. Then you solve it. So we have 192 minus 118.25 equals 6A. So 73.74 equals 6A. Then we divide both sides by 6. Therefore, A will be equal to 12.29. And that is the value of A. So the question simply required us to find the value of fixed and variable elements of the sales revenue. So what are the fixed? In this equation, y equals A plus bx. A is referring to the constant, which is the fixed cost, and B is the variable cost. So we've already calculated the value of A and the value of B. So B is the variable cost and A is B is the variable cost per unit and A is the fixed cost. And that is what was required in that question. Thank you and bye-bye.
Ladies and gentlemen, we are discussing about the financial modeling and data analytics paper, which came in April 2023. The question in focus is question 22. It reads as follows. Let's read together. As a senior financial analyst at Wema Capital, you have been tasked by the Chief Investment Manager to develop a financial model for a new startup company that plans to manufacture and sell electric bikes components in the country. The following information is provided. Number one, the company is expected to produce 1,000 units annually, 1 million units annually, pardon me. Number two, the unit selling price is expected to be 18.5 in 2024. The unit selling price is expected to increase by 5% annually. Number four, the cost of goods sold percentage of revenue is 42%. The salaries and benefits expense as a percentage of revenue is 17%. The annual rent and overhead expenses are 500,000. Number seven, depreciation and amortization percentage of property, plant and equipment or PPE is 25%. The interest rate percentage of debt is 10%. The applicable tax rate is 30%. Number 10, the accounts receivable days is 30. The inventory, number 11, days is 14. Number 12, the accounts payable in days is 30. Number 13, capital expenditures in year 0 is percentage of 15 million. It will be funded by debt issuance of 5 million and equity of 10 million. Required. Using Excel, A, prepare the following financial statements. Number one, the statement of profit and loss for the 5-year period. Number two, the statement of financial position for the 5-year period. Number three, the cash flow statement for the company for the 5-year period. B, we are told, undertake an analysis and compute the following financial ratios for the 5 years. Number one, profitability, that is the return on assets, return on equity, and net profit margin ratio. Number two, liquidity, current ratio, and quick ratio. So ladies and gentlemen, we can start solving this question on the on your right hand side over here of the screen. You can see the solution. So we move to the right over here and we start by creating the income statement or developing the income statement. So before we develop the income statement, the assumptions need to be created. So we write over here assumptions. What are these assumptions? The assumptions are provided to you right over here. And these assumptions will guide the 3 statements which you've been told to answer right down over here in part A. Statement of profit and loss, statement of financial position for the 5-year period, cash flow statement for the 5-year period. So we need the assumptions tab. And under the assumptions, we start now identifying the revenue growth rate over here. So we start by identifying, so you can bold this, Control B, there, that. And then here, we can start with revenue growth. That. The revenue growth will be moving for how many years? We're starting from year 2023 because we're assuming that that's the current year over here. So then we'll go now 2024 and moving ahead like that. So we put in the years right here. So 2023, 23 like that. Then we move on over here plus that one plus 1, 2024. And then we can go up to plus 5 years up to 2028. Just drag it like that. There. This, we can put it in bold, Control B, straight out like that, so it can be able to indicate the years there. So what have we been told for the revenue growth? We're saying the unit selling price is expected, or the sales or the revenue is expected to increase by 5% annually. Yeah. So we just put in terms of revenue growth in terms of right over here screen, we just put 5%. So first of all, like this, we highlight this section here, put percent. You can see percent is here, and you just put 5 like that. So the ones we've modeled the growth rate, come up with assumptions for the growth rate over here, then we identify, of course, we can be able to now just say that that one is already done. Here we can perhaps maybe put it in red, but we'll put it in red when we develop now the income statement. And we've actually actualized the 5% annual growth. The next item is the units produced. The units produced, you can see, is right over here, note number 1 here. So you can write towards the right over here, units produced. Units produced. And with the units produced over there, we are saying that it's going to be 1 million. It's going to remain constant as at 1 million over here. So that. And of course, because we're going to put the comma format, come right over there, put the comma format. The accounting way of doing it, the financial analyst way of doing it is for it to have V0s like that. So just press Shift, Control R. It actually represents over here. And we're saying that this needs to be spread out very well. So you highlight and then you double click. That comes out like that. That is units produced. Then we can proceed on to compute the cost of goods sold. Or the unit selling price is 18.5. You can put selling price, unit selling price, and it's 18.5. Remember, it is for the year. Remember, for year 2023, we may not have been given over here. But you're seeing from year 2024, the revenue growth should actually be, from 2024 should be 5% and 1 million. So these ones should not be able to exceed. But in terms of the number of units not produced, but you're saying that the unit selling price in year 2024 is 18.5. So that one, we should be able to include it right over here, 18.5, unit selling price. Selling price. Unit selling price. But here is 18.5. That. So we move ahead and we've already modeled these three right over here. The cost of goods sold, we need to model that. So we'll come up with assumptions. The cost of goods sold as a percentage of revenue is 42%. So we are saying it's going to be 42% moving ahead. So the cost of goods sold percentage of revenue, 42% there. So say COGS goods sold like that. So we're saying here it is G, the G should be small letters. Why? Consistency. That. So cost of goods sold, here we've been told that it, for 2024 is 42%. It should be 42%. So we put percent here, 42%. But we haven't been told whether it's going to remain constant right over there. That's now what we need to try and be able to identify there. So after that, the salaries and benefits expense as a percentage of revenue is 17%. So 17% remains constant, salaries and benefits. Fees and benefits. That, just double click here, sort of like that. And we see it's 17%. Like that. But my assumption is the cost of goods sold, should remain constant like that. It only makes sense like that, so I'll just model it like that. The salaries and benefits should also be 17% across. They would have told us if there was any change in the cost of goods sold as well as the salaries and benefits. So here we're told is 17%. 17, I'll first of all put the sign like that. Here, then we just put it sort of like that. Salaries and benefits. Let's move on to the next item under the assumptions tab. So we've done those ones there. So the annual rent and overheads is going to be 500,000. That's annual, 500,000. Rent and overheads. And overheads. That is 500,000. And here it's not percent, so we put the comma format like that, 500,000. That, and we don't want it like that. We just want it to be, flat figure. That, and we just drag. So once we have the rent and overheads given to us there, the assumptions section, then we can move back to the question and identify the next item, which we're saying is depreciation and amortization. And this one is based on the percentage of PPE or percentage of pre-PE. So we come over here like this. And amortization. Like that, then put in brackets percentage of PPE that. You're saying it's going to be how much, so we double click it like this. But here is, we can go back, let me just find out, it's 25%. So if it's 25%, so here we're saying it's going to be 25. But here remember, we need to sort of put it, so 25. And we shift, Control R, that's the assumption. We've not been told anything about the changing value of, depreciation and amortization in the terms of this rate. So next item, number 8 here, the interest rate as a percentage of debt is 10%. Interest. Sorry, pardon my spelling, interest. And you put in brackets over here, percentage of debt. Like so. Here we put it for consistency of PPE. Rent and overheads. So salaries, if I remember, let me just try and focus on it. Percentage of revenue. Yes, it should be percentage of revenue. And what else? Percentage of revenue. Let's see, cost of goods sold. Yeah, that's the cost of goods sold. Yeah, so it's percentage. Both of these, the cost of goods sold and salaries is percentage of revenue. That. So here I can say salaries, percentage of revenue. Shift percentage of revenue. That. This D should be capital. Right. And then this should also be the same. So this item should be copied. Percentage of revenue, like that. Oops. Percentage of revenue, copy. Percentage of revenue, close the brackets. Move on like that. Close the brackets. So once we have the interest on debt given to us there, we need to put in the values moving across over here. So the interest on debt, let me just try and recall right here. Note number 8, interest on debt, percentage of debt is 10%. So we put 10% moving across. Percent, and then Control R, like so. The next item is the tax rate. Should be 30%, flat figure there, tax rate. is of course going to be as a percentage of earnings, yeah. Percentage of earnings. Earnings, that. So here, percentage of earnings should be 30%. We've been told 30%. 30, that. Then we sort of undo that. Control R. That's the tax rate. Then now we've been told something else about now the balance sheet items. I believe so. Yes, we've been told the balance sheet items in terms of the accounts receivable right over here. So the accounts receivable. Accounts receivable. And this should be in days. What have we been told? Let's go to the assumptions. The question itself. Accounts receivable note number 10 is 30. The days is 30. So it should remain constant like that. So 30 days. This is not percentage. So we need to put the comma format. That's we put 30 now. That. And of course, we do not want it in like that. So shift that. Next item is inventory. Days is 14. Inventory days. Brackets days. And as usual, percentage like that we do not want. So we want to copy the format. Come to format painter. Come right there. Put it like so. So we put 14. Then we fill it in. Control R. So we're moving along. Inventory is 14. The accounts payable and capex has also been given to us there. Accounts payable. Payable. This is of course in days. So we've been told the days, how much, just to confirm. Note number 12, the accounts payable days is 30. It's 30. 30. So the comma format. 30, like that. Once we have the 30 there, we can then develop our assumptions for capex. Year 0 is 15 million. So 15 million. Capex. Capital expenditures. Capital expenditures. Here, what have we been told in year 0? Capital expenditure in year 0 is a percentage, and we're told it's 15 million. 15 million. It will be funded by debt issuance 5 million and equity 10 million. So total of these 5 and 10 should be 15 million. So we can now say that debt issuance it could be either issuance or repayment. When you repay debt, it becomes a negative value. When you are issuing, it becomes a positive value. So debt issuance should be positive, debt repayment should be negative over there. And then you've been told equity Then we're saying equity is either issued or repaid. Repaid. So here capital expenditures, just to confirm, 15 million. So this is 15 million capex. So here should be 15 million. Because we've been told here 0. This is 2023, 15. It's 15 million, like that. So we just put the comma format, reduce the zeros. And then it will be financed by debt issuance 5 million and the equity 10 million. So debt issuance 5 million. And then here 10, that. So we have that given to us there. And what we can do now, because we have strict financial experts, we need to put the inputs to be in blue over here. So all our assumptions here should be in blue. So what we do, we just come over here, drop down window here, not this blue over here, let's go to more colors. Come over there, and we can be able to select a color such as that one there. Then we say, okay. That shows that those do not have formulae. You can change these values because these values will be tied towards the income statement. Now we come and develop down over here with your permission. Once we have the assumptions here, we can maybe perhaps decide to put it up to there to show that that's the maximum point where we are reaching. So we can put it in a different color over here and put it maybe say in a color such as that color there, faint blue, like that. Then we come down. After the assumptions, we can come down and answer the first part of the question. Prepare the following financial statements. Part A, the statement of profit and loss for the 5-year period, statement of financial position for the 5-year period, and statement of cash flow statement, and the cash flow statement for the company for the 5-year period. So we are going to do all the three. So statement of profit and loss is the first thing that we are going to do. And we start of profit and loss, of profit and loss. Profit and loss, like that. So in a similar fashion, over here, we're going to just format printer because we want it to look the same up to there. Statement of profit and loss. How do we, what is the first element we start with? Revenues. So we start with revenue. That. We're not dealing with this current year revenue. This is just to give us a guide of the starting point we're supposed to start. But we are supposed to create a forecast based on the current values here. So what do? We just try to make sure that it's almost the same. And in terms of the format over here, just try and maybe perhaps squeeze it a bit like that, if you don't mind. Double click like that. So from here, moving forward is what we're saying is going to be the forecast value. So what do? We put forecasts right over here. So even if we were to just drag it like that, 2023, and then we come over here and say field series, it's okay. But now we're talking about what? The forecast. F. Because these are not actual values. These are forecast values like that. That. That's more like it. This is the actual values of it, but we do not really have the values here. But we are trying to focus based on the information given to us. So we come to revenue, and we can see we've been given the revenue growth as 5%. So we've been given the units produced and the unit selling price. So the unit selling price times the units produced will give us the revenue itself. So we come over here, plus the units produced, because it's a formula, units produced, you multiply with the unit selling price, and you enter. So what I want us now over here is, because this section moving down over here will be the accounting format, so I put that, and then I put 2 zeros like that, so that now it cannot disturb us now. So that is it. So how do we model now the years 2025, 2026, and so on and so forth like that? So we are saying that the growth rate is 5% moving forward. So it's pretty simple. You pick the previous revenue and you add a factor increasing the previous revenue by 5%. How do we do that? We multiply by 1 plus the 5%, this growth rate over here for 2025. Then we close the bracket and we enter. That's what it gives us. And if now we are to drag it moving across, it will give us the corresponding values based on the increase. That. Moving on, we can model now the cost of goods sold. Just pick cost of goods sold there. So cost of goods sold is a percentage of revenue. What I've done is I just put plus this item over here. That's what I've done. And that's why you can see it's written over here, plus C8. So it's just picking what C8 is. C8 over there, C8. So how do we model cost of goods sold? And over here we are told that the cost of goods sold as a percentage of revenue is 42%. So if you can put the formula over here, and margin center over here, if the formula for COGS percent is given as, and over here of course we're going to try and center it as much as possible, cost of goods is just given COGS over revenue. That. So this is the formula that you need to remember. Cost of goods sold over revenue. That. So if the cost of goods sold over revenue gives us 42%, so this is already the 42% which has been given to us here. We already have the revenue given to us. These are the revenues. Can we then get the cost of goods sold figure, which will be able to fit in right over here? Yes, we can. The COGS percent, the 42% moving across there, we multiply with the corresponding revenues, will give us the COGS. Hence, plus the revenue, which is this one over here when you cross multiply, then you multiply that with 42%, will give us the COGS of the cost of goods sold. And then you just drag it moving across. That. So we haven't been told anything that alters the cost of goods sold component. So we've just been told it is going to remain at 42%. So we can move on towards the right and continue by filling in what the gross profit is. There is no adjustment over here, so gross profit. And this, because it's a, it's a value over here. Remember, these ones have got formulas, that's why they are black in color. So we are saying we're just going to need to underline that here, and we say here we are getting them now as revenue. You subtract cost of goods sold, enter, get 10.7 million. Once you get that, you move sort of the formula towards the right. so that you can be able to get the solution. So now we talk about now the expenses over here. That, and you can be able to put it bold. So we start the first expense over here moving down as what? I may not remember. The first expense should be salaries and benefits. You can see up over here, salaries and benefits. So we put plus, you just go up to salaries and benefits there. Say enter. And for salaries and benefits, we are seeing it is as a percentage of revenue, so 17%. So we can just change this formula. Percent. Salaries and benefits percent. Like that. Salaries and benefits percent is given as salary and benefits, salaries and benefits divided by revenue. So we have the revenue given to us there. It's this one which is moving across there. And we have the salaries and benefits percent. Can we get the salaries and benefits? Yes. In a similar fashion of the way we did the cost of goods sold is what we're going to apply right here. Hence, plus revenue multiplied by salaries and benefits percent. That. We move, Control R. So we also move ahead and talk about depreciation. Plus that value over there. So depreciation will be based on the PPE value. And hence, we may not be able to have the depreciation right away. We leave it like that. We proceed and identify what else we have. After depreciation and amortization, we have the interest. It's a percentage of debt. So, percentage of debt. We don't have the debt component given to us there. So, we just leave it like that. Those two items, we just need to leave it like so. We move ahead and compute the total expenses. So this one, we know because it's going to be, first of all, we'll need to get the total expenses like that. And then we'll also need to get this value like so. So it's just going to be plus sum. You can see the sums over here, but the sum of what? Sum of these expenses right over here. So from here, moving down like that, you close the brackets and then you enter. So we move it like that. Remember, we've not filled in these values, so this value is likely to change here. We can be able to decide to put it in bold. Why? Because it's a total. And this we needed to also do the same. That. So once we've filled in what we've managed to fill in, we can move ahead and get earnings before tax. Before tax. So it's obviously going to be the gross profit, and then you subtract the expenses, the total expenses there. So you get the earnings before tax as that, and this should also be put in bold. So you can move like so. Then we skip a line and compute the component of taxes. There. Taxes we have been told what? Taxes right over here, we can move up over here. The applicable tax rate is 30%. So we can move over here and put 30%. Close the brackets like that. So plus 0.3, that's 30%. Then you multiply that against that. Control R. What about net earnings? We're getting about the net earnings. Net earnings. Excuse me. So net earnings is just going to be based on, of course, this should be bold, Control B. That. So it's going to be plus, you get the earnings before tax, then you subtract the taxes. That. You get that value there. So we need to then copy the formulas moving across. Remember, we haven't filled in this part. If I can be able to use with your permission, so that you cannot be able to forget, I can be able to highlight something like that you've not filled that value, that part or that section. So that is our provisional statement of profit and loss. Provisional statement of profit and loss, because we've not filled in this part here. We move ahead and fill in the statement of financial position right down below here. So, of financial position. Or what is usually called SFP. Like that. So we use format painter. This is a similar fashion. That's what we need. So we start by identifying the assets. So that. And then we put in the first item over here of cash. We're just putting up items that are considered to be the assets. So we've combined the current assets and non-current assets. We'll be able to do that just for convenience purposes. So for cash, we haven't been given any item or any component on cash over there. So we can be able to just to put that color there. So accounts receivable is the next one. Accounts receivable. So accounts receivable, at least we have some component on accounts receivable from the assumptions section over here. Accounts receivable days, we've been told, is 30 over here. And accounts receivable is tied towards revenue. So what is the formula for getting the accounts receivable days? So we can come over here, down over here, and just put it beside it over here. So this one, I just merge. So I can put accounts receivable. These are days. Like that. This is just a short form, please guys, note that. Is given as accounts receivable over revenue. That then times 365. Of course, this one can be just to merge the center, put it there, then you just put x 365. That's how you get it. Accounts receivable days is given as accounts receivable over revenue times 365. So once we know that, we can be able to model the accounts receivable, because that's what we want here. accounts receivable. We have the accounts receivable days. They are given to us up over here. Accounts receivable days, you can see they're 30. We also have the revenue given to us there, which is this is over here. So we have the accounts receivable days, we have the revenues, and 365 is a constant. Can we be able to model the accounts receivable? Yes. The accounts receivable is given as accounts receivable days, you multiply by the revenue, and then you divide by what? By 365. So let's do that together. So you pick the accounts receivable days, which are up here. Accounts receivable days, you can see them here. And then we multiply with the revenue, which is that. And then you divide by 365. We get that as our accounts receivable. But we do not want decimals over here, guys. What we want to model based on complete values, complete figures. So what do? We apply that same formula moving across. We move on and see what are other assets. Inventory. So our inventory has also been given us in terms of days. Inventory days here, 14 days like that. But inventory is driven by the cost of goods sold, not the revenue, but the cost of goods sold. Knowing that, how do we model inventory? So, inventory days is given as inventory. Inventory, we divide by COGS, cost of goods sold, and then times 365. For us to be able to now model the inventory, which is what we're looking for right over here, we just get the inventory days, we multiply by cost of goods sold, then divide by 365. Hence, inventory days, then we multiply with the cost of goods sold, which is this one here, and then we divide by 365. Move ahead and sort of apply the formula moving across. That's what you're getting. Thereafter, we can model other items that are related in the assets over here. So because we can see that we need depreciation over here, it goes without saying that we will need to compute something inclined towards property, plant, and equipment, PPE. So we can be able to have property, plant, property, and equipment. And equipment. So this we will need to have what is called perhaps maybe a depreciation schedule so that we can be able to fill in this value here. The moment we have the property, plant, and equipment, then we'll be able to also fill in the depreciation over here. So just in a similar manner, we just leave it like that. We'll be able to come and fill it later on. So anything that is pegged on the assets or the creation of financial statement or financial position does not exist. And so we can be able to just come over here and maybe sort of create a sum part or a summation right here. You can say total assets. That. So this needs to be bold, put in bold. Sorry, Control B. So that means it's just going to be plus sum, seeing this value here, of what? All of these values given to us there. Enter. Here, of course, we do not need to have something like that, so it's like that. So once we have the total assets given to us there, we now look at liabilities. So as for modeling the liabilities, pardon me, we Control B, yeah. We'll need to identify what liabilities exist based on the income statement of these assumptions here given to us here. Depreciation, we will need a depreciation schedule. The interest, we need an interest schedule. The tax, we'll be able to create a tax schedule. The accounts receivable, the inventory, we've already modeled these two. Now it's accounts payable over here. So the accounts payable and an element of debt, because we're talking about interest on debt. So the debt is also going to be a component that we'll need to put in as part of our liabilities there. So we start by identifying accounts payable. Accounts payable. And the accounts payable has got a similar formula as this, as inventory days. So we can just alter this. Accounts payable. It's got accounts payable. This is, of course, in days, please. That. Accounts payable days. We can just put accounts payable. Payable. Divided by cost of goods sold times 365. So for us to get the accounts payable, which is what we're looking for over here, we can just get the accounts payable days times cost of goods sold divided by 365. Let's do that together. So the accounts payable days is up here in the assumptions tab. Then we multiply that against the cost of goods sold and divide against 365. So we do not want decimal points. So we can just scroll down here. That. We drag. Control R. We mentioned something to do with debt because there's interest on debt. Debt. And this part for debt, we will need to create a schedule that is going to talk about debt here. So here we're going to just put, just going to put it into a gray to show that we're going to fill in that later on because we don't have that value of debt. So if that is the case of debt here, we can then just come over here and see the capital structure. The capital expenditures is 15 million. Debt issuance and repayment, debt we have as 5 million. You can see the debt is 5 million here. So if debt remains at 5 million, that is going to be a constant amount moving across. So just come over here, put plus 5 million. But if we put it 5 million across that, so it should remain something that we're going to put like that. And hence, we should now drag this moving across. Control R. So the interest on debt is 10%. So if the interest on debt is 10%, so how much then can we say our interest is? We go back now to the income statement. You see what I was saying? That we need now to start filling in these values as a percentage of debt. So you can say is plus 10%. Is it 10%? interest on debt, you can see it here, interest on debt, multiplied by the debt component, 500,000. And of course, obviously now it means that we're going to now change the color because we already have those items given to us there. At item. See, it just changes our income statement instantly and it will just fill in these values very well. We're not done yet. We need to get the depreciation component here. So we move ahead. Once we have the debt, there is really nothing else that we are going to, that we really need over here. So we just get the total. So if we have that, so I don't think there's any need for us to put it now in gray here. Just put it in form of a summation. And we just talk about what? Total liabilities. Total liabilities. So we have just plus to add them together. We just have to add them together. Sum. Like that, and enter. So we now then apply the formula across, Control R, and we bold because that value, because it's a total, Control B. That's the total liabilities. So we are not done with the statement of financial position. We need to have that element of shareholders' equity. So there's what we call the equity capital, which we've been told the equity has been issued as 10 million. Remember, the debt remains like that. So it also goes without saying that if the debt remains constant like this and the total capital expenditures is 15 million, so it also means that, guys, you're going to just add this component, that Control R, remains as 10 million. So if that's the case, then we can be able to fill in the shareholders' equity section just down below it. Shareholders' equity. Equity. Shareholders' equity, just pick it from the assumptions section. There. That's what it's called, equity, shareholders' equity. And we just put it like so. But the shareholders' equity is a combination of many items. So this should be shareholders or equity capital. Yes, it should be equity capital. Pardon me for that. It's equity capital, not shareholders' equity. So this, I should just cut, Control V, comes like that. This is a title, so it should be bold. Do we have anything else in equity capital? The only item perhaps is retained earnings. Retained earnings. Earnings. Retained earnings there. So as far as the retained earnings is concerned, we are saying that we're just going to pick the previous retained earnings, which represents the net earnings over here from the previous year. We don't have it, plus this value. So that you can pick the formula. Remember, there's something that is missing over here that we've not filled in. We're going to fill it in as we move along. So we can say that to calculate the retained earnings, it is the previous retained earnings plus the current earnings, net earnings over here of that value over there. And we enter. So we drag that formula moving across. That's what retained earnings is. The previous retained earnings for the year, this year was 2023. Then we add the current net earnings component over here of 4.959, but it's going to change because once we fill in this value here. So we get the previous value plus the current earnings like that. So this one will be previous value plus the current net earnings, you can see here. So the formula will just change as we fill in these items, this item for depreciation will change. So we can come back down here and concentrate now on identifying the shareholders' equity. So we can come back here and concentrate now on identifying the shareholders' equity because we don't have any other item. Shareholders' equity. And we are saying that we need to come up with a summation there, and also summation under it. That. So that should be controlled, it should be bold. So plus that value plus that value. So if we have that value, remember this value is going to change because we picked the net earnings from above there. So we're just going to have it like that for now. It will change. Control R. What is the total liabilities and shareholders' equity? Total liabilities and shareholders' equity. It should be and shareholders' equity. So it is just going to be, we add this total liabilities plus that value there. So it's going to be plus that one, then we add shareholders' equity. That's what we have there. Sort of give it control bold. So we can need to have a check that is going to assist us to reconcile the total assets and the total liabilities. You can actually see over here there's a difference over here, but we filled in the cash value and the property, plant and equipment we haven't. So we will need to then come up with a check over here. So for the check, it means that for you to balance plus, that should be minus the total assets. So this is to the tune of 18 million. This is going to be just our check to see if indeed we have done the correct thing. Control R. So as of now, we cannot be able to have balance because we don't have this value given, these values for cash and property, plant and equipment. We'll then need to come up with the cash flow statement over here. So this we can be able to put it maybe some form of, can be able to italicize, to put it in italics and like that, so that, you know, we can just be sure that we have the correct value for the balance sheet there. We can put it in small letters, maybe in a small font, like that. Bold. Put it in a different color so that it's going to be our guide. We can then move on to the cash flow statement. Remember what we're being asked in the question right here. We move back up here. Prepare statement of profit and loss, statement of financial position, cash flow statement for the company for the 5-year period. So we're going to prepare now the statement of cash flows here, cash flow statement. And so we will then need to put it sort of like so. Cash flow statement. The items of the cash flow statement start by assessing the operating cash flow. Operating cash flow. So we have cash flow right there. Specifically, we'll be looking under the operating cash flow, we'll be looking at the net earnings. And then we add depreciation and amortization. And that, we're going to add that. And then we subtract the changes in working capital. In working capital. So that we can be able to get what is called cash from operations. Over here, and this, of course, is going to be bold until there. Because this is a summation, we will need to put it like so. So our net earnings is whatever we've computed above over there under the income statement. The net earnings is this. But remember, it's subject to change, but we want to link them. Then we just Control R. Depreciation and amortization, we need to come up with a supporting schedule that is going to deal with PPE, and of course we'll be able to determine the depreciation and amortization there. Working capital changes, or the changes in working capital, we will also be able to identify the change in working capital when we compute the working capital schedule. So for now, just leave it like that. This is the part that we need to work out. Moving on, we will need to move on to the next item, investing cash flow. Cash flow from investing activities. Control B. So investing activities means just to try and identify the capital expenditures for that year. So investments in PPE, that's one of them. In PPE, property, plant and equipment. And please note, I will identify the property, plant and equipment, or I'll define the short form of PPE at this point over here. So PPE, property, plant and equipment. So investments in property, plant and equipment is there. Is there really any other thing? There's nothing that we really need. It's not too complicated. So investments in property, plant and equipment, we'll be able to identify that over there. So we don't have that at the moment over here. So when that is the case, so we can then move ahead and look at the next item, financing outflow. Cash flow, sorry. Cash flow. Financing cash flow. So when we talk about financing, how was the activities of the firm financed? based on equity and debt. So we can talk about issuance and repayment of debt. So plus issuance and repayment of debt. So you can just copy it from here. And then just down below it, because it's in succession, it just picks. So we're saying that these values will be able to come up with a debt schedule, an interest schedule moving ahead. That. So here we didn't include the cash flow from investing, so I'll need to insert over here with the permission. That didn't put a summation sign there, so sorry about that. So just talk about cash from investing. Cash from investing. This should be put in bold. That. And here we're saying we'll have cash from financing. Cash from financing. Control B, right there. This should also be Control B, bold. Because you don't have the items from the cash flow statement, or most of the items from the cash flow statement, we will now then move on to the final schedule, which, or before we move on to the final schedule, we'll need to then compute the net increase or decrease in cash just down over here. So net increase and then decrease in cash. Net increase and decrease. This should be decrease in brackets like so, up to there, in cash. And the net increase and decrease in cash will be, we first of all get the cash flow from operations. So it will be, we just pick plus that total there. And then we subtract cash flow from investing because it's an outflow of cash. And then we add cash flow from financing right here. From financing right there. So as of now, we don't have anything. We'll be able to fill it in as we move along. So that is the net increase and decrease in cash. So we'll need to also get the opening cash balance. So the opening cash balance will be the closing cash balance from the previous period. So the opening cash balance, cash balance for here. So the opening cash balance will be based on the closing cash balance. So right here, we will now put a total over here. I'll explain it shortly. Closing cash balance. Closing cash balance. So here we are seeing this value here. It will be driven, the opening cash balance will be driven by the closing cash balance from the previous period. Like that. Then you enter. So if we drag across, Control R, it means that this opening cash balance will be driven by the closing cash balance for the previous period. So 31st December, 1st of January. So this is 31st December, 1st of January, 31st December, 1st of January, and so on and so forth. Over here as you move along. So the closing cash balance will be then the sum of the net increase and decrease in cash and that value there, plus sum like that of those two values there. That is the net increase and decrease in cash, opening cash balance. Enter. Then we autofill towards the right there. So the final section that is going to assist us to fill in all of these gaps, the ones in gray right here, is going to be the supporting schedule. So we write supporting schedule down below here. Supporting schedules. Supporting schedules. And in a similar format, you're going to do it like so. Supporting schedules. The first supporting schedule that will be able to assist us based on whatever we've computed is the working capital schedule. So, capital schedule. So you can just put it in bold. You can just then insert over here. That. No fill. Like that. So what is working capital? It's accounts receivable. You add the inventory, then you less the accounts payable. So accounts receivable, you can just put plus. We go to the balance sheet. We had the accounts receivable. We copy that there. It comes there. Down below it was inventory, so we just sort of drag it down, inventory. And then accounts payable. So we put plus accounts payable, still on the balance sheet. Accounts payable, you can have it there. So what is the accounts receivable? Remember, we computed this accounts receivable. So this value we already have over there. But before we compute the accounts receivable, we can then decide to maybe lock in or close this part so that we can be able to identify the years right over here. What do I mean? We can come to view, then we can come to freeze panes. Then we can just freeze panes like that. Why? So that now we can be able to see which year we are dealing with over here. And like the previous case, I was scrolling down over here and you couldn't be able to see which year we are dealing with over here. So for accounts receivable, the forecast period, we're talking about, we go to plus the accounts receivable value, which is in the balance sheet. This is what we have here. Pick it there. And down below it, you can see it's inventory. So we'll just drag it. We'll just copy the formula down. That, because it's inventory. It's just in following each other. Control R. Accounts payable, we just pick the value from accounts payable from the balance sheet. Right here. We just autofill. Control R. So once we have that, we can get the net working capital. The net working capital there. Net working capital. Plus accounts receivable, plus inventory, which is that, then you less the accounts payable. Less the accounts payable, that, and we have that value there. So because this is a total, you can come back to home and put that, that kind of summation sign to show that you're getting a sum or you're getting a a formula, putting a formula there. And then the change in net working capital over here. Change in net working capital. So here we can say is NWC. There. Change in NWC. We're using that because we've already defined what net working capital is there. So we're getting the change in net working capital over here. So plus that one minus that value. We don't have it. So it remains this value here. And because we'll get we'll apply the formulas moving across, we also need to do the same for change in net working capital. So we are seeing that this value, which is the accounts receivable, we add the inventory and then subtract the accounts payable, like so. So we can then proceed on. Once we've computed the net change in working capital, we go to another schedule, which you can say is termed as the depreciation schedule. Depreciation schedule. Depreciation. Schedule. That. And of course, we'll control B, this one. And what are the components of depreciation? We'll have to begin with the opening property, plant, and equipment value. So opening PPE, Then we'll need to add the capex, which is capital expenditures, and then we subtract the depreciation. And amortization. Depreciation and amortization. So in terms of our computation, we will need to identify opening PPE. The opening PPE component over here for 2023 wasn't given to us, but it is derived from the closing PPE, which is down over here. So we can be able to come up over here and say closing PPE over here, because you're saying that it is going to be a formula, so just or a summation or a computation. We are saying that the focus for 2024, the opening PPE, is just from the closing PPE plus that value. And then we enter. What is our capital expenditure? Our capital expenditure is derived from the assumptions section. So we go back up to the assumption section. What is our capital expenditures? You can see it's 15 million here. And that is what is going to be. Yes, it was 2023, I'm saying it's 2023, 15 million. But that one is broken down into debt and equity. So we pick these capital expenditures from above over here. Place it down here. So capital expenditures plus 15 million. So it would be prudent for us to put it over here because it's 2024. So I escape that. Then I put it right over here. Because even the question is telling us that we are just going to deal with that item of the PPE itself. So we're saying we're going to just deal with 15 million. That. So this one, we can just move on like that and say that this is okay. So 15 million. So we can just come down right here and say capital expenditure is going to be plus the 15 million. That. Enter. So moving back on this side here, just delete that. So once it's 15 million over here, what is for the next years? We have not been given the capital expenditures for the subsequent years. So what do? We just drag whatever is not been given. The depreciation component is always based on the opening PPE. So we are just going to get the percentage depreciation plus the depreciation rate, depreciation of open PPE, 25%, and then we multiply by the cumulative sum of the opening PPEs plus the capex. So that rate times this value plus that value. Come over here and close the brackets. Enter. So for us to be able to estimate our opening PPE or our closing PPE, this value over here, it will be, sorry, you were saying our closing PPE will be, we get the opening PPE, we add the capex, and then you less depreciation. We've even said it before. So for us to get the closing PPE, we get plus opening PPE, then we add capex, and then we less this depreciation component here. That's what we get. And because it's a formula, Control R. There is nothing over here. But what I want us to fill, because this value is picked from down over here, we will need to fill in or autofill that as well. What is our depreciation component? Our depreciation component is given to us over here. So the formula, you can see the formula has been given to us there. So we just also do the same and put Control R. So it changes. So once we have that, guys, we can put this as part of now our filling in, because we can be able to fill in the depreciation and amortization component. Remember, our income statement over here did not have what? Did not have depreciation and amortization. So is it correct for us now, since we've identified the components of PPE, to now fill in the depreciation based on the working capital schedules? Yes, so depreciation is picked from plus this value here, depreciation and amortization. There. We enter. Now we fill in across. Control R. We change it to like so, because we filled in the depreciation component. Once we filled in the depreciation, now we can see our net earnings, or our income statement seems to be complete. So earnings before tax will be based on the net income. We've already put a formula there. So it's just going to be the 10.3 million, 10.7 million minus the 7.395 right here. Because we're saying that we've added all of these items over here, because this is the sum of all of these here. So those, let me just double check if we've put everything that is given to us over here. Revenue, we've used revenue. The units produced, we've used that. The unit selling price, we've used that. Cost of goods sold, the cost of goods sold has been given, has been used to us down over here, the cost of goods sold. Yes. The salaries and benefits, we've been told is 17%, and that one is what we've put salaries and benefits over here. And then the rent and overheads. Oh, the rent and overheads hasn't been put over here, guys. So what we can be able to do is just simply just put rent and overheads right over here. And we've been told the rent over overheads is just a constant 500,000 over here. My sincere apologies for that. So this is the item we haven't fixed in, rent and overheads. And understandably, because of the information, the way the information has been given to us over here, we'll need to now put in over here rent and overheads here. So insert that, and with your permission, I can put rent and overheads. Overheads. That. Yeah, you were saying it's 500,000. That's one we've just been given. So we just put it there. That's why it's always good sometimes, guys, to double check the work that you're doing. As you've seen, there are sometimes that there are some omissions which usually occur. The depreciation amount we've used, the interest on debt is what we're going to work out. The tax of earnings is going to work out the accounts receivable. We've used the inventory, we've used accounts payable, capital expenditures we've computed, and right over here is 15 million, and we've worked it out. The debt issuance and repayment has been used, and the equity has also been used. So this is what we have as our net earnings over here, as you can see. So we can then, now we are going to fill out these items over here for cash. You can see the property, plant and equipment needs to also be filled over here. And then we also need to fill in these statements for, or these components for the cash flow statement there. So we'll just proceed on as we fill them in like that. We can then move ahead and talk about the debt and interest schedule there. Debt and interest schedule. The debt and interest schedule will begin from the debt opening debt. Opening debt. And of course, this one is Control B, bold. And then issuance and repayment of debt. Issuance or repayment of debt, in this case over here. And then we have the debt closing component here, closing debt. We also have an interest component, expense, interest expense, which we already have calculated them above from the income statement. So we can begin with the opening debt. We don't have any opening debt. So it's picked from the closing debt component here. So here we put now a formula like that, rather a line. So the opening debt plus of 2024 is derived from the closing date of 2023. Actually, we don't have any value there. The issuance and repayment of debt in 2024, we have a component of debt. So where do we derive that value from? We derive it from the assumptions, issuance and repayment, because we talk about debt and interest schedule, from the assumptions. The debt is here, 5 million. Issuance and repayment of debt, 5 million. That. And then the closing debt is just going to be derived from the opening debt plus issuance and repayment of debt. So plus that value plus that value. Enter. Get 5 million. And because this one is a formula, you just fill across that. The debt repayment, issuance and repayment should mean that we also pick the values from above. So is it correct to say that in 2025 we issued an additional debt like that? So this perhaps would mean that we'd need to do away with, because it was just one issuance that was done. So if that is the case, so we need then to do away with just this debt was opening. This is the debt opening over here. So this one has picked from here, yes, and this one will pick from right over here. So issuance and repayment of debt, let me see issuance and repayment up above over here, just 1 second. Issuance and repayment, there was only one issuance, and here we should have zeros because there was no additional issuance of debt from the schedule over here. So there should not be any issuance over here. So this should be perhaps deleted like that. And so the interest component will be able to also change, but it should be able to pick the interest. So it should be now, just change this a bit. It should pick from the interest schedule. So plus interest on debt comes to the interest and debt schedule down over here. Interest expense should come down over here like that. So with that, the interest expense is just going to be based on this value here. Let's just come down here. Plus now that value, the closing debt, yes, times the rate of interest, which you're seeing the rate of interest is in the assumptions tab here. Rate of interest is 10%, yes. So now that comes the interest expense like that. And so when we are saying that the interest expense will be based on, and of course, this you can be able to just drag it like that because it's a formula. That, and this should also be Control R, which makes sense. So saying it's based on closing debt. Interest expense is going to be based on closing debt. So you can see there's a formula applied to as a 10% of 5 million, 10% of 5 million, and so on and so forth, like that. So we are done. We are done with the supporting schedules. We've done supporting schedule, the working capital schedule, the depreciation schedule, and we are done with the debt schedule, debt and interest schedule. So now it's going back up again and filling in the items that we did not fill on. We did not fill in that. So this interest on debt, the interest on debt will come from the interest schedule over here, and we're saying it will just be based on E98, which is that value, and it is correct there. So now we can be able to just refill it back again. Remember, we still had 500,000 moving across, but now I've just correctly linked it with the components there. And the answers still remain as the way they are. The only values, the way I applied the 500,000 was based on these values here, and yet it should have been based on the closing values from the debt schedule, which is down below. And so once we have that, we can cash. We don't have the amount of cash yet. We can fill in the amount of property, plant, and equipment over there. The property, plant, and equipment will be filled in from the PPE schedule. So plus PPE schedule is here. PPE, and it's going to be based on the closing value, not on the opening value. No, it's on the closing value. So we link it with that. So that is okay. And then we sort of now drag it, Control R, that. It cannot balance for here because we have not filled in the component of cash here. So the first thing is to first of all clear off that. And then we move on to the cash flow statement. Depreciation and amortization, we've already worked it out. The supporting schedule down, plus supporting schedule down over here, which says the depreciation and amortization component is there. Enter. How about the change in working capital? We go to the schedule down, the working capital schedules. Down here. So the working capital schedule, see, you're looking for the change in working capital. We have that. Put it like that. And we can be able now to just fill in the schedule, Control R. Cash from operations. The cash from operations is just getting the net earnings. We add depreciation, and then we subtract the change in working capital. Let's do that. Plus net earnings. We add the depreciation, and then we subtract the change in working capital. Have it like that. So we fill in, Control R. The investing cash flow. The investing cash flow is based on the amount of capital expenditures. Please note that. So the CapEx is on the working capital schedule down from our worksheet. So capital expenditures, CapEx, you can see it is right here. Enter that. And then we move across. Remember, we're just trying to solve what has not been done before. And so we'll need to clear whatever has already been filled in terms of the cells. So debt and issuance, debt, issuance, and repayment. We will pick this from the schedule down below here. So we debt, issuance, and repayment, debt, issuance, and repayment. We'll talk about the closing component, not this one, please, the closing component. The issuance is right here. Sorry, not the closing, it's that value there. Not the closing component, it's that just the issuance right there. So we enter. Then we Control R. How about the equity issued? Equity issuance will need to go up to the assumptions. Equity issued was 10 million. And please note it was not issued constantly like that, like the way I had initially figured out. So, like that. And so this one, which is above over here, because there's no additional equity, we've not been informed whether they are issuing additional equity, so we need to delete that one there. And we assume that it remains constant like that. So, sorry. Keep it like that. So what is cash flow from financing? Plus that value is add that value. Changes, so shift Control R. What we didn't do above over here, we didn't get the sum, plus that value, enter. So it keeps on changing, please. Control R. We didn't get the sum on this cash flow from investing. So now, what are we left with now? We have filled in the schedules. We are left with, now we've got some balances over here. So how do we balance off? We come and pick the cash item, which is the only one remaining, and we fill it from the cash flow statement. This closing cash balance value here. There. Then Control R. So from there, we can see that there's the cash value of 10 million. For the first component here, we can see it has balanced. But there's a difference of 10 million, 15 million, 15 million, and 15 million there. So those items can be checked from the balance sheet, let's say from the income statement. We can just double check whether our cash component is okay over here. So we're just checking. So from the cash flow statement is okay. So we have the 15 million like that given, and supporting schedules is okay like that. So let's just see from the equity capital from the balance sheet. The equity capital should remain as 10 million. So yes, it was picking from above there. That's the item I think that remains over here. So the equity capital is just, yes, that's the item that is missing. So the equity capital over here is just the current capital component over here. So this one is just the current capital, which is the 10 million. So it's going to be plus 10 million, the current capital, this one here. That one, equity issued, or this one over here like that. And then we add the previous value. We add that value there. So then we need to increase or Control R that value there. You can see it keeps on reducing, so it's almost balancing right over there. So there's a difference of 5 million over here. The debt component right over here also needs to be adjusted. So we come to that the equity capital remains constant there. So if the equity capital remains constant, then we can just try and assess the retained earnings. Seems to be somewhat okay. So the debt component, the debt should remain as 5 million. Yes, because you're saying the debt is always going to be 5 million. And the debt should be 5 million constant moving across like that. So that is where the problem is. That. Yes, it's the debt. So it's moving at, it's just that value over here, or we can be able to put a formula over here, plus that value plus this 5 million, that. Then we Control R. Let's confirm whether it balances. Indeed, ladies and gentlemen, it has balanced. And you can be able to see with this check over here that it balances completely. So that answers our first part of the question right here. And we need now then to now stop what is called the view freezing panes. So we unfreeze panes, we unfreeze it, and then we move towards the right there. So if it has balanced, we have done part A, prepare the following financial statements: statement of profit and loss, 5-year period, statement of financial position for the 5-year period, statement of cash flow statement for the company for the 5-year period. Part B is asking us to be able to analyze or undertake an analysis and compute the following financial ratios for the 5-year period. The first one is profitability, return on assets, return on equity, and net profit margin ratio. So we can come to another tab over here, create another tab over here. Question 22B. B. This is question 22A. 22, can put A like that. It's question 22B. And we come up with, first of all, the years. For here, just insert. So, and we're saying the years are from 2024 all through to 2028. Put it like that. All through to 2028. That. So we're dealing with profitability ratios. Profitability. Right over here. And then you're talking about return on assets. On assets. On assets. That. Then we're talking about return on equity. Return on equity. Just put it like that. And then we just say it's equity. That. Of course, this needs to be deleted. To the left. That. That. So once we have that, of course, years can be that. Then finally, we've been told we need to compute what? Return on assets, return on equity, net profit margin ratio. So net profit margin. Net profit margin ratio. So once we have that, we can then now demarcate it by now computing liquidity ratios. Liquidity. What liquidity ratios did they want us to compute? Let's go back to the question. Current ratio, quick ratio. Current ratio. This should be Control B. Control B. We don't even need the years over here. For what? Just you can see that these are years. So it's the current ratio, quick ratio. Quick ratio. So return on assets is given as you first of all get the net profit margin or not the net profit margin, the net earnings, and then you divide by the average of the assets. So we will do that right here. So we pick the net profit or the net earnings. We come back to this tab over here. We move to the right here. We come to the income statement. So we pick the net earnings. That one. And then we divide by we want average of what number? Of what? We want the average of the assets. So those two. Then we close the brackets. Why? Because we talk about 2023, 2024. Enter. Yes. So we put it in percentage forms. We come home. And of course, because we want this in percentage forms, we just put it like that, 2 decimal places. And we drag it, moving towards the right. Then we can move on to get the return on equity. In a similar fashion, we get the net earnings, you divide by the average of the equity value, shareholders' equity. So we get net earnings, which is that value. We divide by, open the brackets, the average of the equity value. We're not looking at the liabilities, the equity, shareholders' equity. So that. Then we close the brackets like that. You say enter. So Control R. As far as the net profit margin ratio is concerned, the net profit margin ratio, we are saying that is just the net income over sales. So we get plus net income, which is over here, the income statement, the net income, which is the same as the net earnings, over the revenue. There. We move across. Once we have that, then we can move on to liquidity ratios. Current assets over current liabilities gives us the current ratio. So we just work it out. Current assets the current assets represent that one plus the cash plus the inventory. All this current assets we divide by current liabilities. Current liabilities is that one. Enter. That is it, current ratio. So we want it in 2 decimal places, guys. I think it's only fair. Consistency is key. Becoming a good analyst. Quick ratio is just given to us right over here. We'll just get the quick ratio. So the quick ratio, we're getting as the cash component over there. The cash plus the accounts receivable. So we get the cash plus accounts receivable. Cash plus the accounts receivable. That, and then we divide that by or against the accounts payable. The accounts payable. So we divide against the accounts payable, which is here. This is in brackets. Like that. So that is what we are saying we are getting as our quick ratio. Consistency is key. That. So this is it. Now, what is remaining then is, of course, for presentation. Now, presentation is also very important for in financial analysis. So here we can just put it in an Excel format like so, putting with borders. We complete with borders over here. So you can put borders like so, and you can put a thick border over there like that, and then we can be able now just to say that now this is what we have been talking about. So once we've done that, we can then say that we have concluded question 22 part A and part B. So moving back over here, we just go back to the question and see what now. Of course, now this is just now, what all that's left is just now presentation, and you can just put it like that, and you can put it in thick borders like that. This you can also put it in another thick border, and so on and so on and so forth like that. And then you now, of course, you can see now the presentation looks at least a bit better like that. So from here, from the team at Manifested Publishers, we can say that we have concluded the question. Thank you for being with Manifested Publishers, and God bless you. Parting shot is to now view it from a bird's eye view. View what? View these financial statements from a bird's eye view, and we just see, of course, including the check, we've just checked that it's already okay like that. So from a bird's eye view, this is the way it looks, guys. You can be able to see now that the presentation looks a bit much better. This is much better, much more presentable, and much more, you can be able to just make someone now happy when you show them that this is the amount of work you've actually done. But this is the kind of work that you actually do as an investment and financial analyst, or as an investment expert. So be blessed. Bye-bye.
So the unrealized profit on inventory, unrealized profit on inventory, this one is computed by taking the unsold goods, and then we multiply that with the gross profit margin. In most of the examination questions, the examiner will not have given you the margin, but the examiner will have given you something called the gross profit markup. So if you're given the gross profit markup, what you do, you use that gross profit markup to determine the gross profit margin, simply because there is a relationship between these two ratios. If you're given the gross profit markup as A all over B, then your gross profit margin here is all over B, and then to the denominator we add what? Numerator. So meaning that if, for example, you're told the gross profit markup is maybe 2 all over 7, it means that your gross profit margin will be 2 all over 7, and then to the 7 we add the numerator, so this will be 2 all over 9. So in most of the examination questions, the examiner will not have given you the gross profit a margin which you appraise here, but you are given the gross profit what markup. So therefore, compute, that's how we compute the unrealized what profit. So you take the goods not yet sold by the buying company, multiply that with a gross profit margin. So then which adjustment, which items are adjusted with this unrealized profit on inventory? This unrealized profit, number one, we raise it from the group inventory. We raise it from the group inventory. What we mean by the group inventory, this is the inventory of the parent plus the inventory of the subsidiary added together, and then we less any unrealized what? A profit. Any unrealized profit. Next, we also deduct, or basically we also adjust this unrealized profit in the retained earnings of the selling company. The retained earnings of the selling company. So if the selling company was a parent, let's start from the retained earnings of what? The parent company. If the selling company was a subsidiary, let's start from the retained earnings of what? Of the subsidiary. So therefore, we have said unrealized profit on inventory, it arises whereby there was intra-group trading, there was sales between the group members, but it happens that some of the goods which were sold by one of the group member to the other were not yet sold as at the end of the year. So what you need to do, you proceed, you determine the unrealized what? Profit. By taking the unsold goods times the gross profit what? Margin. But equally, we have said in most of the cases, the examiner will not give you that particular gross profit margin. You will be given gross profit markup. You use that in terms of getting the gross profit what? Margin. And then once you compute the ULP, less it from the group inventory and also deduct it from what? The retained earnings of the selling what? A company. Then we have the other consolidation adjustment number 4, and that is what we refer as intercompany sale. Intercompany sale of asset. Intercompany sale of asset. Intercompany sale of asset. So when talk about intercompany sale of asset, this is where we have a group member selling to the other group member an item of asset. For example, in this case, you can be told that the parent company here, the parent company sold an item of PP, an item of property, plant, and equipment to the subsidiary company. To the subsidiary company. So as far as this transaction is concerned, there are two adjustments which are made here. The first adjustment is adjustment in relation to an realized profit. Unrealized profit on the sale, and the other adjustment which we make as far as this is concerned is adjustment relating to depreciation overcharge. Depreciation overcharge by the buying company. So in this case, I'm only talking of unrealized profit and also depreciation overcharge. But it is important to note that whenever an item of asset has been sold by one of the group member to the other, it can be sold at a profit or at a loss. At a profit or at a loss. So if it was sold at a profit, the profit which was reported by the selling company, this entire profit will not yet be realized, because we know that, for example, once the parent company sell an asset to the subsidiary, is the subsidiary supposed to sell that asset to third parties? No. The subsidiary company should not sell, or is not buying that particular asset to sell it to third parties. So it is buying that asset to use it. So therefore, the profit which was reported by the selling company, the entire profit will not yet be realized. But equally, the asset can be sold at a loss, which is not a common scenario. So all the questions which have come across is whereby you are told the asset was sold at a profit, which you are saying that profit, the entire amount will not yet be realized. And then as a result of that, you have to compute now the depreciation overcharge by the buying company. So let's look on which items are adjusted with these two items. So the first one is unrealized profit on the sale. the unrealized profit on the sale is basically the profit which was reported by the selling company. So if this company sold an item of PP and it reported a profit of 50 million, we are saying the entire profit will not yet be realized. Will not yet be realized. So which items are adjusted with this unrealized profit? One, we adjust this in the group PP, in the group property, plant and equipment. Remember, group property, plant and equipment, this is a PP, the property, plant and equipment of the parent plus that of the subsidiary, and then to this we less the unrealized profit, because now this company will have accounted for that item in its books of account. The item it bought at a selling price, so therefore its PP will be overstated with the profit reported by this company. So deduct that from deduct the unrealized profit from the group PP, and then deduct that unrealized profit from the retained earnings of selling company. Retained earnings of the selling company, also deduct it there. Other than deducting it from the group PP, deduct it from the retained earnings of the selling company. That is the adjustment which is made as far as the unrealized profit is concerned. So the other adjustment which will be made is the depreciation, or is the adjustment in relation to depreciation overcharge. So why do we compute depreciation undercharge? We are saying the PP of the buying company, of the purchasing company, will be overstated with the element of the profit, with the element of what? Of the profit. So therefore, what we do is basically to compute that depreciation undercharge, and when computing depreciation undercharge, you compute it based on the revaluation, not the revaluation gain, sorry. You compute it based on the unrealized profit, So the examiner may, or you may be told that this company may be depreciate its asset at a certain rate. So what you do to compute the depreciation undercharge, you take the rate which is given to you, multiply that with the component of unrealized profit. Alternatively, the examiner may have given you something called the estimated remaining useful life of the asset which was sold. To compute the depreciation undercharge, or overcharge, that is, you take the unrealized profit, divide that with what? With the remaining useful life of that asset. And then you'll get a figure here. So this figure of depreciation overcharge, one, you adjust it in the group PP. You add the PP of the parent, that of the subsidiary, and then to this you are going to add the depreciation overcharge. This company had overcharged the depreciation. It reported a PP which were, or the net book value of the PP was understated, and then that depreciation overcharge, you also add it to the retained earnings of the buying company. This company overcharged depreciation during the current year. As a result of that, its profit, or its reported profit, was understated. So that is the adjustment we make as far as depreciation overcharge is concerned. We are saying compute that depreciation overcharge by taking the unrealized profit times the rate which is provided. If you are not given the rate, you'll be given the remaining useful life of that asset. Divide the unrealized profit with the remaining useful life, deduct that or add that to the group PP, add it to the group retained earnings of the buying company. So therefore, as far as the preparation of consolidated statement of financial position is concerned, we have those key consolidation adjustment which you should be in a position to deal with. And basically what I've said is that anytime you come across a question from this topic of group account, at least you'll come across three adjustments. The common one is fair value adjustment. The other one is adjustment in relation to unrealized profit, and the other one is in relation to amount of intercompany debt. So this one is not that very common, though it is tested from time to time. So therefore, those consolidation adjustment are key. You must be in a position to deal with them if you want to be comfortable, or basically if you want to handle any question from this topic comfortably. So next, I want us to look on how we prepare the consolidated statement of profit or loss. Consolidated statement of profit or loss, which is basically the same with the consolidated income statement. So how should you prepare this? If you are told the parent company here has acquired a subsidiary, and you are required to prepare now the consolidated statement of profit or loss. So how do you go about in preparing this? So let's look on the consolidation procedures, the procedures you follow, the steps you follow for you to successfully prepare what is required. Consolidation procedures. Number one is that you add similar items of revenue and expenses. Similar items of revenue and expenses, those of the parent and those of the subsidiary. You add similar items of revenue and expenses, those of the parent and those of the subsidiary. So we can say number one, add similar items of revenue and expenses, those of parent company and subsidiary company. And in this case, it's also important for me to mention that you may be told that the parent company, for example, acquired 80% of the shares in the subsidiary, 80% of the ordinary shares of the subsidiary. Now, in this case, when preparing the consolidated statement of profit or loss, we are saying you do what? For example, for revenue, and also expenses, here, we are saying you take that of the parent, and basically you take 100%, the full amount of the revenue of the parent, and the same case with the expenses, the full amount of the expenses of the parent, and you add 100% of the revenue and expenses of the subsidiary, even if the parent company didn't acquire 100% what? Shareholding. In the past, I've seen most of the students making a mistake whereby when taking the revenue and expenses of the subsidiary, they multiply that or they take 80%. That is very wrong. You take 100% of the revenue and expenses of the subsidiary, even if the parent company didn't acquire a 100% shareholding in what? In the subsidiary. Number two, we say that for subsidiary acquired in course of the year, take into account its results from date of acquisition. It results from date of acquisition, i.e. time apportioned. So basically what that means is that if, for instance, you are told that the parent company acquired the subsidiary maybe 6 months to the end of the financial year, or basically to the date of consolidation, then you are saying when taking the revenue and expenses of this subsidiary, then you cannot take those items for the whole year because the subsidiary was just acquired 6 months to the end of the year. So therefore, when taking the revenue and expenses of this subsidiary, you only take those items for 6 months. And therefore, what you do, you take the full amount of revenue and expenses, that of the parent, the full amount of revenue and expenses, that of the parent, and then you add the revenue and expenses of the subsidiary only for how many months? 6 months. So therefore, in the event a subsidiary was acquired during the current financial year, then we are saying what you do, you take into account its results only from the date of acquisition. You apportion all items of revenue and expenses, those of the subsidiary, on time basis. Then procedure number 3, that is step number 3. You make the necessary adjustments. Make the necessary consolidation adjustments consolidation adjustments. So in this case, we are going to look on or to discuss those adjustments which are made, and they involve consolidation relating to or basically you can refer to this as intra-group sales. Intra-group sales. The other one is adjustment in relation to any unrealized profit on inventory. We also have any or basically adjustment relating to depreciation other charge or depreciation overcharge overcharge. And also we have adjustment in relation to what? In relation to any impairment loss on goodwill, any impairment loss in relation to goodwill, and also any adjustment relating to intra-group investment income. Intra-group investment income. So these are various adjustments which are considered specifically in preparing the group or the consolidated statement of profit or loss. We are going to discuss them in details, and then after making those consolidation adjustment, finally what you do, you split the profit for the year, split the profit for the year into a profit attributable to parent company, and NCI. So the profit which you are going to get after preparing now your consolidated income statement, we are saying you split it into two. You split it into two, into the profit attributable to the parent company and the profit attributable to NCI. So the first thing we do here is to compute the profit attributable to the non-controlling interest. To compute the profit attributable to NCI, what do? We take the percentage NCI, and then we multiply this with the subsidiary company profit after tax, plus or minus any consolidation adjustment, plus or minus any consolidation adjustment. So basically, you'll be able to understand this better when looking on an illustration question. I'll be able to explain in details some of the consolidation adjustments which we make or which are adjusted to that subsidiary company profit after tax. So therefore, these are generally now the consolidation adjustments, or not the consolidation adjustment, but rather the consolidation procedures which are followed, particularly when preparing a consolidated statement of profit or loss, or a consolidated income statement. So I want just to mention something as far as these consolidation adjustments are concerned. Consolidation adjustment. So maybe I'll start with the adjustment in relation to intra-group sales or intra-group trading. Intra-group trading. So intra-group trading is sales between the group members. The group members, for example, sales between the parent and the subsidiary, or sales by the subsidiary to the parent. So any amount of sales between the two companies, this one we always deduct it, or we always adjust it in our consolidated statement of profit or loss by deducting it from the group inventory. So it's the group revenue, not the group inventory, from the group revenue, and also we deduct this from the group cost of sales. So assuming you come across a question for group account and you're told the parent company sold some goods now to the parent, or the parent sold some goods now to the subsidiary, or the subsidiary sold some goods now to the parent. So when preparing the consolidated statement of profit or loss, what you do, such sales, you less them from the group sales. The group sales is the sales of the parent plus that of the subsidiary. You less that from the group's sales, and also you less that from the group cost of sales, which is the cost of sales of the parent plus that of the subsidiary. So the other adjustments is adjustment relating to unrealized profit. Remember, you have looked on how we determine the unrealized profit, which we said is determined by taking the unsold goods times gross profit margin. So this unrealized profit on inventory, this one is added to the group cost of sales. Is added to a group cost of what? Of sales. To the group cost of sales. So in preparing the consolidated statement of profit or loss, any unrealized profit on inventory, we add it to the group cost of sales. Then we also have the other adjustment relating to depreciation, overcharge, or other charge. Depreciation, other charge, or over a charge, specifically for the current year. For current year. So this particular depreciation, overcharge, or other charge, when preparing this consolidated income statement, if it is a depreciation other charge, that one is added to a group cost of sales. To group cost of sales, it is added to the group cost of sales, any depreciation other charge, but a depreciation overcharge. Depreciation overcharge, this one is deducted from the group cost of sales. From the group cost of what? Of sales. From the group cost of sales. And then from there we have the other adjustment in relation to any impairment loss. So impairment loss, this one, is the decrease in the value of goodwill. Any goodwill arising on the, or which are also on the date of acquisition, you can be told that that goodwill had reduced in value, or in other terms, an impairment review was conducted at the end of the year, and it was found that the goodwill was impaired with a certain amount of money. So that particular impairment loss, when preparing the income statement, you add it to the administrative expenses. This one is quite simple. You add it to the administrative what? Expenses, to the group administrative expenses. And then finally we have adjustment relating to intragroup investment income. When we talk about intragroup investment income, this refers to any investment income which is generated from within the group. A good example include dividends received by parent company, company from subsidiary company. So dividends received by parent company from what? Subsidiary. Generally, what we know is that once the parent company acquire majority of the shares in the subsidiary, the parent company is investing in a subsidiary by acquiring majority of the shares. So if this company happen to have paid some dividend during the current year, happen to have paid some dividends during the current financial year, those particular dividends or some of those dividends will be paid to the investor company, which is the parent company, and the parent company then will proceed and account for these particular dividends in its income statement as an investment income. But in this case, you can see this investment income is an investment income which is generated within the group. Remember, you said in the introduction, a group is basically the parent company and its what? Subsidiary. So therefore, this dividends received by the parent company from the subsidiary, which you're saying is an investment income from within the group, this one we say should not be included in the consolidated statement of profit or loss. So this one is excluded in consolidated statement of profit or loss. Excluded from the consolidated statement of profit or loss. Don't include it there because this is an investment income from within the group. Any investment income which we include in our consolidated statement of profit or loss is any investment income generated from outside the group or received from outside the group. So therefore, in preparing the consolidated statement of a profit or loss, those are some of the adjustments which are also important and basically which you must be in a position to deal with. So therefore, generally what we have discussed here is how the group account, how the consolidated financial statements are prepared when the parent company has invested in what? in a subsidiary. We have looked on the preparation of the consolidated statement of profit or loss, and also the preparation of the consolidated statement of financial position. And equally of importance, what you have discussed are the consolidation adjustment, those particular adjustments which are made when preparing consolidated income statement, consolidated statement of financial position. So that basically is the end of that. Once we meet in our next session, what we are going to do, we are going to look on an illustration question regarding the preparation of group account from Kasneb past papers.
Learners, welcome to the economics lesson. The chapter is agriculture and industry. In our today's lesson, we will study the benefits of small-scale industries in developing countries. By the end of this lesson, you should be able to elaborate the benefits of small-scale industries in developing countries. And the first benefit of small-scale industries in developing countries is to do with the potentiality of large employment. Potential for large employment. Potential for large employment. Small-scale industries have the potential for large employment. Large employment. Okay? They have the potential, small-scale industries have the potential to create employment opportunities on a massive scale. Why? Because small-scale industries are labor-intensive in character. They use more labor than other factors of production. They can be set up in a very small period of time and can provide employment opportunity to more number of people. Potential for large employment. Another benefit is that one that we call requirement of less capital. Less capital is required to set up small-scale industries. Okay? They require less capital when compared to large-scale industries. So a developing country is a capital-scarce country. A developing country is a capital-scarce country, and therefore small-scale industries are more suitable. That's a characteristic of a developing country. The developing countries may not have enough capital. Okay? And due to that reason, small-scale industries become better or suitable to operate in developing countries. And again, they can be started and run by small entrepreneurs who have little capital resources. Requirement of less capital is another benefit. The third benefit is the contribution to industrial output. Contribution to industrial output. How is it a benefit? Now, products manufactured by small-scale industries form a significant portion of the industrial output of the country. They produce a number of consumer goods as well as industrial components in large quantities, and therefore they satisfy the needs of consumers. The consumer goods are produced by small-scale industries, and these goods that are produced by small-scale industries are cheaper and they satisfy the requirements of the poorer sections of the society. 4, contribution to exports. Contribution to exports. Small-scale industries contribute majorly to the industrial exports of a country. Further products produced by small-scale industries are used in the manufacture of products manufactured and exported by large-scale industries, and therefore they contribute both directly and indirectly to the exports and also earn valuable foreign exchange. A good example in Kenya here is production of tea, production of coffee. Coffee in Kenya is produced both on large scale and also on small scale. We have small scale farmers who produce tea, and that tea is exported. All right, it's put together in factories, processed, and also exported. Okay, they contribute both directly and indirectly to in order to earn what we call foreign valuable exchange. Okay, by exporting, and that is another benefit. By exporting, then that gives the other benefit, which is earning of foreign exchange. Earning of foreign exchange. Earning foreign exchange. Small scale industries earn valuable foreign exchange. By doing what? By exporting products to different countries of the world. In point 5, we said that small scale industries contribute to exports. After contributing to exports, these exports as a result, they help to earn foreign exchange. And at the same time, the imports are very little. Okay? And so there is less foreign exchange outgo. Therefore, small-scale industries are net foreign exchange earners. Point number 6, equitable distribution. Equitable distribution. Candidates, the large-scale industries lead to inequalities in income distribution and concentration of economic power. But small-scale industries distribute resources and wealth more equitably. And it is because income is distributed among more people or more workers, since it is labor intensive. And that results to what we call economic and social welfare. Small scale industries do what? They contribute to what we call equitable distribution of wealth. Why? Because if you are to compare with the large scale industries, the large scale industries lead to inequalities in income distribution, because you may find one corporation earning a lot of money. Okay? When a company produces on large scale, many of the income is retained, maintained, or concentrated in one company, because a large scale industry is not labor intensive, it is capital intensive. Large scale industries use machineries, plants, and all that mechanization in production. But in small scale industries, it's labor intensive. Therefore, if it's labor intensive, it means the income is distributed amongst many people. Many people are employed when dealing with small-scale industries. You have many people being employed, and therefore income is distributed among many people or many workers because it is labor-intensive. And that results to economic and social welfare where there is equitable distribution of wealth. So small-scale industries help in the equal distribution of wealth as contrasted with the large-scale industries. Use of domestic resources, number 7. Use of domestic resources is another benefit of small-scale industries. Small industries use locally available resources in a productive manner, which would have otherwise gone to waste. The small amounts of savings which would have remained idle is channeled into setting up small enterprises, and that increases capital formation and investment in the economy. Number 8, opportunities for entrepreneurs. Opportunities for entrepreneurship or entrepreneurs. Okay? Small-scale industries provide opportunities for entrepreneurs with limited capital. Why? Because setting up a small-scale industry requires less capital and lower investment in technology and machines when compared to large-scale industries. And therefore, small-scale entrepreneurs can start small-scale industries easily and succeed. Cost efficiency, number 9. Cost efficiency. Small-scale units can adopt lean production methods which offer better quality and more variety of low-cost products. They can be more cost efficient when compared to large-scale units because their expenses are lower. Flexibility in operation, number 10. Flexibility in operations. Small-scale entrepreneurs are more flexible. They can adapt themselves to changes in the market requirements very fast and benefit from new opportunities. And related to flexibility in operations is the advantage of adaptability to change. 11. Adaptability to change. Adaptability to change. Small-scale industries can understand the changing requirements of the customers and adapt themselves much quickly. They can change their procedures, they can change their markets, they can change their techniques faster and cater for the new requirements of their customers. 12. Less industrial disputes. Less industrial disputes. How is it a benefit to in relation to small-scale industries? Candidates in large-scale enterprises, workers are more organized and they join strong trade unions. The trade unions fight for the workers' rights, but in small-scale industries or enterprises, workers are not well organized and union activities is less. So they there is very little possibility of industrial disputes to occur. So that's a benefit. When it comes to the affairs of small-scale industries or workers, there is likelihood to be less industrial disputes because they are not as organized as the large-scale industry. So that becomes an advantage. So candidates, there are many benefits of small-scale industries. I can go on and mention benefits like the personal contact with employees. Small-scale industries have personal contact with employees. And I can also mention another advantage being that there is personal contact with customers, right? Personal contact with customers. Another advantage could be self-interest. And how is self-interest a benefit? Is because candidates, small business is generally run by the sole proprietors of the business. The sole proprietors earns all the profits and bears all risk. So self-interest acts as a strong motivator. And therefore, the sole trader would put in his or her best efforts to make the business a success. So these are benefits of small-scale industries. And to just recap what we have learned, candidates, we sought to elaborate on the benefits of small-scale industries in developing countries. We've said, point number one, that small-scale industries have potential for large employment. Small industries employ large number of people in developing countries compared to large-scale companies or industries. The second benefit is the requirement of less capital. To set up a small-scale enterprise, you require less capital compared to large-scale industries. Number three, contribution to industrial output. Number four, contribution to exports. Number five, earning foreign exchange. Small-scale industries help in the earning of foreign exchange. Number six, equitable distribution. Number seven, use of domestic resources. Number eight, opportunities for entrepreneurs. Number nine, cost efficiency. Number 10, flexibility in operations. Number 11, adaptability to change. Number 12, less industrial disputes. These are the benefits that I wrote on the board. I also mentioned three other benefits, which are self-interest, personal contact with customers, personal contact with employees. So in total, these are 15 benefits of small-scale industries. To close this lesson, I will leave you with one assignment. Elaborate on the benefits of small-scale industries in developing country. That is your assignment. When doing the assignment, ensure that you don't refer to the notes. Try and actively recall what you have learned in today's lesson. Thank you. God bless you. Let's hope to meet in our next session, where we'll proceed with the topic agriculture and industry. In our next session, we are going to
Path to CPA victory. Live Zoom classes. Experience the energy of live learning with expert instructors. It's just like being in the classroom, but from the comfort of your home. Plus, if you miss a class, no worries. You'll have access to class recordings. Live classes are just 4,500 shillings per subject, and our September to December timetable is out now. Classes kick off on September 2nd. To enroll, use paybill 4216C8873 and enter the subject code as your account name. It's that simple. Manifested online classes. Your CPA success story starts here.
And then we proceed on to do the adjustments for non-cash incomes and expenses. Adjustments for non-cash incomes and expenses. Cash. Incomes and expenses. So bold, like that, and we double click over here so that now at least we can be able to now list the provider list right over here. The first one is finance costs. Finance costs. Finance costs. So we pick what is the finance costs. 17. You can see it's 17 there. So we pick plus that value. Then we proceed on to select depreciation. Depreciation right there. And the depreciation, we can get it from, of course, from the statement of financial position over here. If it's not there, we can check it at here. There is disposal over here. For, you can see the depreciation is over here, note number 2. Depreciation charge for the year was 43 million. So we're dealing with this year. We just pick the 43 million. Then we select loss on disposal of PPE. Loss on disposal of PPE. There. So do we have any working on PPE? Loss on disposal of PPE. We don't have anything right from here from our working. So we can check the additional information right over here. Property, plant and equipment. Property, plant and equipment held by Bermuda Limited are items of plant and equipment are freehold premises. During the year ended 30th June 2022, items of plant and equipment which originally cost 40 million were disposed of, resulting in a loss. Here it is, loss of 6 million charged in administrative expenses. So loss on disposal of PPE 6. You're seeing it's just going to be a positive value there. Then we proceed on to assess the amortization of intangible assets. Amortization of intangible assets. Amortization of intangible assets. So we just assess from the assets over here, the intangible assets, that is non-current assets. You can see the intangible assets given to us there is, for 2021 is 50 and 40. So we'll just get the difference between that plus that one minus that one there. So enter. You can see it's 10. Once we have that, we can be able to now include gain on financial assets at fair value. Gain on financial assets. Assets at fair value. Value. So we need to identify that gain on financial assets at fair value. So there is nothing over here. Financial asset OCI. That's not the one. So we need to identify that, and from the income statement we can see the gain on financial assets at fair value, that given to us, because it was a gain over here, but we need to reduce that gain on financial assets over here. So we put minus over here, minus 5, enter. And I can see there's a slight error over here. Profit before. Put an E here. before tax, like that. So once we have the gain on financial asset at fair value, then we can do the adjustments for incomes not correctly classified. So adjustments for income not correctly classified here. Incomes not correctly classified. Not correctly classified over here. So this one we can maybe perhaps, if we bold it, it will indicate it's a heading, but you can just try and italicize that and indicate that the adjustments for incomes not correctly classified. The first one is investment income. Investment income. So investment income can be identified from the income statement or statement of profit and loss. So the investment income was over here, so it needs now to be deducted from over here. So plus, so we just put in investment income there, but it should be negative. So we should put negative plus minus that. It should indicate that that is -6. So those are the adjustments for non-cash incomes and expenses there. And from our working over here, this working over here represents the working for cash and cash equivalents. So cash and cash equivalents. Someone might ask, what were we doing by working out the 8 and the 89? So I can put that bolded like that. So this is the working for cash and cash equivalents. We proceed on with the cash flow statement. Adjustments for working capital there. Adjustments for working capital. Adjustments for working capital. So this format, put that like that. The first item is decrease in inventory. Decrease in inventory. Inventory. That. And inventory can be found from statement of financial position. You can see it's right over here. So you can highlight that in red with your permission. So we get the difference between the 176 minus 123. So we can just do it like that. Brackets 176 minus the 123. 3 there. That is obviously how an accountant would do it if you are perhaps maybe having a narrative exam, writing it down. But because we are accountants, and someone should be able to come and check the formula based on the Excel. Once you click the Excel part over here, you should be able to identify. So it's plus the 176 minus 123. No need to show any working or side workings right over here besides the written part. Then we need to also assess the increase in trade receivables or decrease, increase or decrease. So are we seeing whether it's an increase or a decrease in trade receivables? So it's moving from here, which is the 2021, to this part. So obviously we can see that there's an increase. In the previous case, it's a decrease from 176 to 123. So here we are increasing. So increase in trade receivables. Increase in trade receivables. So plus, just do it. The 87 minus 95. So for format painter, let's move along like that, seeing it's going to be an increase in trade receivables. It represented as a negative value. Next is increase in trade payables, increase or decrease in trade payables. So that should also be highlighted in red like that. So let's see trade payables, like that. So the payables are right down here under current liabilities. It's from 3 to 7, so that's an increase in trade payables. So we can just drag that down, then we adjust trade payables. Increase in trade payables. So we just pick plus trade payables 100 minus 156 minus that value. Format, yes, I can format it. I just want to do it for completeness. I do not want to do it everything once everything is done. Then we move ahead and try and identify whether we have anything to do with cash generated. Is there any other adjustment required? Nothing. So we move on to cash generated from operations. Generated from operations. So we just add them. Like that. So we just get them. You see this button here, auto sum? You can just add them. Minus like that. So if it's increase in trade payables, we are saying that it should represent an actual increase in trade payables. So we are saying it should be plus trade payables, this value minus, sorry, I did it the other way around, that value minus the 100 over there. So we should be able to have 56. So the cash generated from operations should be the sum from the beginning. It should not just be the sum from there. So what we do is that we can just change this and okay, so we just say plus sum, click there from the beginning, there up till there. Close the brackets, enter. You can see it is cash generated from operations. So now we move ahead and analyze interest. So the interest, we can see the interest has been given to us over here of 3. How do we calculate the interest, the final interest value, the interest paid? So it's this one, which is the interest at the beginning of 2021. Then you add these finance costs, and then you subtract the interest payable like that at the end of the year like that. So that now we can be able to include how much interest was actually paid. So interest paid over here, we are saying we get plus interest payable, which we're saying is right here, the 3. Then we add, so we are going to open this and put a negative value, open brackets, and then we put a negative value there, plus how much was paid, finance cost within the year, and then we subtract closing value, interest payable. Close the bracket, enter. So we have the interest given to us there, interest paid. We move on to the next item, which we're saying is going to be tax paid. So the tax paid is going to be plus the tax, you can see right over here under current liabilities, the income tax payable, you're saying is 34. Then we're going to get a negative value also for that, plus how much tax was actually paid within the year, income tax expense 47 right there. And remember, it is a negative value over here, so I think I'll need to also change the formula. Then we deduct the tax closing value, closing balance here. Saying we're getting 32, so we'll need to adjust this part over here. We subtract, we should get 62. Why are we doing that, this adjustment of negative? Because we actually deducted, you can see here the 47 is actually a negative value. So we first of all add the beginning tax component 34 plus a positive tax component over here of 47. But you see now you get, this is already negative, so I need to subtract. So I can be able to negative, 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 negative will give me a positive value there. So this is the value for the tax paid. Format painter there. Then we assess the net cash received from operating activities. Received from operating activities. So how do we get the net cash from operating activities? Over there, we just get the sum of cash generated from operations from there. So plus sum from here to there. Net cash received from operating activities. It's 205. We move ahead and talk about the cash flow from investing activities. From investing activities. Cash flow from investing activities, we need to put it in a similar format to these adjustments here. The first talking point over there is investment income. Over there from the income statement plus investment income is right here, you can see it. So highlight that. Sorry, I can just first of all highlight that as investment income. There, not highlight, just put it as a format painter. That as 6. So plus that value, enter. Our next item is now purchase of PPE, and we need to see the working for that. Purchase of PPE. Purchase of PPE. That. Plus the purchase of PPE should be, from the working over here, we can see the purchase of new asset right over here. So the working purchase of PPE, the purchase of new asset, that value should be included. And that value should be a negative value. So first of all, you include it like that, because it represents an outflow of cash, plus minus 165 there. We move ahead so that we can be able to get either the purchase or sale of financial asset at other comprehensive income. So we are saying we have the purchase of financial asset at other comprehensive income, at OCI, other comprehensive income, right over there. So what you need to take note of, is that we had initially, we can just go to other comprehensive income, this part right over here, I highlight over here, and also the other comprehensive income, right, this part over here. So at the beginning of 2021, we had 10 as far as the financial asset was concerned at the beginning. And at the end of the year, this was at the beginning of the year, this is at the end of the year. So at the end of the year, we had 22 as financial assets at other comprehensive income. Now, within the year 2022, there was a reserve there that was provided for, and it's actually represented by this value right over here, the 2. So because this was what was provided for as a form of equity reserve, this value plus that value will give us a total of 12. But because this is the closing value, we will need to ensure that this 12 will actually close, or ensure that we will be able to end the year at a value of 22. So the balancing figure, or the difference between the sum of this financial asset at the beginning of 2022 and the financial asset equity reserve minus this 22 should be able to give us 10. So in essence, I'm saying this, I can just work out over here, plus that value plus the 2, enter, give us 12. But at the end of the year, I can put it right over here, at the end of the year was that value there. So we need to ensure that this side and this other side actually balance. So what do? The difference between this 22 and 12 will be termed as the purchase of financial asset at other comprehensive income. And we can be able to pick plus that value minus that value. We get the purchase of the tune of 10. And this, because it's a purchase, we are saying that we are going to include a negative value there. So plus, you can say, or minus 10, because I've already explained it. So just put minus 10 there. So once we've understood the purchase of financial asset right over here, we can proceed on to identify the proceeds on sale of PPE. Proceeds, pardon me, on sale of PPE. Proceeds on sale of PPE will be given based on the additional information. Additional information number 1. Property, plant and equipment held by Bermuda Limited are items of plant and equipment and freehold premises. During the year ended 30th June 2022, items of plant and equipment which originally cost 40 million were disposed of, resulting in a loss of 6 million, charged in administrative expenses. These items had a net book value of 28 million as at the date of disposal. So this is very important, because you're saying that the difference between the net book value and the loss over here will give us the proceeds on sale of PPE. So we select plus 28 million, then we subtract the 6 million over here, which represented a loss, that we get proceeds on sale of 22. Now we can be able to get the net cash used in investing activities. So net cash used in investing activities. That. And getting the net cash used in investing activities is just the sum over here plus sum. So you select the first one of these values, of these items there. Close the bracket and we enter. 147, negative 147. Now we can move to the final part of the cash flow statement, cash flow from financing activities. Cash flow from financing activities, from financing activities. Financing activities. So this one will just consistency sake, put it like that, bolded, like that, we bold it. Then we identify the items. There were new issue of shares. So issue of new shares. Of new shares over here. We come to our working, the very first working over there. Rather, not the first working, but the issue of new shares was done over here, sorry. The third working over here. We can see there was issue of new shares of 60. So we click that over here, put a formula, plus there, and you can even see it's written there, increase due to new issue, 60. Then we proceed on to identify the dividends, if there are any dividends paid. Dividends paid. And we check the balance sheet over here. So there's nothing to do with dividends. I'm over here on this subsection over here. So we can just move up as we move. Yes, retained profits. You can see over here. And when we talk about retained profits, we talk about now monies that have actually been kept up. There is a dividend payout ratio and there is what we call a retention ratio now. So these retained profits relate to the dividends. So we have this 91. So comes plus dividends paid, the 91. Then we add if we have any component in the income statement over here. We don't have any item on the income statement. We can then proceed on revaluation reserve if there is any element of revaluation reserve, or profit for the year, sorry, pardon me, profit for the year over here, the 67 over here. Then we deduct now this closing balance over here. So closing balance, the 121 here, these retained profits right over here. So I think the formula didn't pick very well. So plus the 91, and then we add this value here, and then we deduct this 121 right over here. Enter. So this should be negative, and we just put in a negative sign right over there. Enter. Like that. Dividends paid. And once we've done that, we can be able to see clearly that we don't have any other item from financing activities. So we get the net cash received from financing activities. Net cash received from financing activities. Activities there. How do we get it over there? We just get the sum of that of the new issue shares and the dividends paid. So plus sum like that. So we close the brackets like that. Sorry. Plus that one plus that value. Get 23. So this value can be able to just maybe decide to underline it, that one. This net cash used, you can be able just to also underline that as well. And this one, just underline there, like that. After we get the net cash received from financing activities, we need to get the net increase or decrease in cash and cash equivalents. Net increase in cash and cash equivalents. In cash and cash equivalents. That. So the net increase or decrease in cash and cash equivalents, we can get it from, we cannot be able to get it from this cash and cash equivalents right over here. We can get it from adding the three components of the cash flow statement. That is it. So we add plus, we get the 205, that one, plus we add the negative 147, then we add the 23. Enter. We can see we have 81. But we need to factor in the cash and cash equivalents at the beginning. And that is now where this cash and cash equivalents summary comes into play or into use. So we add cash and cash equivalents at the beginning. Cash and cash equivalents at the beginning, like there, cash equivalents, equivalents, that's correct, like that, at the beginning. And we can see the cash equivalents at the beginning is plus, we can go up over here, this is at the beginning, 2021, that value, enter. Then we factor in cash and cash equivalents at the end. Cash, and you can just put it like that. Then we now adjust this to the end. So this one, we can clearly see over here that it balances off. So we can just get plus that one plus that value will give us 89. So does this tally? So to check, we can have a check over here. Check. How do we check whether we actually am doing the correct thing over here? So we just check if this value, remember this value was gotten from the sum of those values there. So plus this value minus the one that we did here at the balance or at the beginning or at the end over here, 2022. If they're different, then that value should give us a value over here. So you can see, and we can just put the comma format over here to see that this check is indeed actually true right over there. So you can just put it like that, and maybe you can even just italicize that like that. So this is how we prepare the cash flow statement based on IAS 7 cash flow statement. And please make sure to always have these summaries over here indicated to you like so. So you can decide to even make it for presentation purposes. You can just make it like that, and put it like that. And this one over here should also be, maybe you can decide to put it in a big format like that. But now the outer part right here can be in a thick border like that. So this one can also be in a thick border outside, that for presentation purposes to your bosses, or for maybe a PowerPoint presentation. There like that is going to be part of data visualization. So this is it, the summary ends right there. You can decide to put our outside format there, then we put the like that, then the outside border over here. This should be at the center, so we just put center like that. Then this one should be indicative over here, should reach at that point there actually. There, and then we put the thick outside border like that. So this is bold. So perhaps it may not reach over there. So what do we do because it's not reaching over there? We just come and click margin center. Then we redo it again until where it reaches there. So we can now margin center at that point like that. So ladies and gentlemen, we hope you have enjoyed our session of being with us here at Manifested Publishers. We are here for you, and if you've got any questions, please you can be able to post questions on the comment section, and we'll be glad to answer your questions. Thank you for being with us. God bless you.
Greetings to you all and welcome to the revision session of the financial accounting paper that was done by CPA and CFA candidates on Monday, 4th of April 2022. This was a morning paper. The candidates were expected to answer 5 questions in a time period of 3 hours. And in this session, I'll be tackling a question at a time. In this first session, I'll answer question number 1. In the next session, I'll answer question number 2 until we complete the 5 questions. It's my hope that you are ready to revise. I also hope that you attended the class lectures where we took you through all the topics as per the 2021 Kasneb revised syllabus. Welcome to the lesson. Question 1 of the financial accounting paper that was done in April 2022 reads as follows. Part A, highlight 5 elements of financial statements, 5 marks. I'll first answer that one. Elements of financial statements. So candidates, what are financial statements? Financial statements are also known as the final accounts, and the main financial statements are the statement of income, or what we call the trading profit and loss account. The second one is the statement of financial position, also known as the balance sheet. The examiner required candidates to highlight 5 elements. The candidates who understand English did not have any problem answering this question, because if you know the meaning of elements, what is an element, then it becomes very easy for you to answer such a question. An element is a segment. An element is a constituent of something. An element is a section. The candidate required, the examiner required candidates to highlight 5 elements of financial statements. 5 elements of financial statements. This is financial accounting. We are revising the paper that was done in April 2022, question number 1. A, elements of financial statements. I've said the main financial statements are the income statement and the balance sheet. So what are the sections in a statement that is known as the profit and loss account, the trading profit and loss account? So if you are to look at an income statement or a statement of financial position, you'll find elements like revenues. And in a short while, we are going to be preparing a statement of profit and loss account. When preparing a statement of profit and loss account, which is a financial statement, the first section, the first element, the first segment is revenues. The second element in a statement of profit and loss account is what we call expenses. So these are the main elements in a statement of profit or loss account. Then the main elements in a statement of financial position, the main elements, we have assets. We have number 4, liabilities. Number 5, what we call equity. So these are the main elements of financial statements. Revenues. Now, what are revenues? Revenues are increases in assets or decreases in liabilities. What are expenses? Expenses are decreases in assets or increases in liabilities. When liabilities increase, then that is as a result of the expenses. Then there is assets. What are assets? Assets, or an asset, is a present economic resource that is controlled by an entity as a result of past events. What are liabilities? Liabilities, or a liability, is a present obligation of the entity to transfer an economic resource as a result of past events. How about equity? Equity, learners, is the residue interest in the asset of an entity after deducting all its liabilities. We know from the balance sheet equation that assets equal liabilities and equity. So if you are to make equity the subject of that formula, then equity will be equal to assets minus liabilities. So these are the main elements of financial statements. Example of revenues are things like sales, right? Revenues are items like discount received, commissions, and so on. Expenses are like airtime, telephone expenses, transport expenses, insurance expenses. You can name them, all right? Assets are like land. Land is an asset. Buildings are assets, all right? Prepayments, prepaid expenses are assets. Inventories is an asset. Then liabilities, accounts payable, loans, those are liabilities. Okay? Equity, we're talking about here capital, reserves, premium, share premium, and so on. So this would earn you how many marks? 5 marks. Identifying the elements will earn 5 marks. 1, 2, 3, 4, 5 marks. Let's now move on to answer part B. I read, Fatuma Ali commenced business as a result as a retail chemist. Fatuma Ali commenced business as a retail chemist on 1st January 2021 with an initial capital of 30 million shillings, which she paid into her business bank account. She hired a shop manager at an annual salary of 2 million shillings. In addition, the shop manager is to receive a commission of 10% of the gross profit. During the year ended 31st December 2021, Fatuma Ali did not maintain proper books of account. After an examination of the available records, the following information was extracted. The bank statement for the year ended 31st December is as follows. We have the receipts and the payments. Then below the bank statement, additional information number 1, I read, all sales were for cash and sales are banked. All sales were for what? Were for cash, and sales are banked daily, subject to the retention of a cash float of 100,000 shillings. The following payments are made out of cash sales. We have the manager's salary, drawings, payments to suppliers, general expenses. Note number 2, I read, as at 31st December 2021, checks sent to suppliers amounted to 2.5 million had been presented to the bank for payment. Number 3, as at 31st December 2021, invoices from suppliers amounting to 8.6 million had not been paid. Number 4, as at 31st December 2021, inventory was valued at 36.5 million shillings. Number 5, depreciation per annum is to be provided on motor vehicle at the rate of 25% on cost and on the shop fittings and equipment at 10% on cost. Note 6, during the year ended 31st December 2021, Fatuma Ali took goods which cost 100,000 shillings for her personal use. Required 1. Statement of profit or loss for the year ended 31st December 2021. How many marks? 8 marks. 2. Statement of financial position as at 31st December 2021. How many marks? 7 marks. 7 marks. This is part B. Statement of profit or loss. The name of the business? Fatuma Ali. Fatuma Ali. Fatuma Ali. Fatuma Ali. We are preparing statement of profit or loss as at what? For the year ended. The period is 31st December 2021. 31st December 2021. This is a statement of profit or loss. And in part A, we said that the elements of a profit or loss include revenues. So we're going to begin here with the revenues. The revenues are in millions. Fatuma Ali revenues. So the first revenue here is the sales. Sales. For us to calculate sales, we need a working because the sales are not provided clearly in the question. Why? Because Fatuma Ali did not maintain proper books of accounts. If Fatuma Ali prepared proper books of account, then these sales we need to pick it from the trial balance. But here there is no trial balance, therefore we are going to use the information provided to determine the sales. So working number 1 will have sales. Working 1. And from the receipts, from the bank statement, we can see we have sales amounting to 123,720 shillings. In addition, information number 1, we read that all sales were for cash and sales are banked daily. All sales are what? Were for cash. That means the customers were not allowed to pay by check. It was just by cash. And sales were banked daily, subject to retention of 100,000 shillings float. So the payments that were made out of cash sales, you have manager's salary, drawings, payments to suppliers, and general expenses. That means that when Fatuma Ali received cash from the customers, that cash was used to make cash transactions, and they are listed. So when preparing the sales account, these are the items to include in the sales account. Working 1, these are workings. 1 sales account. Sales account working 1. Now in note number 1, candidates, we read that all sales were for cash and sales are banked daily, subject to retention of a cash float of 100,000 shillings. So all sales were for cash. What does that mean? That means that Fatuma Ali sold on cash basis. The customers paid in cash, and all the cash was banked So if we check the bank statement, you can see the second item on the debit side of the bank statement reads sales 123,720,000. So that's the first item to recommend to record in this account, bank 123,720,000. So out of the cash that was received, 123,720,000 was banked. But we read in note number 1 that not all the cash that was received was banked. Part of that money was spent, and we've given the items here. So we're going to prepare another account, which I'll call cash account. The cash account, because some of the sales that were received were paid out of cash. And the first item there is manager's salary. The manager's salary was paid out of cash, because when you pay salaries, you credit the cash account and debit the salaries account. So here we have 1.98 million. 1.98 million. The second item, drawings, 4 million. The third item, payment to suppliers. Suppliers were paid how much? 1390. General expenses. General expenses amounting to 840 was also paid from cash. Then there is also the float, retention of 100,000. Float of 100,000. So these are the payments that were made out of the cash sales. So I'm going to have the total 1980 plus 4 million plus 1390 plus 840 plus 100 is 100, which gives me here 8,310,000. 8,310,000. So the balancing figure, we need to balance this account by transferring all these amounts, which is a total of 8,310,000. This amount we transfer to the sales account. Sales account. So this amount is transferred from cash account to the sales account. So we record here cash 8310. 8310. So these two will constitute the sales for the year. So there are sales that were banked and sales that the amounts that were used to pay these expenses, 8,310,000. I'm going to get the total 123,720. The amount that will be transferred to the statement of profit and loss is 132,030. 132,030. 132,030 is the figure for sales, working number 1. 132,030,000. 132,030,000. That is sales for the accounting period ending 31st December 2021. So what is the cost of these sales? Cost of sales. We read from this question that Fatuma Ali commenced business as a retail chemist on 1st January 2021. That automatically tells you that Fatuma Ali did not have opening inventory, because it's only been in operation for 1 year. so there is no opening inventory. But we have purchases. Purchases. Again, purchases are not provided directly from the question because the businesswoman did not maintain proper books of accounts, because if proper books of account was prepared, then